Right, good morning ladies and gentlemen, and a warm welcome here in Cape Town, Century City, to the 10th annual BCI Global Investment Conference. I'm Adrian Brock and I'll be your MC for the next 3 days. My average privilege to speak to you all here. 3 days, yes, but just keep in mind that third day, Wednesday, will be online only with our global investment managers. A big thank you to the audience and the presenters here today. We really appreciate the time that you took in all being here, and to all our presenters, all the hard work you've done in preparing for these sessions and speaking to the audience. A big welcome to our online audience. We are streaming live, so we've got a big online audience as well. So thank you very much for joining us online as well. We would like to see you here next time live in Cape Town as well. Looking at the agenda, I'm going to come back to the QR code. Looking at the agenda, Tanya, Olga and the BCI team once again made for a fantastic lineup of some of the top quality investment managers locally and globally. So we trust you're going to find a lot of value over the next 3 days. The key themes of rate cuts, local and global elections, asset class valuations, macro events and geopolitical risks will likely permeate through a lot of the presentations you'll see today, prepared by, like I said, some of the top investment managers in the country. But I think more so what is important is a lot of those fundamental truths that will come through as well. Some will argue that 2024 are probably, or there's more uncertainties in 2024 than 2023. 2023, we knew that rates are going up, we knew inflation's going up. End of 2023, we were all certain that there's going to be 3 rate cuts in 2024. And look where we are today. So, slight possibility of no rate cuts for this year. The point rather being is that we all know forecasting doesn't work. And hence, again, going back to fundamentals and understanding how fund managers see the world. In asset class specific funds, we're going to look at all the major asset classes, local, global equity, but also fixed income funds and then multi-asset funds, how they see the world and position for that. Yes, there's a lot of risks remaining, but to quote Benjamin Graham perhaps, successful investing is not about managing risk. It's about avoiding it. So we'll see how the managers do with that. We've invited some of the top DFMs in the country to moderate a lot of the sessions here today, coming with a wealth of experience, and to name them, and we're really grateful that you also took the time in preparing for the session. We've got Apex Investment Consulting SA, In8 Invest, Corian, Net Group, Multi-Managers, Equilibrium, Portfolio Metrics, Might and Optimal, Morningstar, Analytics, and Sanlam SMI. I hope I didn't miss any one of them. So a lot of DFMs joining us here today, and they'll be sure to make for great content. After each session, we've allowed for a Q&A for our moderators to engage with the presenters, but also for you as the audience to engage. We've got a roaming mic, so if you want to ask questions to any of the panelists, you're more than welcome. If you don't want to ask an open question, you can always mail it to marketing@bcis.co.za, so that email address marketing@bcis.co.za, very easy one. You can mail it through there. The tech team at the back will make sure that it appears here on the tablet in the front, and they can actually field the questions as you queue them live. To our online audience, you know how it works by now. We've got a Q&A bubble on the Zoom field on the background of the live streaming. So also more than welcome to set your questions in there. From Robert Walton, the BCI team, we want to thank you for your continued support, and really great to have you all here in making BCI a massive success, but it's all due to you and the presenters, all the fund managers that you'll see today. Our first session for today on South African Equity Outlook, and on the stage already ready to go, and here to moderate the session is Managing Director Pierre de Klerk from Apex Investment Consulting SA. Pierre, thank you very much for being here this morning. He's joined by Cy Jacobs from 361 Asset Management, Chetan Pillay from Allan Gray, Peter Armitage from Anchor Asset Management, and Barry Shamdi from Investec. Gentlemen, thank you all for being here this morning. And Pierre, I'll hand over to you. Thank you very much.
Thank you. Thanks, Eugene, and thanks, James, for joining me, and welcome, everyone. I hosted the same session this time last year, and at the time it was just after the coronation of King Charles in the UK, and I remember I tried to kind of link the theme and said that for a long time SA equity was viewed by all of us as the king of asset classes, and in the old days we were limited in the extent that we can invest overseas, but that have changed. And last year, this time, valuations was already looking good, and we said, what do we expect for the year ahead? Now, 1 year forward, we're on stage again, and I think, although there's been some dispersion, it's reasonable to say that the outcome from SA equity has been underwhelming over the last year, at least at the index level, and valuations still look good, and some can argue even better. So, we find ourselves in a place and in a time where there's this kind of continuum of opinions. At the one end, there are managers and investors that talk about SA being a compressed spring, just waiting to unleash the value, and that we're going to make between 18 and 40% in the next year because valuations really offer opportunities. And then on the other end of the spectrum, there's investors and certainly managers that believe the structural problems are really severe, and it's a value trap. It's not pent-up opportunities. So I think that's the background against which we talk about SA equity this year, and the background for the presentations by the presenters. So we're going to start, and each of you can follow the other without interruption. Thank you. So we start with you.
Thanks. Right, good morning, everybody. We only have 12 minutes each, so it's not going to be too long, and I've got a few slides, so we'll just take you through them. I think my topic was actually stolen by Alan Gray, SA too cheap to ignore, so we just called ours election and economic outcomes. I think the great thing about speaking first, obviously, is that I won't be the one repeating a lot of things that I'm sure others are going to say. But really, if you take stock of South Africa, where are we right now? We're all feeling pretty good. The last month we've had no load shedding. You take us back a year, we were going into winter and things were exceptionally bad, level 5, and landed up at close to 6 to 8. If you look back, how have we done? I think there's been a great improvement. Obviously, businesses helped bring on new energy. And at the same time, I actually think the new minister's done phenomenally well. And you've seen a tweet he put out recently, those who follow him. On the Transnet side, we also had some major hiccups. It's good to know, and you'll see a slide following on shortly, that things have improved drastically, especially over the last few weeks with coal deliveries. And we shot ourselves in the foot over tourism for many years, but if you look at the numbers in 2023, we saw a phenomenal increase of some 50-odd% on the previous year. We haven't seen the December 23 numbers, but our estimate is that those continue to be pretty good. And overall, South Africa, from the base that we were on before, it must be said that there is some improvement around. Having looked at the whole world and really what's really driving the world and driving markets, obviously rates and inflation are key to everybody. Where are we in the cycle? It's great to see that at least at a South African level, inflation is dissipating. In fact, globally, looks like it's coming off the boil. Often the Fed is behind the curve, and we think once again maybe rates should start being cut already, but probably waiting for slightly lower signals. But again, we're at the point where rates really shouldn't be moving higher, so hopefully in an election year, which is also one of the big challenges the world's facing throughout the world, many elections, we do feel that we're near the top of the rate cycle and that markets will remain stable given elections. Obviously, one of the positives, as I've mentioned, SAE reforms, we've seen big improvements in the likes of Transnet and Eskom. There are some others that need help, but we are seeing some progress. The big thing has been China's recovery, and obviously SA is very linked to China, and we have seen very, very slow steps in getting China right. We think that's maybe done on purpose at a very slow level. Obviously, the property sector took enormous strain, but we are seeing some positives come out of China as well, particularly on regulation and the reversal of regulation. We've seen what's happened in the IT sector over the last few weeks particularly, and it's re-rated significantly, and we're still pretty positive that things will move slowly in the right direction on that front. Just some of the stuff. I haven't got too much time to talk, obviously. I've only got 8 minutes left now. But really just some interesting facts around energy and how many new projects have been approved by NERSA, some 108 underway at the moment. And really this problem is really going to be gone in the next year or two, which we think that already over winter now you're looking at a much lower, say 1 to 3. And Transnet, just some interesting observations around coal transports. And you can see that over the last few weeks, we've seen significant pickup on the line. In fact, the best we've seen since January of 2023. The big thing obviously coming quite fast in the next 3 weeks is the SA election. And what do we think will happen? Well, I think this doomsday coalition scenario is not going to happen. All of us, I think, have been scared, and I really believe the market, up until maybe a few weeks ago, was pricing this doomsday coalition, that potentially the ANC and the EFF or the MK, whatever it may be, may form the coalition. And really is our understanding that's not what the ANC wants. They've realized there are parts that they have failed in, and they obviously want to keep as much control as they can. And they realize that they will be looked at positively if they do something that will help South Africa. So really our base case, I'm not going to go through all the various alternatives, but really our base case is that the ANC gets somewhere between 40 and 45 and looks to do some kind of friendly coalition, which I think overall will be good for markets, particularly where markets are pricing equities today. And our overall guess is that these polls at 37 and 38 and 39 are a little bit too low, and we think more like a 42, 43% mark, because you do know that closer to elections, the ANC does put in a big effort to drive their voter base into voting, and even buses them to the various voting stations, etc. So we think that things will probably land up at the 42, 43. But the big thing is we hope that we get a coalition with part of the Moonshot Party or the DA, which is what we're hopeful for. What's driving our economy a lot? Well, we have had a very sluggish GDP over the last few years, but there is a very big component of the informal economy which is driving growth, which is unmeasured in South Africa. We think this bodes well, and I think that's why a lot of times we look at retail earnings and that always seems to surprise on the upside. And I think this has been a very important factor in South Africa over the last number of years. We look like we're a lot slower than in fact we are, and you can see by the private consumption as a percentage of GDP, that continues to rise. Obviously, this has been hindered a little bit by soaring inflation over the last while. Obviously, load shedding with its costs, etc. But obviously, we think that is abating, and we're hopeful that this part of the economy picks up further over the next couple of years, especially as interest rates start to fall. I think what is interesting to look at is just where our market is actually priced from a historical point of view. If you look at our Aussie, obviously going back some 10 years, you can see we're somewhere near the low. Bear in mind there are dips there like COVID and Nenegate, etc., that are very close to where we are now. And if you look at the South African market, even compared to other emerging markets, you can see that our multiple, etc., looking forward for the next 12 months, looks somewhere very much on the low side. And bear in mind that emerging market index also includes the likes of China, etc., which has really come off, probably 60, 70% from its all-time high. So looking at the stocks overall, and SA stocks particularly, so this is really looking at domestic equities, for example, like SA banks, and just looking at where that multiple sits, again going back to March of 1995, so almost a 30-year history, and you can see both the SWIX and the banks multiples sit massively below that of the developed markets and emerging markets, and you can see developed markets which have had a phenomenal run, particularly the US, over the last number of years. If you compare that bottom blue line to the top grey line, it does seem that is slightly out, and it is apparently 2 to 3 standard deviations away from the norm. And I know everybody's thought that's never going to change, but I think for us, the US is one particular market where current rates are, that is particularly overpriced relative to the outlook for earnings. Looking at an individual stock level, I think it's just interesting you take a stock like FirstRand, which is probably, in our view, our best quality, well-priced bank with good growth prospects. You have a look at the forward multiple of this. When has it been this cheap? Well, it's only been this cheap, in COVID, which obviously, nobody knew the world was going to survive, and we understand valuations at that time, but previously only when we had the Nenegate scandal. So, how bad are we currently? Well, there's obviously a lot of nervousness around the election. But I think that, looking forward, this is a good opportune time. And I think we've seen, FirstRand being pretty consistent with all other banks. So we would argue, given the multiple of probably 6.5, the dividend yield of over 9, other banks 10 to 11 on the dividend yield side, we would argue this is the time you should really be looking at SA Inc. Interesting example as well was like a Mr. Price. If you go back to the previous election when Ramaphosa came in, and we had this term Ramaphoria, we always all believed he was going to be fantastic for South Africa. Turned out to be the biggest disappointment. But the point of this is we had a Mr. Price, for example, trading on a 14, 15 multiple. He came in, everybody felt positive. The stock re-rated to a 25 multiple. So we had like a 40% upside from a 15. We're now sitting at around a 10 and 11. We're not saying we're going to get a fantastic result. We're all going to believe that the DA or someone is going to take over. But I think the coalition is a big positive for South Africa. It means going forward that we're no longer controlled by a single party, and that will be the first time ever. And I think if there is some working together of 2 or 3 parties, I think overall internationals and particularly domestics could find that very positive. And hopefully the market picks up some momentum. We don't need the 40% upside, but on a 10 or 11 multiple, who's to say it can't go back to a 13 or 14? And for that, you'd see significant upside in most of the domestic sector. Just quickly on our fund, a couple of slides, just to say that during a lot of the periods of extreme volatility, just to show that the 361 SA Equity Fund generally does pretty well over those times. We've seen a lot of big things like COVID and wars, and we've still got a lot of geopolitical wars around, but hopefully we're a little bit more defensive than most of the other funds out there. And then lastly, just something that we think we do very differently, particularly to other larger funds in the industry, is we have a true active management style. So for us, being overweight or underweight sectors, we continually change our views. You can see, for example, in the attribution of just in the resource sector in the left square, how much attribution versus the market our SA Equity Fund has produced each and every year from 2019 to now. There's some 20 to 25% of outperformance just from the resource sector, from being under or overweight the right parts of the resource sector at the right time, which has obviously led to big outperformance, consistent outperformance in the middle block versus the market. And obviously, very importantly for us as well, is capital protection. And the last big event we saw was obviously COVID, and you can see that during COVID, even the equity funds performed significantly better than the market. And we'll get to talking about the hedge funds in 2 days' time. But that's it for me. Thank you. And I've just 10 seconds left, so perfect. Cool. Thank you.
Spot on time. Thank you. Thanks, Si. Spot on time.
Yeah.
Thank you, Jason.
Good morning, everyone. Today I'm going to be talking to you a little bit about SA Equity, as kind of has already been discussed, but also talking to you a bit about how we're thinking about it. To make it a little bit interesting, I'm going to do it through the lens of Bobby Axelrod. And for those of you who may not know who Bobby Axelrod is, he's one of the title characters in a show called Billions. If you haven't watched it, I'd highly recommend you do so. It's very entertaining, especially for those of us who work in finance, and I also think it's a very well-written show. Effectively, if you don't know what it's about, it's Billions revolves around Bobby Axelrod and his adventures as the CEO of a multi-billion-dollar hedge fund. And now if you know Bobby Axelrod, you know he sometimes does some things that are a little bit over the line, so let's put that to one side. But the one thing he does do is he always takes a kind of objective, dispassionate, objective view in whatever he's doing. So let's take that lens and apply it to SA equities. Key point, my title of my presentation, SA Inc. Too Cheap to Ignore, should have a question mark at the end. And I say that because I think it makes a big difference, actually, to the message that I'm probably going to deliver today. Okay, so at a headline level, is SA Inc. cheap? At a headline level, the data would agree with you. So what this chart shows, it's just the price-to-earnings ratio of the JSE Mid-Cap Index. And I've used the Mid-Cap Index as a representation for SA Inc., or SA companies that are predominantly exposed to the SA economy. And I've got the data here over the last decade, and what you can see is, well, over the last decade, it's traded at somewhere around a 16 times average. Today, we trade at about 11 times. Right? So on a headline level, SA assets have certainly derated. However, when we look at this chart, we must ask ourselves, well, let's look at the next best alternative. And actually, if we look at the textbooks, the textbook will tell you that actually one of the important determinants of a PE is the risk-free rate. And I use risk-free rate in inverted commas in the South African context, but what I've used here on this slide as a proxy for the risk-free rate is the SA long bond. And what you can see here is we've gone from 7% to 12% in a decade. The other thing that worries me about this chart is actually the trend of higher highs and higher lows. You know, South Africa, we tend to push ourselves to the precipice, we tend to pull ourselves back, but every time we've done that, investors have asked for a higher rate of return to lend to us. So at least from a cost of capital perspective, the derating in South African assets, one could argue, is somewhat justified. But you may well tell me, Jathan, you guys are fundamental investors. Surely it's earnings that matter. And I would tend to agree with you, so that's what I've put on this next chart. And what this just shows us is, for the same mid-cap index that I showed you earlier, what are the earnings of those companies in that index after inflation? And for me, this is quite an interesting chart, because what you can see is, again, it's a decade worth of data. Up until just before COVID, SA Inc. earnings were flat after inflation. SA companies were not able to grow their earnings. Then COVID happened, and you can see the kind of step down. Thereafter, it was interesting. If you think of a company like Tsogo Sun, you couldn't gamble at its casinos, you couldn't stay at its hotels, and so what were they forced to do? They were forced to cut their cost bases quite materially. And so what happened was you have a much leaner cost base, you have a reopening of the economy, revenue tends to recover, earnings of these companies started to grow because now you had revenue on much leaner cost bases. And so you saw that nice uptick in revenue as the country reopened. But then the question became, what next? And unfortunately, what next meant, well, now you've got a higher level of revenue, so for some companies, that meant you needed to bring some costs back into the system. But the second part of this is then you had to deal with load shedding. You had the extra diesel and waste and all of the other costs associated with load shedding that have come into the base. You put that together with stagnating revenue at a headline level, where actually companies, before it was kind of a rising tide lifting all boats, now it's actually companies that are growing top line are generally stealing market share from somebody else. You can see what's happened to SA Inc. earnings. The net result is, as we stand here today, after inflation, those earnings have basically gone nowhere for the better part of a decade. So again, SA assets have derated, the SA cost of capital has gone up structurally, and SA company earnings have basically gone nowhere. And again, if we look to the textbooks, they'll tell you one of the main determinants of a price-to-earnings ratio is growth, the growth rate. So if, in theory, SA companies aren't growing, they deserve to trade on a lower PE multiple. So, I've kind of painted a negative picture, and, you'd probably rightly tell me, well, this is well known and perhaps priced into assets as we stand here today. To my mind, I think what's important is, well, then what needs to change, right? If we want to look forward, something has to change for that picture to change. And to my mind, it's two things that need to change. Firstly, South Africa's growth rate needs to improve, and in particular, SA-focused companies need to be able to grow their earnings. And the second part to this is South Africa's cost of capital needs to come down. The second one worries me less because if South African companies start growing earnings again after inflation, foreigners are likely to pile back into our market, and the cost of capital issue will take care of itself. People will be willing to lend to us at lower rates. So actually what needs to happen is the country needs to grow again. Now, I'm sure we all have our views on the future growth trajectory on our country. There's several challenges to my mind. I'm going to highlight two in the interest of time. One in our control and one out of our control. The first one out of our control is China. As much as we've tried to diversify our economy, South Africa is still very much a resource-dependent country. And as a consequence of that, we're dependent on China. And there are a few factors here that make me worried. The first one is the Chinese property sector. I'm sure you've been following the news and have seen the kind of troubles that Chinese property is going through at the moment. This is relevant because as we stand here today, China consumes just about 50%, actually slightly more than 50% of most of the world's industrial commodities. So a slowdown in Chinese construction will naturally have an impact on commodity demand, at least in the short to medium term, and commodity prices. Second thing that worries me about China and the Chinese economy is demographics. Largely as a consequence of the one-child policy, you can see you've got not only do you have an aging Chinese population, but actually you don't have net growth in the Chinese population. And that's not forecast to get any better. The last kind of picture that I have there is just to represent geopolitical tension, between China and the West. What happens to the Chinese economy, for example, if they decide to invade Taiwan? And what does that mean for commodity demand? And as a consequence, what does that mean for South Africa? Bobby Axelrod had if you can't see it on the screen, he had a very interesting quote on China. I think it sums it up quite nicely. I purposely had to keep the slide away from our marketing team because they probably would have taken it out. All right. Something in our control, and it's already been alluded to, is Eskom and load shedding. The chart on screen just shows the bars show Eskom's ability to generate energy, and the gray line represents peak demand for electricity. And the thing to take away here, as we all know, is Eskom cannot satisfy peak demand other than the last few weeks. I guess what's been keeping the show on the road thus far is the private sector. The private sector has come to the party in adding private generation. That's great, but the problem is, at least over the short to medium term, we are highly reliant on Eskom for baseload generation, and that baseload generation is dependent on an increasingly aging coal power plant fleet that is likely to become more and more unreliable as time goes by. So, this makes me worried. This makes me worried not only because it means we kind of are in darkness, but there are kind of real-world consequences to this. If you think about ShopRite, the kind of large diesel and waste bill that they're incurring, that's largely being passed on to customers. It's why we saw food inflation spike at 14% last year. Something like that can be very dangerous in an economy that isn't growing. If you think, generally these are the things that kind of start social unrest. So, those are kind of the two factors that make us a little bit worried. And actually, as a result, we don't think South Africa is a dripping roast. And actually, you've seen that over the last 12 months. And what I've got on screen is just the total returns over the last year of selected SA Inc. stocks. And I take away two things from this. The first thing is there's been disparity just between companies exposed to the same to the same economy. But interestingly, there's been disparity within sector. What I've highlighted in red are the total returns of the banks. You can see a bank like Nedbank has vastly outperformed a bank like Absa, even though they're both kind of largely SA-focused. So, to our minds, there certainly is value in SA, but you have to be highly selective in what you buy to avoid falling into what we believe could be value traps. So, putting it all together, 2024 is a year of heightened uncertainty, both SA and globally, and we don't know what's going to happen. And as a consequence, we've tried to position for a wide variety of outcomes. However, we have tilted the portfolio, and what I've got on screen is just the breakdown of the Allan Gray Equity Fund. You'd notice that more than two-thirds of the portfolio or of the fund have very little to do with the SA economy, either in direct offshore shares that we hold or in the lighter gray pie section, SA shares shares that happen to be listed in South Africa but have very little to do with the SA economy. In the red part, which is the shares that are more domestically focused, we have a strong preference for shares that have some sort of self-help story. And by self-help, we mean companies that have internal levers to pull to help improve their economics. That just summarizes what I've just said. Thank you very much.
Thank you. Thank you, Peter.
Yeah, let me talk you through Allan Gray's top 10 shares.
I think you'll have to click a few more times.
We're a bit worried about number 9 and 10, but we're coming through. Okay, making money in a post-election South Africa. I'm actually chuffed Allan Gray came through with a slightly negative view, because I think the other three of us are all slightly more positive, certainly in the shorter term. I don't think we drum banging on South African equities over the longer term, but we think over the next 12 months is a pretty good outlook. And I think we've also all got common roots. I think I followed Sa and Barry followed me at Investec, so we probably come from an optimistic background. I had a very strange experience yesterday. We've got our national conference for Anchor next week, and I was asking for the stars of the show for people to give awards to. And our fixed income manager, Nolan Varpenaar, put forward a guy called Leletu, because he said he sits there studiously all day long, looking for and scrutinizing and trying to find that one extra basis point. And every time he does that, he squeaks with joy. And I thought, well, that's beautiful. But when we started our business 12 years ago, that wasn't quite how we thought it would work out. Equity bulls, we started a local equity portfolio, we started a global equity portfolio, but fixed income is now the biggest part of our CIS range, and largely because local equities have been fairly disappointing. But having said all of that, for the next 12 months, we think there's a reasonably good outlook. I want to say thank you to BCI. This is the 10th conference we've been at. We started our business 12 years ago. I think we've got about 20 billion rand of BCI's collective investment schemes, so thanks to all of those who support us. Our business is now sitting at about 130 billion rand of AUM, and we're very proud of where we got to in partnership with BCI. So the summary of our thinking, the world has changed dramatically. I think you can't ignore geopolitical risks at the moment. Equity valuations are at stretched levels. And one of the stories of today that I want to get across, and you've heard a bit of it from Sai, is that global equities are at extremely high valuations and South Africa is at extremely low. So as simply as that, a lot has to go right to get continued performance out of global equities. And just a reasonable base case in South Africa could see a nice bump up in equity performance. Interest rates are at their highest level in 15 years. So there's a lot of potential for stimulus to come back into the economy. We're largely reliant on what the US does, but we think we're at the top of the curve and that will start to come down. However, talking about, and one of the things to get across today, South Africa is a tiny little niche. It's 3% of emerging markets, not 3% of the world. So you really do have to have a global perspective. And I'll just compare some of the things that you can and can't buy in South Africa. In South Africa, you're buying something very specific, which you wouldn't choose to own over time. But at this very point in time, we think it looks interesting. Our RAND forecast in 12 months' time is 1850. We made this forecast in our quarterly document when the RAND was sitting at 1930. But again, we think in 5 years' time it will be 25. And one of the nice things with investing is if you have a high level of confidence in one of the metrics, you can build a portfolio and build an investment outcome around that. But today, when you look at the interest rates environment, our core income fund, which we nearly didn't launch 3 or 4 years ago, has now got 5 billion rand in it. and that's earning 9.3%. But if you look across to the equity market, you can get a 10 or 11% dividend yield. Now, dividends are taxed at 20%, and when a company it gets passed on, and income is taxed at 45%, or we can offer you 10 to 11% in the redefines and the growth points in dividend yield. And all of those will grow at 5 to 10%. So mathematically and fundamentally, if you've got clients who are looking for an income, it starts to look very attractive, in spite of the fact that you can earn high interest rates over in the equity markets in fairly low risk counters. So it's Goldilocks conditions in the US, but equity valuations are high. So the bottom line from an SA equity perspective, we're looking for about an 18% return from SA equities over the next 12 months. There is the potential and the optionality for that to be a bit higher if things turn out not as badly as the fearmongers. And we think there's big upside to the mean. We certainly can't argue with the facts that Alan Gray presented, but looking one level down below those mid-cap indexes, there's also companies trading at 5 or 6 PE multiples that we're fairly confident do have some pretty nice growth ahead of them. So I always look at my own personal share portfolio, and it has certainly got a lot more bias to South African shares. But then not to forget about what's happening around the world. And if you're going to invest in equities, the starting point are these 20 shares, which are close to 40% of global equities. And this is evidence of the fact that if you've got a good business model and a good IT plan, you can pervade the world. The iPhone having 1 billion phones, etc. So I just broke up the other day the top 20 companies in the world. 9 of the top 10 and 9 of the top 20 are IT, and you're hitting the $2 trillion there. Surprisingly, when I did this, 5 of the top 20 are pharma. And that's because if you've got a good drug or product, again, a little bit like IT, you can sell it all around the world as opposed to just in your region. If you go back 10, 20, 30 years ago, beverages companies, if they wanted to sell in a country, they had to build a factory, and there was a lot more capex involved. Then 3 out of 20 financial and 3 out of 20 other. So why am I showing this in a South African context? Because if you want exposure to the growth areas of the world, you can't really get that in South Africa. So I guess it's no surprise that we have lagged. There's a choice of one IT company, and that's Naspers. Well, that's doubled recently because there's Prosus. And there's a choice of effectively one pharma company in the form of Aspen. And then going through to talking about the composition of the SWIX, which you hear a lot about, it's really 45% South Africa and 55% the rest. So all of the things that we talk about, the poor SA economy and the prospects and the pressure on banks and the talk of nationalization that comes from the lips of Julius Malema, that's in that 45% component. And again, if you look back in the history of our fund over the last year or two in SA equities, we've steered away from that, but over the course of the last few months, we've gone quite heavily back into that green segment, where we're saying the South African economy, where you can get your 10, 11% dividend yields on companies that are growing, starts to look quite attractive. Quite an interesting point is the index earnings in US dollar terms. So the blue line here is US dollar earnings from the US market. And you can see this is based to 2007. It's gone from 100 to 260. The rest of the world in dollar terms has basically been flat. So the phenomenon that we were talking about earlier of earnings not growing, this is in dollars, of course. So remember that the dollar since 2007 to today has weakened by an average of about 6.5% per annum. So all of the rand earnings growth has been eclipsed by that. What you can see, however, is the dollar turning a bit. And we think as rates start to come down in the States, the very, very strong dollar that we've had for the last few years has the risk of weakening a bit. So you can go through a period of this graph where SA earnings might be a little bit stronger. So this is the world index forward PE multiple, probably a graph that you'll see about 20 times over the course of today and tomorrow. But I guess the key point is it's sitting at close to its highs in the last 15 years. That's one standard deviation. And by contrast, the South African forward PE multiple is at its all-time lows. So those are the two issues that you're dealing with. South African GDP growth is sluggish. So again, we're not sending out a message of shift all your money permanently back into SA, but we certainly would be backing SA equities over the next 12 months. You're sitting here with SA GDP growth of 1 to 1.5%, compared to a world stage where it's sitting at about 3%. So the stage in which you're operating is simply a lot more attractive from a global perspective. I'm scared 3 slides are now going to appear. Yep, as I feared. So there's our RAND PPP graph. You can see South Africa is about as high as it's been away from PPP since 2000. So you see the potential for the RAND strengthening in a bit. We are of the view that there's about 2 to 4 RAND of kind of South African corruption and bad factors sitting in the currency. And then this is really what we've got to look out for. This is our debt service cost as a share of the main budget revenue. So if you view South Africa, the country, like a company, and it's got 100 Rand of turnover, it's spending 20 Rand of that 100 Rand on servicing debt, which is, and you can see we've quite responsibly kept it around that 20% level, but we can't afford to go any higher. Because obviously if you start to spend more than that of your revenue on interest, you simply don't have enough money to put back into the economy. And social grants and the like are eating up another 25%. So if we look at the South African index and we go through the different factors, domestic shares we think look pretty attractive, are very well priced. In that, banks, insurance, and retail are the key. Those are components of SA domestic. Rand hedge, which is where we focused in our fund and seen us perform quite nicely over the course of the last few years, has worked quite well, but we've moved that back to SA domestic. We've also, of course, had the issue where the big asset managers have moved their offshore allocation from 25% to 45%. You would have seen that in Alan Gray's slide. So we think that phenomenon and drive is close to over, so you don't have that technical factor underpinning the market. And then just the last slide on where the bank valuations sit. Just to put them up on a screen, ABSA is sitting at a forward 5 PE multiple, and if you go one level down, the dividend yields, ABSA 11%, Nedbank 10%, Standard Bank 10. So these are businesses we think that can grow at a compound 5 to 10 or 15% in a good year, and you're receiving that 10% in cash. So a pretty nice place to park if that's attractive to you from an investment perspective. Our forecast 3-year earnings growth, taking out Capitec of those banks, is actually around 9%. So that makes, for certainly on a spreadsheet, a very attractive perspective. Yeah, so that's our view on things. I think Magnus Haystack will only want to shoot 3 of the 4 of us up on the stage today, but I'll hand you over to Barry.
Thanks, Peter. Thanks, Barry. Thanks, Pete. Well done. Okay, good morning, ladies and gentlemen. It's great to be back here again in a cold Cape Town, but hopefully what I've got to say will warm your hearts. Hulle weet nie wat ons weet nie. They don't know what we as South Africans know. We're built different. A phrase coined by Drickus Stilnox du Plessis, made more famous by our Springbok rugby champs, and, which I didn't know, a song now by Kurt Darren. So let's go back to investment principles, investment basics, risk and return trade-off. You take on high risk, you expect it to get higher return or potentially higher loss, but it should come as no surprise then that South Africa since 1900 has been the top performing equity market in real terms, believe it or not. And some of you may say, well, maybe it was risky back then. I promise you it wasn't less risky. Sorry, oops, one back. This was highlighted in a couple of the other slides, but we are an emerging market. I think people do forget that sometimes. I know a lot of us like to think that we are similar to the UK or the US, but we're not. We're an EM, and if you look back, this goes back to, I think, 1992. We've traded more or less in line with an emerging market. You can see there has been a little bit of underperformance of late, but you can also see that during COVID and when we had that commodity spike in South Africa, that performance picked up quite quickly again. So really what we are is we trade at the whim of global emerging markets. We're not really trading on South African fundamentals. Another interesting thing is why do we think that EM underperformance can change? Well, if you have a look at this, you can see there's quite a strong link between EM outperformance, so this is the emerging markets over developed markets, versus the commodity index. Why do we think this could change? Well, there's 2 reasons. Number one, on the demand side, the developed markets are way behind on infrastructure investment. There's a lot of infrastructure that needs to be replaced. But number 2, we've got this net zero commitment by companies and countries around the world that have committed to energy transition, renewable transition, and that is extremely commodity intensive. Not just green metals, but all metals, steel included. There's one further reason, is that there's very limited supply growth. There's supply growth, because of the restraint of CEOs since the credit crisis, there hasn't been much new investment in the commodity space. So now you can see, even with an example is this bid for Anglos now, companies haven't invested, so they need to acquire, and they're looking at ways to increase their exposure to some of these green metals, like a copper. So you can see there has been some pickup here in the commodity index, and if this persists, I mean, I don't know the exact timing. I mean, I thought it'd happen a year or two ago. If it persists and this commodity demand comes through as we expect, it'll be very good for emerging markets and for South Africa, a commodity exporter. Moving down from a global level to South Africa level, our strategist, Chris Holdsworth, has created this index of SOE performance. It includes rail, ports, and Eskom energy availability factor. And believe it or not, our performance has actually been improving since the start of last year. Not something you'll see in the newspapers. Good news doesn't sell, but certainly something that you should be conscious of, especially in terms of bottlenecks businesses have experienced, in terms of cost bases businesses have experienced, in terms of cost of diesel, etc. We're also sitting at the highest real rates we've ever, well, not ever experienced, since around the credit crisis, 2008. Now, I know there's been a lot of toing and froing this year about when the first rate cuts are going to come, but they're coming. I'm not sure exactly when. Maybe it's in the third quarter of this year, maybe it's early next year, but I think we have reached a point where rate cuts are starting to get penciled in, which will be very good for domestic consumption and very good for growth again. And the last slide on South Africa, we're sitting at the cheapest level. This is the ex-Resi, and I mean, I sometimes put in the Resi, and then people say, no, it's distorted by the Resi. So I've left the Resi out in this instance, but we're sitting at the lowest level we've seen, and we think that is quite exciting. I mean, we've seen a lot of work done in the past, showing that your future returns are very much reliant on what your starting valuations are. Low valuations are very good. So getting back to hulle weet nie wat ons weet nie. So in South Africa, we are able to find very well-managed businesses with appropriate governance, with appropriate remuneration policies which focus on beating cost of capital. We've got men and women who've been operating in the toughest of environments, that have dealt with riots, that have dealt with floods, strikes, COVID, and all through that they've been able to protect their margins and return cost of capital beating returns. And any marginal improvement in the South African economy is going to go straight to the bottom line. South Africa's been a breeding ground for entrepreneurs and business people, and like I said, I think we've found ourselves at a point where there's a very low base from which to emerge. So what we've done at Investec, we use Holt's, Credit Suisse's Holt system. What that does is look at cash flow return on invested capital, and that to us is much better than earnings because it's more accurate in terms of a measure of profitability. And I'm not sure if you can see, but that line, I don't know how this pointer works, but effectively that orange line at the top there is your real cost of capital, and those bars are your real, that's your cash flow return on invested capital. And what you can see, even though amidst the price here, while the returns have been declining over time, still significantly beating its cash flow return on invested capital, with that low base in place, we think can do particularly well from here. Another great company, Spur, also significantly beating its cost of capital. Reunert, now you can see there it went through a tough patch, and that would be because of the low investment in infrastructure in South Africa. That's starting to pick up now. They're benefiting tremendously from the spend in the renewable space, but also from their defense business because of geopolitical tensions. Pan-African Resources, so what you can see here is a level of cyclicality in these earnings, but at the end, this is a great, well-managed South African gold mine that pays a dividend and is probably class-leading in terms of its transition to producing its own renewable energy. And then Afrimat, a lot of you will also be familiar with. But really what I was trying, and Kaap Agri, also doing very nicely and improving all the time. But what I really wanted to highlight was the CEOs of these businesses, Sean Walsh from Carp Agri and Andries van Heerden from Afrimat, Val from Spur. These are all champions, great capital allocators, and are doing an amazing job in a very difficult environment. So, I mean, we can't carry on without talking about the risks. I mean, there's opportunities and there's risks. We've spoken about the elections, we've spoken about inflation and the geopolitics. Hopefully inflation is largely under control. The elections remain to be seen. But I think the most important thing when we talk about the risks is not the risks that you know about that cause problems for you with your investments. Generally, these risks are largely priced in. It's the risks that you're not forecasting. On the opportunity side, like I said, we've got potentially peak interest rates here. We've got SOEs that are improving. We've got a reducing cost base for companies where that diesel cost comes out of their margins. They have less stuff stuck at the ports. We've got energy transition and the commodity demand, and hopefully that benefits us as a commodity exporter. Long-term dollar outlook, a few of my colleagues have spoken about that for a while. The dollar's been extremely strong and not something we expect to persist. I mean, you're already starting to see some of the nations in the West starting to change some of their reserves from treasuries to gold because they're worried about sanctions if they misbehave, etc. And then lastly, one thing we haven't spoken much about this morning is the two-pot retirement system. And while it's not great to spend your savings, I think it will be very positive for domestic consumption in the SA market as people do access some of that retirement pot. So I was very lucky to hear Renee Naylor speak at a conference a couple of weeks ago, and she gave us an insight sort of behind the scenes, and she was talking about team selection and what they looked at. And there was this matrix of teamwork and talent, and they plotted all the players. And you could get away with a little bit less talent if you're a team player and vice versa. But she spoke about how Rassie had this one non-negotiable. And he said everyone in that team has to be a warrior. They need to commit to every tackle. They need to put their body on the line. And she shared this poem with us, which Rassie shared with the team about what it was a warrior was. And I'm not going to read the whole poem. I don't know if you can even see it because it's a little bit behind there. But I think the point of it is that last line. It's that very special something that stands a man apart. We all quickly recognize it. We simply call it heart. And I think when you look at the companies we're invested in, the CEOs of some of these companies, we recognize that attribute in a lot of these companies and their management teams. These guys are going out there every day, finding opportunity where there are government failures, creating employment, creating growth for the company, despite all of these tough conditions. And just to end off, this is a bristlecone pine. It's one of the longest surviving tree species in the world. It thrives in harsh conditions and tough soils and tough weather, much like those companies we invest in the Investec BCI Dynamic Equity Fund. Thank you very much.
Thanks, Barry. Thank you, gents. We've got a few minutes, so there's some questions that's come in, and I've got some questions as well. Peter, I want to start with you. Two of the questions that came in, the one says, is SA a value trap, or is SA incorporated a value trap? And then the second one might refer to your prediction for the rand, or really saying the rand will probably be at 25 rand against the dollar in 5 years' time or so. And then the follow-up question from the same person to that was, should we go offshore? Now, if I slightly rephrase those two questions, it would be, and that's something that I've been kind of thinking and worrying about recently, is where will the money come from to drive our, to unlock the value in our equity market? And maybe another point to make about that is, you said by your estimate the money flowing out under the Reg 28 increase of the limit to 45 is close to done. But I must say, when we look at the managers' asset allocation on a quarterly basis, what we've observed, and it is actually very interesting to put them next to each other, there's some managers at 45, some of them have drifted to 50, but then there's a few managers in the low 20s, and the average seems to be 35 to 37, if I look at that category. So there is the fear, I think, that there's a good, let's call it 10% that can still flow out should the rand strengthen a bit. People sit with their fingers on the trigger and they actually want to externalize even more. So coming back to these questions and my question, should we worry about where the money comes from that will unlock our equity valuations?
Yeah, certainly I think that's very relevant. And I like to hear the questions because it's the kind of questions, we're kind of at the everybody's given up stage. ABSA is at a 5 PE multiple and an 11% dividend yield. So you say, who's going to buy it? Well, I can go down to the micro level in our business. And as I was saying, we've had 5 billion rand put into our core income fund, which is earning 9.3%. When rates start to come down and that 9.3 goes to 7.3%, you start looking on a relative basis. We certainly, in the context of our business, will have private clients and the market as a whole going, that asset has become, without ABSA having moved yet, it's ridiculously priced relative to the other. So greed and fear will always drive markets. When people see something where they can make money and you get some momentum, you can have some movement in asset prices. But I think what you're talking about is a real long-term question, and where the money comes from in the long term, you will need South African growth. So over the short term, valuations with a bit of a trigger, we're sitting, the pessimism is intense because we're before elections, interest rates are so high, et cetera, and you've just finished about 2 years of that bleed out of South Africa. So I don't think that 37 will ever be at an average of 45. We're not on average going to be at maximum allocation. There'll always be some people with other factors. So I think that there's enough going around for there to be a reasonable kind of 12-month in SA markets. I think from the rand perspective, I love giving 3 and 5 year rand forecasts because nobody ever measures you on them. But I think realistically, it's interesting looking at it the other day. The rand has weakened by 6.9% a year for the last 3 calendar years. It's kind of random that it's exactly the same amount. But if you look over almost any 10 or 20 year period, you're sitting at about 4 to 5% rand weakening. So if you take, when I put that slide together, 1930, and you just compound that out at the 5%, you're going to get to around 24, 25. So that's a path that, unless you have a long and sustained commodity boom from China, I think that's the only thing that would prevent it. But I think the world is only so big, and China's built a lot of its infrastructure, and I think the kind of booms that you had in the past, you're not going to see repeated.
It's interesting the comments you make about the equity yields and the banks. Does it feel a bit like 2001 kind of scenario to you? I remember, there's only few lessons one learn, I suppose, but I remember my old boss at the time, Wayne McCurry, said, now's the time to bond your house and invest in SA equities. So could it be that we there now, if we look at the kind of yields that we can get from equity?
Yeah,
do you agree with that?
That's Sir, do you want to take that?
Yeah, no, I would agree. I think we're at a point in time. I think there's a further problem. We say where the money's going to come from, and I think that's been the PRC that has just gone now from about 10 to 15% in their offshore allocation. And given the size of their funds, I mean, that's another risk if they were to go from 15 to 20 or 25. I think the problem's far larger with the PRC than the balance of the funds in South Africa. But yeah, as we've seen in the market over the last number of years, many foreigners have pulled out. So all we need is, 1 or 2 new foreigners to think, well, South Africa's got a slightly more positive story. They back in. There isn't much liquidity. As you know, liquidity's dried up very much in the SA market. And I think what you've seen even in the last month is a couple of managers becoming positive on SA equities. And the next thing you know, Shoprite's up 10%, Clicks is up 10%, Sanlam's up 10%. It's very difficult to actually get these stocks in. So I think if something just comes even slightly more positive, we could see a big race to try and acquire these SA domestic equities. So that's what we think is going to happen.
It's a very interesting point you make about the PIC, and maybe people in the audience didn't necessarily know it. I, to my shame, must admit, I only learned it recently that the PIC is like a 10% global exposure. We all know pension funds can invest up to 45%, but one of my ex-colleagues works for the PIC, and I bumped into her socially and chatted, and she started talking about them increasing their global. And literally, it was less than a year ago that I learned they are at this very low level of global exposure. So I think your comment is very it speaks to my fear as well. I don't know to what degree they can move up, but that is certainly a factor to keep in mind. There's an interesting question that came in from Joanne, and it's something that happened in the last week or so that got under all our skins, and that's the BHP bid for Anglos, and then they saying they don't want the SA assets. So Joanne's question is, what does one make of it? Do you read anything more into it regarding the investability of South Africa, whether it's a trade or whether it's a long-term hold? Go for it, Barry.
Well, just an observation. I mean, a couple of years ago, most of you will remember BHP did split out of SA assets in South 32. So it makes complete sense that they wouldn't want to sort of contaminate the structure that they set up in place already. It would be very odd if they went back in again. So I don't think it's that unusual. I mean, I'm not saying that's not their reason, but I think it's very justifiable from BHP's perspective.
You like that?
I guess you could make the point also that one of the businesses they want to spin out is Amplats, which they currently don't have any PGM exposure in the portfolio, and perhaps they don't want it. But that point more broadly, you can look at SA-focused miners, and we used to look at this for the gold miners, for example. It's closed a bit now, but SA gold miners structurally traded at discounts to some of the global peers. I think there definitely is a higher risk, country risk, placed on South Africa in terms of multiples. This is both kind of resource and non-resource companies. I think with justified reasons. If you think about barriers to exit, they're much higher in a country like South Africa than they are elsewhere. So, if you think about the essence of a commodity price is balancing supply and demand. If demand falls, supply needs to be able to react to kind of offset that. And if there's a barrier to that, mining companies will naturally place a discount on kind of entering that jurisdiction.
Another question, which is from a macro perspective, we've talked a lot about the valuations, but it's a kind of a two-part question, and I don't know who of you are most kind of macro inclined, but anyone can put up their hands. And that is, should South Africa fear a Trump presidency, if it's likely that Trump might be president again? And coupled with that, is China a friend of South Africa or not? So the two big kind of geopolitical trade, I suppose, related aspects that could indirectly influence us. Is it something to fear? Is it a non-issue for us? Sai, do you want to go first? And then
I think it could potentially be an issue. I think Trump is obviously a lot stronger on his views and condemning a lot of what's happening in the world today. And South Africa has chosen to align itself with some very interesting partners. I mean, I've noticed even in Cape Town now we've got a couple of big, magnificent super yachts parked in the harbour. I looked them up, they're owned by Russians. Just wonder why they're here. Secondly, you can see we're currently holding a conference, I think, again, on supporting Hamas, etc. I think Trump's got a much more strong view against terrorism, etc. And South Africa, unfortunately, just seems to be on the wrong side of history when these events have happened. So it could be a risk, and we wouldn't want it to become a big issue. But there is a serious chance of that, I think.
And the health of China, Peter, maybe second part to you.
Yeah, so I think China's. We've all been waiting for a Chinese rebound over the course of the last 12 or 24 months. I think the mix of the Chinese economy is you've got property kind of dragging it down by 20-25% because they've overbuilt and developers going bankrupt, etc. And then above the line, you've got everything else actually growing quite nicely. And retail's, in fact, we had a conference call the other day with a Chinese expert kind of scratching our heads with the kind of retail growth numbers you see in China, why their retail companies don't do better. But they tend to just pass on the price and not make as much money or have the same sort of operating leverage as South African companies. But China's a supposed friend of SA, but I think they operate on a very self-centered basis where they will come in and buy assets cheaply and act for their own benefit. But ultimately, if you look at the macro, if China does seem to be bottoming and coming through, which is good for South Africa, demand for commodities from China, from South Africa, is one of our biggest drivers of our economy, our export imports, the currency, emerging markets, etc. So a healthy China is much more important to us than what happens with the US. I think the US is pivotal from a sentiment and other perspective. I think it's only about 3 or 4% of our exports, so we don't live or die by it. But what's been worrying is the South African government. I think Naledi Pandor actually said they need us more than we need them, which is a comment. It just seems imbecilic.
Thanks for that. Barry, another question I'll direct to you, given that you're fairly positive about SA. And the question, well, if I just rephrase it a bit, it basically says, if we get a friendly coalition government, how much can it strengthen the rand? Do you have any specific views on that?
You know, it's hard to make calls on the rand, but I mean, you generally do see, like Peter said, fear and greed on both sides, and things become a little bit self-fulfilling. So the lower the currency gets, or the stronger it gets, the better it gets, and interest rates are able to come down even faster. So, I mean, if we get into a positive cycle, I don't want to give a number, but I think you could see a material improvement here. I just very reluctant to give an actual number. So, but yeah, I think just like it overshoots it on the upside, it can overshoot on the downside as well, which would be quite exciting.
Our fair value is 15 Rand 20. I mean, mathematically.
Exactly, yeah.
So we don't think it'll get there. It's not a prediction, but it's, that's where you can certainly trend down. You must remember the average move in the currency from high to low in any 12-month period in the last 12 months is 2 Rand 50. So we always get absolutely bewildered when the rand strengthens by a rand or two. But that happens, every 18 months you have those kind of moves. So we're not out there forecasting 17, but certainly if you had a very good outcome, there's the potential for it to strengthen much more than what people expect.
I just wanted to say on the China question, like Sai said, the stimulus has been quite underwhelming so far, but we were talking last week about trying to find an initiative to remove the overhang of excess inventory of housing, or the residential housing. I mean, if they were to do something like that, it could make a material improvement. And then I think the other thing is we do think that commodity demand from energy transition and from developed world infrastructure renewal replacement is a big factor, which people underestimate.
Jatin, can we get your view on China? Because I know your global sister company has historically been fairly active and positive about Asia as an investment destination. What's the current thinking?
Yeah, look, Chinese assets have derated substantially. When we talk to foreign investors, anecdotally, the demand for Asia ex-China mandates now are much higher than they were before, which already talks to some of the sentiment around China. I think what we're worried about and have been worried about for a long time, our concerns have been primarily on the property sector. We've called it too early. We've been worried on iron ore for a very long time, just because of the level of overbuild. It finally seems as though the kind of chickens are coming home to roost. To my mind, longer term, there certainly is a bull case to be made for commodities outside of China. But if we look at, let's say, the next kind of 2 to 3 years, we can see the mine supply that's coming on. We know what the demand is. We can match those two, and we can say, well, actually, if China has a big wobble, there's going to be a problem here. Any renewables aren't going to fix the problem in 2 to 3 years. So there's kind of a medium-term versus long-term kind of view on commodity prices. But I think the other thing that kind of worries us about China, and it's very relevant for our NASPIS process exposure as an example, is there's this idiosyncratic geopolitical risk that we can't control for. I alluded to it in my presentation, but we would have been making very similar arguments about Russian assets before Russia invaded Ukraine. And what happened is, well, you woke up and overnight your assets were down 90%. So there's this. For example, we think 10 cents probably cheap here, and we're quite constructive on NASPIS process, but we will purposefully limit the position size because of that idiosyncratic risk that actually we can't control for. And if we define risk as the kind of permanently losing our clients' capital, there's a good chance you could do that, and you can't control for it. So position sizing is important.
I do want to mention that quote again. It was hidden below the presenter, so you couldn't see it. And I just want to mention it because it is so good and funny. It's not very PC, but the Bobby Axelrod quote that said, "China is like a pig on LSD. You never know what direction it's going to run." I mean, it's quite harsh, but I think it speaks to, we are exposed in South Africa to what happens in China, and it's very relevant to us. We've got a few seconds. I forgot to ask for questions in the audience. I apologize for that. There is a roaming mic. I can maybe take 1 or 2 questions. Is there a question? There's one there. Rocker, sorry, man. Apologies for not turning to the audience earlier.
For Peter particularly, we've heard a lot about South African CEO, warrior CEOs, but for how much longer can they go on squeezing the South African orange before it splits?
That was for you.
For me?
Yeah.
Yeah, I mean, I think it's kind of company specific. I think the worrying thing is the actual fixed investment spent by South African companies has been quite low over the course of the last few years. So you're not seeing that growth come through. You look at a company like AVI, its earnings have basically been flat for years, a very, very well-run company, but they've chosen to pay the money out as a dividend as opposed to reinvest. So I think the banks have still got some places to squeeze. I think they've still got big bases, and as interest rates come down and credit losses come down, it's more of a cyclical than a squeeze factor. But I think South African companies are well run. I'd rather invest in a well-run company that hasn't got too much more to squeeze than a fat company that's not making its margins. Because the well-run company typically has got good capital allocation and will invest that money that they make wisely. But I don't think we at the end of the lemon squeezing exercise where now everything is so well run that there's no upside. I think you mustn't forget we're in a cycle. And for a lot of those things, we're at the bottom of a cycle where there's a bit of an upturn coming, we think.
Thanks, Peter. I think I'm going to conclude there. Sorry. Yeah, let's go for one. Sorry, Eugene. We'll take one and then we'll conclude. Thanks.
Hello.
Yes.
My question is to Sai. So you've kind of maxed out your offshore exposure on many of your funds, right? But now with South Africa kind of not being all doom and gloom, do you see that allocation switching a bit, maybe increasing on South African exposure or keeping it where it is currently?
So our balance fund is actually at around 36% currently. That's kind of our view. We made a commitment on our general equity fund. We're just not going to bring money back. We got to the 45%. We're not going to trade on the rand components and try to swing on currency. But obviously, the part that is invested in South Africa is a lot more domestically focused than it's been for a while. And you've seen from our SA fund and our hedge funds, we have been divesting from a lot of rand hedges and buying a lot of SA domestic equity.
Thank you. We're over time, so I'm going to conclude, but there'll be lots of more opportunity to ask questions in Q&As in the next sessions. Thank you very much to my panel. I hope next year we're sitting here and we're celebrating the double-digit returns that some of you expect. It'll be very nice for our portfolios. But yeah, thanks for your insights and thank you, Eugene.
Thank you.
Fantastic. Well, if you buy into the SA equity argument, you can always sell your Bitcoin and invest it in SA equity, right? To our panelists, Pierre, thank you very much for being here today. We are going to break for tea now until 10:35, but if I can ask if you can maybe come back in at 10:30. We're going to start streaming live at 10:35. It's a bit of a long stretch to lunch, hence the tea break now. So make sure you get ample coffee outside, very nice coffee, and I'll see you back here at 10:30, latest 10:35. Thank you. Right, I think we're there. Thank you all for coming back in promptly, and our online audience as well. Thank you very much for joining us again. Our next session on SA fixed income, much talked about asset class, but I'm not going to steal the thunder here. To moderate the session, the head of In8 Invest, Lee Kohler. Lee, thank you so much for being here today. It's always a great pleasure to have you. And his panel, joining him on stage this morning, Conrad Wood from Aliwani Capital, Maitse Mutsuani from Argon Asset Management, Philip Bradford from Portfolio Metrics, and Arna Lawrence from Sasfin Asset Management. Gentlemen, thank you so much for being here this morning. Lee, I'll hand over to you. Thank you.
Great. So it's not always that you get to do a fixed income panel. It's the most exciting asset class to talk about. So we're quite excited here to chat about what has been a very interesting market. We know that fixed income is especially impacted by things like elevated interest rates that we've seen globally, inflation, etc. So with us, we've got probably some of the best fixed income minds to discuss the topic. So each of the gents will have 10 minutes. They'll speak to their topic. I've actually pre-asked them some questions, and you'll see the answers on stage. So you'll see it there. They can't back away from their answers. They've answered it without knowing what the others answered, and they're going to defend their position. So that's what's going to happen after their session. So to start off, we've got Conrad. Yeah, you up?
Thanks, Lee. Good morning, everyone. Thanks to BCI and thanks to you, the clients, for giving us this time this morning. So, at the risk of dampening Lee's excitement about this panel, and just after that equity bull market show that we've just had, I'm going to tackle a somewhat more somber topic, which is could or would South Africa default on its debt? I don't particularly have a high conviction view on this myself, so it's just something that I hear asked very often, and I hear answers given to it very often, and those answers are often bipolar. It would be the typical on a Saturday evening braai after a few glasses of wine. Of course we're going to default on our debt. Just look around you, look at how they conduct themselves, look at economic growth, look at policies. And then the other side of that spectrum is, well, they'll never default on the debt because you can't default on your own debt, right? You just print money. So the answers are obviously bipolar, and in typical economist fashion, I'll go and land somewhere in between those two. But I just thought it's a healthy perspective often to just take a step back. We're all invested in these income funds. We all have a lot of money vested in government bonds and government yields. So a sober perspective is sometimes quite useful. So if we look at the current backdrop, there have been 42 sovereign bond defaults over roughly the last 20 years. So this is not an uncommon thing. It's not like one every 50 years or one every 100 years. There have been 42 sovereign bond defaults over the last 20 years. And half of those have come since 2010. So if you just use a very rough rule of thumb, we're having about 10 a decade. That's the run rate of sovereign bond defaults. And for those of you who don't know what a sovereign bond default is, that's when you own a government bond and they don't pay you back your interest or your money that they owe you on maturity at high level. The current market backdrop is interesting, and the graph on the bottom left just shows you a spike in the number of sovereigns that Moody's classifies as vulnerable or likely to default based on their rating scales. And you can just see how that's gone up fairly significantly since the COVID pandemic, and it now sits at about 10. So according to Moody's, there are 10 sovereigns in the world right now that are on the verge of or likely to get into some debt default stress. On the right-hand side, what's interesting is the same work that said when sovereign defaults happen, what are the circumstances that are largely in place at the time these sovereign defaults happen? And you can see the big bar is that in over 80% of sovereign defaults, there had been a Fed tightening cycle in the run-up to that. We've just had one. In close to 80%, those sovereigns had no form of fiscal rule or fiscal anchor in place that governed how they managed their budgets, their debt, and their borrowing. And then lastly, and interestingly, is high debt burden was not as prevalent as those first two in terms of driving sovereign defaults, with only just over 60% of sovereigns that went into default having what we would classify as a high debt burden. So why do sovereigns default? Why do we get into a situation where sovereigns are unable to pay back interest or capital on their debt? And there's largely four categories of default or reasons for default, according to, again, to Moody's and some other work. Chronic economic stagnation, institutional and political factors, a high debt burden, and a banking crisis. And I would argue that if we look at those in a South African context, we're going to zoom into the bottom one, the bottom third, or at least that's the one that I think gets people talking the most at the moment, and that is high debt burden in South Africa. And could that result in South Africa defaulting on its debt? I mean, the others are in the background, I guess, but I don't see them as particularly front and center in terms of risks for the South African sovereign. So when we look at high debt burden or evaluating debt sustainability, it's interesting that default risk rises as interest burdens rise. So the more debt you've got, the more likely you are to not be able to pay that money back. But a high debt burden is neither a necessary or a sufficient condition for default. So there have been sovereigns that have defaulted with much lower debt burdens than what we have at the moment. And there have been sovereigns that haven't defaulted with much higher debt burdens than we have at the moment. So you're not going to get away without a nice formula here, because this topic is an emotive one that people expressed a lot of views on. Reminds me of the COVID pandemic. It's a lot of keyboard warriors and Twitter warriors that express views on defaults. But if you actually look at the math and the debt sustainability formula, you can see that the change in your debt burden, your quantum of debt, is largely dependent on what your primary budget balance is. So that's your revenue minus your expenditure, excluding any money that you pay to service your debt burden. And then it's the very important part of this equation that I'm going to zoom in this morning, which is the change in your debt burden is largely dependent on this factor here, which is R minus G. And that is the rate that you pay on your borrowings, the cost that you pay on borrowing money versus the rate your economy is growing at. Now, just keep that in your mind for the next slide. The cost of borrowing or the rate you pay on your debt versus how fast your economy is growing. Other factors that are important are foreign currency exposure, and there South Africa has very little foreign currency debt, so we are not particularly vulnerable to a massive rand weakening, making our dollar debt unserviceable, because it's not a big portion of our debt. One that we are watching closely and that is interesting is contingent liability. So how much other debt on the peripheral to the sovereign do we have that we might need to make good on? And there our beloved SOEs come to the fore in terms of the more we need to pick up their debt, or the more the sovereign needs to pay for their debt, the more encumbered the sovereign becomes. But just zooming in on that debt sustainability formula, because that's the important part that we need to understand. And South Africa is down here on the bottom in this fiscal vulnerability scorecard that I like to look at by UBS. And you can see that we have 76% debt to GDP burden. So relative to other emerging markets, that is quite high, but it's not completely out of kilter. There are other emerging economies with roughly similar debt burdens. The alarming thing is just how quickly it has changed. It's gone up by 30% in the last decade, whereas the growth rates in debt at other EMs has been much, much slower. But if we come across here to that part of that formula I referred to, the G minus R, the cost of borrowing versus your economic growth, South Africa is sitting with a negative number there, and you can see that this is quite exceptional relative to all other EMs. We pay more on our cost of debt, or our interest rate that we borrow money at, than what the economy is growing at. Now apply that to your own personal finance situation. Money coming in via your salary or your income versus money going out on your bond or your mortgage or any other debt that you're having, and the interest rate that you're paying on that. And it doesn't take a rocket science to determine that that's not sustainable on an ongoing basis. So why is that R, that cost of debt, so high for South Africa? So this is our bond yield curve. These are the government bonds that they issue in order to borrow money into the deficit. And you can see that the longer you go out, the higher the interest rate gets. Now, one of the very powerful things about our bond market that was previously put out as a positive factor was the fact that we could borrow so long. We have a very long debt maturity profile in South Africa. But currently now with the steep yield curve and the fact that those long-dated bonds are at 13% yield, borrowing long is just making R higher and higher and higher, and G is staying low, our growth rate. So we are borrowing at nominal rates of 12 or 13% in this area of the yield curve, and the economy is growing at nominal growth rates of 5 or 6%. So more than double the cost of debt versus economic growth, and that is absolutely not sustainable. So would South Africa then default? So the answer to could they absolutely could. I've shown you that lots of EMs do, and the metrics are going in the wrong direction. Would they? And the question, though, the answer that I gave in the beginning is, well, people say that they'll just print money or they'll just raise taxes. So they won't outright default by not paying you your money back. They'll use either of those two. Now, those are not without risk and without complications. If you just print money, you have risk of an inflation crisis, right, which is a de facto default. If your money supply growth or the rate of money you print is faster than the economy is growing at, you're going to have runaway inflation or hyperinflation, which to bondholders is the same as a default. You get paid your money back, but it's worth much less than what it was. Raise taxes. They can raise taxes, but it wouldn't be insignificant. It would be a large amount, and we know that this economy is largely overtaxed. And any more taxes added to the equation actually has a downward effect on GDP growth. So just to end off, what needs to be done then to avoid default? Well, we've got to fix that R minus G, and we've got to fix it urgently. And part of that is to shorten the maturity debt profile, so not to borrow as long. We do need to keep on keeping hard currency debt low as a percentage of total debt. We need to run a balanced primary deficit and get a strong fiscal rule in place. And if we don't do that, the signs to watch out for, the warning signs that they are going to default on debt or struggle to keep up with debt payments are default by stealth, so the tolerating higher inflation, increasing money supply or currency debasement in order to pay back that debt. Looking at prescribed assets, that's a whole presentation in itself. So if they can't get funders of their debt, they can legislate that you fund it. And then exploring restructurings and exchanges of bonds. So just to conclude then, I mean, could South Africa default? Yes, if we do nothing about these current metrics that we have in place. Would they? I think unlikely, and they'll do some of these things that I've alluded to in the run-up to rather outright defaulting. But we've got a way out, and we've got a chance if we just implement some of these structural reforms. So something we watch closely as bond investors. Thanks.
Sorry, which one is the pointer?
That's the pointer.
Start, Lee? Yeah, ladies and gentlemen, thank you for the opportunity once again to talk to you. So today I'll be talking about a few things, mainly surrounding global macro factors that impact local fixed income. So naturally we'll start talking about US growth, progress our conversation to factors that has been holding it up. As we go along the presentation, we'll also look at fiscal policy, as well as monetary policy, and look at the picture of the monetary policy configuration at point. We can sort of like form views based on these sets of economic pictures that we will discuss in a few. So I have a few slides in the business. I'll skip these. I believe these will be made available to you afterwards. I'm not going to waste time on these and jump straight into the meat of this presentation today. So we will be talking about global macro factors driving local fixed income. And the first starting point, I'll look at US growth economic projections. What we're looking at here is, in the white line, is 2023 evolution of how economists have been predicting growth in the US. You can see steady inclines from around mid-2023, looking into the following year, while growth is still positive, it is starting to come off a little bit. I wouldn't say worrying levels, slightly below 2%. It's still hovering around trend. So pretty resilient growth out of the US, even after so many fears for recessions. I mean, the number of indicators that point in that direction, and it is justified to keep an eye on that. So let's look at what policymakers are predicting for US growth in the next couple of years. This is an excerpt from the latest iteration of the Fed's quarterly economic projections. In those highlighted cells at the top in the first column, you will see that growth is still hovering around 2%, so around trend, and highly revised, particularly for that 2024 number, from 1.4 to 2.1. So these people are not seeing growth. Where is it coming from? And we would like to dissect that in the next couple of slides. Simple answer, we look at the hot data, top panel, not necessarily legible, but I'll tell you, this is real GDP growth. We're still compounding at about Q-on-Q seasonal adjusted rate at 3.4%, still highly, highly above trend. And why is it so resilient? There's a comparison of consumer spending forecasts of the US relative to its G10 peers, and the picture is quite clear. That black line is well ahead of the rest of the guys. The red line is the next closest, which is, I would imagine, Eurozone. Half of the growth, 1% versus nearly 2%. So resilient economy, resilient consumer, and in an economy that is structured that way, 2/3 of it driven by consumer spending, it will be difficult to get a recession in these conditions. Looking at economic surprises, again, this also gives us more insight into really what's driving this US economy. And you will notice the personal/household sector has been the biggest contributor to upside economic surprises. I mean, you look at the entire series, the surprises have been less positive over the past, say, six months to a year, albeit still positive slightly. And the big reason has been the US consumer. Moving along to monetary policy expectations, what I have here is implied overnight rate curve from current throughout to the first month of next year. Initially, effectively what this shows is the market is currently pricing in about roughly one cut of 25 basis points. But this was not always the picture. Coming into the year, comparatively speaking, that white line shows that the market expected far more cuts. In fact, you look at the one-year area, that has moved about 100 basis points in the past couple of months, effectively shaving out 425 basis points worth of cuts. So very hawkish signals, and we'll talk about why this is the case. I suspect a lot of you already know we have been seeing some setbacks on the inflationary side. Looking at what the monetary policy makers are projecting, these are the Fed dot plots. Effectively, it shows you where the different members of the voting committee see the policy rate in the future. You look at the 2025 area, the gray dots represent where they saw the median policy rate 3 months ago in December, and the yellow dots is the most recent revised dots in the latest summary of economic projections. As you can see, there's a slight upward drift in expectations. So policymakers are acknowledging there are some signs of strength in the economy, which justifies slowing down this pace of expectations of expected cuts. At Argonne, we also focus on liquidity. In this instance, I'm looking at Fed liquidity. In this chart, I'll take some time and explain it. It's an effectively deconstructed factors that feed into our overall Fed liquidity indicator. In this instance, it's quite simply speaking, how we define liquidity, specifically Fed liquidity, is year-on-year change in Fed balance sheet, less year-on-year change in the Treasury General Account, which is effectively the US Treasury's checking account at the Fed, as well as the reverse repo, year-on-year change on the reverse repo. And I'll show you a couple of factors or levers that Janet Yellen has pulled over the past couple of months, I'll say a year or so, to offset the negative impact on liquidity that has been experienced through balance sheet contraction. You will notice, first of all, you saw a drawdown in TGA, Treasury General Account, heading into the fiscal ceiling, budget ceiling. And then after that, obviously, you can't really draw on nothing that's there. You need to find a way to access funds that are sitting at the reserve. How do you do that? Over the next slide, I'll show how she targeted the T-bill market to achieve exactly that. The white line there shows the size of deposits that money market funds had left money in the reverse repo account at the Fed. It's at around $2.5 trillion. So it is a significant buffer, and I'll explain why. On the next slide, you will see the US Treasury net marketable borrowing composition. Effectively, you're running a government, you have spending commitments, you obviously have to borrow to fund those, but there are certain pools or signaling effect that you can send to the market by the compositions of those borrowings. What we've seen in the second half of really 2023, you started seeing a big increase in these blue bars, and these blue bars represent issuance of T-bills relative to the red bars, which are coupon bonds. Effectively, what this does, it increases supply of T-bills in the market, pushing up T-bill rates relative to reverse repo. In effect, what it does, it sucks out money that's sitting at the Fed, in a way alleviating liquidity constraints that might have been encountered had we just carried on with balance sheet contraction without these other additional measures. So we move on to fiscal policy. An important thing to highlight here is the fact that this is one of the key reasons a lot of us had the growth outlook totally wrong last year. We've seen significant pro-cyclical fiscal spending. It started with Trump's presidency with the tax cuts, and it looks like Biden has continued in that direction. You look at this chart, the shaded areas in red, these are recessions. And you will notice that budget deficits typically go into negative territory in a counter-cyclical fashion. So the world economy is experiencing problems. As a government, you need to engage in spending to sort of alleviate that pressure. But since 2017-ish, around Trump's era, we started seeing this budget balance as a percentage of GDP start really going to deficit territory. And the economy was doing pretty well at that time. We saw some of that now, post-pandemic recovery during Biden's administration. So we're heading into an election with Biden and Trump as the leading candidates, and we know the big spenders. The outlook for this, I would imagine that we are in a world where fiscal deficits in the US might be structurally negative. Sort of to say, think about the US and emerging market. It's a big statement to say. This more on fiscal impulse, I'll skip on that, I'll touch on that. I want to focus more on inflation given the time limitations. And really what I want to point out in these in this busy slides, don't focus too much on the numbers, but focus on the trends of these bars. What I'm showing here is 3-month seasonally adjusted annualized rate of a number of CPI measures, core CPI, super core CPI, and we're starting to see these bars trend into the right direction. Unless we start seeing some serious moderation in CPI over the next couple of months, certainly some negative month-on-month prints would help this picture. But what we see right now is a situation that the disinflationary process is experiencing stasis. We can't ignore this. But where are we? I'm looking at a number of inflation non-costs. We've peaked around just under double digits. We are now sort of like leveling off around the 3% mark. I mean, I don't know, the jury is still out. Does this look to you a trend reversal or just a counter-trend move? We don't know, we'll have to see. One of the charts that have informed my sanguine view on inflation outlook over the past couple of months was this deconstruction of core PCE into its cyclical and acyclical components. You can think of cyclical as demand-driven, acyclical as supply side. You will see the first time that the Fed started hiking in 2021 coincided when core PCE peaked. They had very little to do with that. However, you can see in the blue bars, they started to peak around roughly a month, 18 months after the first delivered its first hike. And the trend continues to decline. And finally, the point that I want to make, the stasis that we're seeing in inflation suggests that it's coming more from the supply side. You can imagine the conflicts in the Middle East playing a role in that. So finally, just to conclude and see where we are, inflation is showing some worrying signs, but let's do a pulse check. I have real Fed fund policy rate, so effectively Fed fund minus CPI, and that spread is still positive, very healthy, currently hovering about 1 standard deviation from relative to long-term mean. So, guys, inflation is going up, but really monetary policy configuration is right for this kind of regime. I suspect the talks that we started hearing about rate hikes being on offing, those are a bit premature in my opinion. And with that, I would like to conclude my presentation.
Thanks. I'm going to have to move quickly. Eugene's bigger than me. He's going to come take me out. I'm addressing the topic here essentially that is SA fixed income likely to produce equity-like returns with less risk? And if I don't get to my end slides, the end of the story is actually yes. Funny enough, in a decent return environment, our current yield on dynamic income portfolio at the moment is at the end of March was 12.3% gross yield, which is inflation plus 7, which is better than the SA stock market did over the last 130 years. So they priced to do very, very well, but importantly, in a bad environment, I think we're positioned to do really, really well, even if the positive scenario doesn't play out. So first of all, I'm getting a lot of questions all the time from investors. Most of our investors are professional investors, multi-managers, DFMs and the likes who use us in an asset allocation context. But one of the questions I've been getting a lot from advisors is, should I buy a fixed life annuity for my clients at these high levels? Now, for once, we've got the fixed rates. The last time interest rates were at a high level in 2008 going to 2009, cash was 12, bond yields were only around 7 or 8. We've now got a situation where cash is 8 and bond yields were nearly 13 a couple of weeks ago. So, but actually, that question is a very similar question to all of us on the stage here face every day. Should I buy fixed rate bonds or should I buy floating rate bonds? In other words, should I buy something that's fixing interest rates or should I go for a floating rate instrument? Now, in South Africa, the government bonds are the fixed rate instruments predominantly. Very little of the corporate debt and the money market instruments type that we'd buy would be long-dated fixed rate. Those are the most volatile, but ironically, the least risky from a credit perspective. The corporate bonds carry the credit risk, but because they're predominantly floating rate bonds, they move up and down with interest rates. And then there's money market. So actually, if you think about it, what a life company does is if you're going to buy a fixed rate annuity, they're actually going to go and buy these government bonds. It's one of the major reasons that long-dated government bonds and inflation linkers trade at lower yields than some of the shorter-dated ones. But I'll cover that again a little bit later. The first question, though, that on everyone's minds, obviously, is interest rate cuts. Is that going to happen? Well, the one thing just to point out to you, and if you look at interest rates over the last 20-odd years now, 20 and a bit years, the forward rates, whenever they say, what's the market expecting? The market is almost always wrong. Those little white lines that came on there, and that's the current lines, those are the forward rates that the interest rate markets are expecting. What you'll notice is that they're almost never on the blue line. The market is always over-expecting where rates are going to be before rate cuts come, and they're under-expecting where rates are going to be when they go up. And if we just zoom in on that for a shorter period of time, just from the current period back from 2017 onwards, you can see that's that same sort of line. So right now, the situation where we are, the market is factoring in sort of flat rates a year on out. But actually, normally what happens is when rate cuts start happening, then those rates only start catching up. So don't rely on the Fed or the market to tell you where interest rates are going to go. They're almost always wrong, and particularly the Fed. The Fed is the worst bunch to ask where interest rates are going to go. But what we know from history, though, is you need to fix your interest rates before the rate cuts actually happen. Historically, if you fixed your interest rates 12 months, 6 months, 3 months, 1 month, before rate cuts, and in other words, you've bought fixed rate bonds, you've tended to do about 1.5% a month. Not every month, not consistently, but that's the whole point of it. You're fixing interest rates. The markets only start factoring interest rates after they happen, and by the time the rate cuts start happening, it's too late. You can't position yourself, say, oh, I'll wait for rate cuts to happen, then I'll go fix my interest rates. The good news is, by the way, is that the South African bond market hasn't factored in rate cuts yet. What we're showing on this slide here is if you go back to 2000, I touched on it a moment ago, when cash was 12, where you see where that red line is over there, bond yields were only 7 to 8%. We've now got a situation where bond yields are over 12%, some of the longer dated closer to 13, and cash is only 8. So bonds haven't yet factored in a rate cut, so you're not too late. The other thing to understand as well is that bonds are giving us, to take that extra duration, that extra interest rate volatility that you're going to get, you're getting the best bang for buck we've had over the last sort of 10 years or so, and pretty much throughout history. The last time we had the similar kind of bang for buck was literally a year ago sitting in this room. I remember thinking when in the middle of the Eskom crisis and the Lady Russia Gate and everything going on, that's what we're getting. So we're getting nearly 2% extra for every year of duration that you take. So bang for buck wise, bonds are giving you more risk, more return for the extra little bit of volatility that you're taking. The other thing as well is that credit, and the best way to look at how does credit done over time, look at income funds. What you'll see here is that income funds tend to lag the performance of cash and on the way up because interest rates go up quickly, and then you have a reset of interest rates by about 3 months. And on the way down, they will follow interest rates down. So we know that the income instruments, the floating rate, corporate credit, or money market instruments will start underperforming as interest rates come down. It's not rocket science. As interest rates move down, so do the returns on income fund type assets. So, but that's all very well. That's in a scenario where interest rates are going down. What happens if interest rates go the other way? What happens if we're wrong? What happens if the whole world, like we've been for the last year, by the way, this time last year, everyone thought rates were going to get cut? Well, the good news is we've been living with exactly that for the last 20 years. What I'm showing here is the rand and the bond yields over here over the last period. What you'll see back in 2012, that you had the rand around the rand around 8, and bond yields around 8 at the same time as well. So bond yields have gone from 8 to 12, and the rand has gone from 8 to 19. And ironically, that should obviously have been a terrible time for bonds. And we started this portfolio back in 2015 where bond yields were around 8, 8.5, and the rand was under 12. And since then, we've had Nenegate, state capture, COVID crash, and then all of the mess we've had since the Ukraine invasion, the inflation blowout. And surely bonds must have done very badly. The irony is they've actually done quite well. And this is since 2001. I started getting involved in the bond market, particularly from a trading perspective in 2002 and a bit before that. This is US Treasuries, including the rand appreciation, which have gone up about 550% over that period. SA bonds, including the rand appreciation, has beaten US Treasuries, the equivalent bond market in the US, by 110% over that period. Now, how is that possible? Yields were 4, 5, 6% in 2000 in that 2000 period, and they're now 13. Surely, if you've fixed your interest rates at that low levels, you would have done badly. Also, what's happened is you've done it at a much lower volatility. So SA bonds have given you, because of the currency volatility, about a third of the volatility. If we look at that same performance since we started managing the strategy in July 2015, global bonds have given, or US Treasuries have given you just over 40% return, 46% return. SA bonds have given you about 40% more than that. And then our portfolio has actually given you quite an extra 20% onto that as well, but again, with much less volatility. Now, how is that possible? Well, the simple answer is that once bonds have sold off, if you've locked in rates at 8% and yields go to 12%, all the interest that you receive, you're reinvesting at higher interest rates. So it's one of the powerful things for us. If I'm looking at comparing an income fund like we're managing here to a fixed life annuity, if I want to lock in my mom at a life annuity for the next 20, 30 years, where if interest rates go up, I'm actually able to lock in at consistently higher yields, and it actually allows you to outperform over time. And we've seen this here. This is showing since we started running the strategy, that's what SA bonds have done, 87%. The SA equity market, in terms of capped SWIX here, has done 50%. Ironically, the same as inflation-linked bonds and inflation. Property's done really badly, as we know. The fixed income, multi-asset income sector's done 82%, and our portfolio's done 117%. So it's about 35% ahead of the peers and about 30% ahead of the bond market, because we've been able to reinvest the coupons at higher level. As we get the distributions coming through, we reinvest it at higher levels. And the point I made, by the way, is that inflation-linked bonds have underperformed inflation over that period. That's a longer discussion for another period as I run out of time. But one of the reasons we always underweight inflation-linked bonds is we find that they're structurally overvalued versus the fixed-rate bonds. So what's going to do better in the future? Fixed-rate bonds, floating-rate bonds, or cash? Well, here's two scenarios. The one scenario is from today. Interest rates go up today, and bond yields sell off by 100 basis points. Everything sells off by 100. The second scenario is bond yields come down by 100 basis points and interest rates come down by 100 basis points. Over 1 year, you're going to underperform, and this is showing one of the longest dated single government bonds, and then showing a Standard Bank bond, and then showing cash. What you'll see, there's quite a wide range of returns in the short term. And in the short term, you'll do really, really well in the fixed rate bond, but you'll still do a positive return if you buy that long-dated government bond over 12 months. Over 3 years, the gap narrows quite a bit. And you'll see, even if you're wrong, even if interest rates go up, you're pretty much the same in a fixed rate bond or a corporate bond, but you're still better than cash. And then over 5 years, you'll see now that actually, even if we're wrong, even if interest rates go up from here and stay high for the next 5 years, we think we'll do better in a fixed rate bond than we will in a variable rate bond. Now, bear in mind, we're holding about 35 to 40% still in variable rate instruments in the portfolio. So we haven't bet the farm on fixed rate bonds, but we still think fixed rate bonds are likely, even in a bad scenario, to give us a better return. But in a scenario where interest rates come down even 1% from here, we think we're going to do 30% more in bonds and probably 40% more ahead of cash over the next 5 years, which is very, very important for longer term investors. From a fund level, our net yield at the moment is about 11.8%. That means if we have 100 basis points sell-off from here in bonds and interest rates go up, we're going to do about 9% over 12 months. If we have a positive outcome of interest rates, we'll probably do about 15% over 12 months. And those are scenarios that investors can work with because they're still very good returns. So really, just to wrap it up, the fund is at the end of March, it was the highest the yield of the fund's ever been, that including Nenegate, COVID, etc. Inflation plus 7 is a proper return. What it means is that if you're wrong, you're still going to get with a yield like that, you're still going to have a decent return. investors need to look at government bonds and fixed rate bonds and give them the credit that they are less risky from a credit perspective than floating rate credit. We all know there's been some default type incidents in South Africa recently as well. That was in assets that didn't move around a lot until they did. You need, as an investor, you need to start fixing your rates way ahead of rate cuts actually happening. And really, the way we've positioned the portfolio at the moment, Dynamic Income is positioned to give us a very decent return, even if rates go up from here. But if rates start coming down, we've managed to lock in a good part of that portfolio, and we'll set up to give decent double-digit returns from here on out. So just to wrap it up, I was given this as some advice before I got married, was that sunshine all the time makes a desert. If you don't have any volatility, you don't have any love. So really, at the end of the day, you need to start embracing a little bit of volatility. Take some of those fixed rate instruments in the portfolio. They are actually less risky from a credit perspective, and they will give you a much better return. So you need to start bringing that into the portfolio. Thanks very much.
Good morning, ladies and gentlemen. I have probably a very similar tack to what Phil has just covered about the equity side of things. And we know the heat is out there at the market, in particular on the equity space. And so we know the old saying is that if you can't stand the heat, then sort of get out of the kitchen. But I think I've changed it to then you should be considering investing in bonds. And then the sub-question here is, can we actually use fixed income to actually grow and protect wealth? So traditionally, we've seen fixed income as being the defensive asset, and equities have been the growth asset. And so the question we're sort of answering almost in a similar sort of sense here is that the returns or the prospective returns in the fixed income space are at such prospective levels that they are beginning to overshadow what you're looking at in the equity space, in particular in the South African sense. But I'm going to take a step back, and the question would be, well, how do you grow wealth? Which is really sort of your roles in terms of helping clients. And the answer really is, well, you invest in growth assets, right? Which is, the equity market. And if you look at, the S&P 500 from 1994, just to illustrate, again, a very particular period. And then, of course, when you had the tech bubble bursting, you had the defensive assets, which was the Treasury bond index, just chugging along. And at the time when equity markets started suffering, then you could actually get that defensive asset playing its role to protect wealth, basically. So if you are able to use those in a meaningful manner, it makes a lot of sense. If you then look over longer periods of time, so now we're going from 1994, it's a 20-year period up till 2014. Again, you've got the tech bubble bursting, you had the global financial crisis, and through both of those, even though it was a systemic crisis in the case of the US, where even the validity of the banking industry was at one point being questioned, you still had this defensive asset delivering in terms of its role. And then if I go even further, till today, so now we've included not just the tech bubble bursting, we've got the global financial crisis, we've got COVID, and then finally we have this period in 2022, which was really sort of, if you want to put it, it was the post-COVID inflation shock, in a sense, and then that dramatic rise in interest rates. And then you look at, well, that was the one period of time when the defensive asset did not work. And I suppose the question then would be, it worked through all of these other periods, even through systemic crises. So what changed this time around in terms of making or not being able to deliver in terms of its defensive nature? So if you look at those periods, so I've highlighted those crisis periods, so July 2000, September 2007, and then December 2021. And these are the periods in which the equity market basically didn't deliver any growth returns, if you want to put it like that. 50%, 57, minus 27. And then you look at the bond returns, again, the only period that it didn't work in this more latter period, down 16%. And the answer as to why is because the starting yield actually counts. So when you look at the beginning of these periods, so July 2000, the 10-year bond yield in the case of the US was at 6%. At the end of that period, it was down to 3.75%. And you know that when bond yields fall, you make capital gains, and hence you sort of see these returns. The key thing here is that if you think about the starting yield today, is 4.66%. So again, we've got a more normalized starting point for the bond space. But again, if you think about why it didn't work in that more latter period, it's because bond yields were at essentially close to their lowest point in the case of the US. So, and then you see the end yield, 3.95%. And again, that was the inflation shock that drove bond returns. Of course, when we talk about starting points, it also is valid for equity markets as well. So this is an indicator which is called the Warren Buffett indicator because he was quoted as looking at this. And essentially what you really do is you take essentially the stock market capitalization and you divide it by the size of the economy, essentially the GDP. And you can see that where we have been over the last number of years is that given that stock markets have done so well, is you're sitting at very elevated levels as far as the stock market is concerned relative to the size of the economy. So again, there has to be some sort of correlation here. And through time, you should see some sort of normalization. So again, from a US perspective, certainly there is an argument to be made that the starting point for equities in the case of the US is perhaps fairly high, whereas in the bond space, actually, it's now sort of almost normalized as well. If you think about 2024, I think one of the earlier presentations today alluded to this issue of all of these risks that are abounding in a global context. And essentially, we look at this from almost a macro thematic perspective. Global interest rates at a peak. The question is, when does the descent begin, or doesn't it? You can argue this issue of the fact that the economy is so strong in the US, there's no need for the Fed to cut. That's one argument. Another one could be made, well, that it's just that interest rates are going to be cut a lot slower than what is generally expected. You have got some inflation pressures emerging, hence this pullback as far as expectations are concerned. And then you've got a lot of elections coming up. We focused on the South African one. And the point that you get with this is that not whether it's a good outcome or a bad outcome. It's just that it introduces uncertainty around policy, around fiscal policy, around the way that they would apply, some of that expenditure, et cetera, how they're going to manage debt, et cetera. So there's a potential for policy dislocations, which we just don't know. And hence, there needs to be an additional risk premium built into that. And then lastly, I think we're all aware of the fact that there are these geopolitical flashpoints, and they have the potential, every single one of them, has the potential to disrupt all of our forecasts. And so if you add that all together, your high initial starting cost of capital, added to that your valuations on the equity space, this uncertainty around monetary policy and fiscal policy, you've probably got this thing of market stagnation from current levels. I'm sure there will be some sectors that will do well, but I think overall, that has to be a consideration. Let's turn to South Africa. This wealth creation element here. We know that in the case of wealth creation, we've said it's growth assets, and in the case of protection, there's the defensive asset side of things. But we do need to think about this one quite carefully, because we do have a problem in South Africa when we think about this wealth creation and protection. If you look at essentially the similar chart to what I started out with, which was your growth assets versus your defensive assets over the last 10 years, can you see the problem for your clients, which is that South African growth assets, well, they haven't been growing to the extent that we probably expected. You can think about things like equity risk premiums and so forth. We know it's additional volatility, but we know all of the constraints that we've had in our economy. And this is becoming a problem essentially for investors, because given this high initial starting point, if I think about the South African equation, which builds in a lot of bad news, and we sort of say, okay, but there's going to be an unlock of all this value. The problem we have here is in this election is some of the key players, notably the ones which could well be what we would term in political context the kingmakers. If you go into their manifestos and you look at what they diagnose to be the problem in South Africa, right? So we know there's a problem. We saw that in the previous chart. And you look at what they are saying. So in the case of the EFF, they're essentially saying that there's an incompetent, directionless, and visionless government. I'm not sure if you add them to the equation in a coalition, whether that would actually change, but they're saying they would make a change. And then in the case of the new kids on the block, the MK party, in terms of their analysis as to what is wrong in this country and why there is a problem. Essentially, what I've highlighted here is that they're saying our constitution is too liberal and we need to get rid of it. I'm sure if we maybe told the leader of this party that if he went to go and read Vali Musa's article yesterday in the press about the constitution and how it came about, I think they'd probably end up having a very big fight about this. But I think the point here is that when you have these parties generating a significant support, it doesn't mean that we are going to automatically move into a new phase of growth post our election. Foreigners have already voted. If you look at the cumulative flows, both in the equity space and the bond space, they've already voted and said, we're out of here. I'll also make the point as well, which is that if you look at these smart warrior managers that are running some of our companies in this country, what have they done, these smart guys? Well, I think, I don't know what the real number is, but it's 50, 60% of earnings on the JSE are from offshore. It tells you what our warrior managers are doing, right? So they are joining the foreign investors. And the point really is here that South Africa is a constrained economic environment, and unless there is not just a sign, there is actual structural change, things are not going to change as far as those outlooks are concerned. If I look then at our starting point, 10 years ago, on the 6th of May, 2014, the bond yield was 8.3%, the 10-year bond yield. Subsequent return on the All-B, which included the 10-year bond yield, was 7.8%. So your starting point gives you a rough indication as to what your return is going to be for the next 10 years. Even though, as Phil also highlighted, despite all this stuff that we had in South Africa, that are bond market negative, the return was 7.8%, which is not far off where the equity market was. And now I'm showing you that the current 10-year bond yield is 12%. What return do you think you're going to get out of the bond market over the next 10 years? I think it's going to be, when we come back for the 20th version of this conference, it's going to be something close to that. So Lee, you can make a note of that one, please. So my question would be, right now, in a South African context, do you need or want growth assets or defensive assets based on where you think things are going to be? And my answer really is that a return of 12% even and potentially even more is certainly something to look for. And then just in terms of where we position at SASFund, what we try to do really is to say, we don't know for sure when they're going to start cutting rates, but essentially we give you two options. One is essentially a floating rate fund, which tracks the interest rate cycle, being the high yield fund. And the other one tracks the bond yield, which is that if bond yields do start falling and things are great, the rand is really strong, well, then you're going to get fantastic returns out of that. And that tracks the bond yield, essentially. So I think I'll park there. Over to you. Thank you.
So I think the one thing we can all agree on is that we've got four smart panelists here with lots of experience. But when you're listening to a fixed income panel, there's going to be lots of graphs, right? So we got through the graphs, but we're going to make sense of those graphs, right? So what does it mean to us? What does it mean for our clients? And what are the actual views? The different views between the four on stage here, right? So we've heard Conrad, and his question was, could SA default on its debt? It could, but it's not highly probable, but there are things we can do to avoid it. We've got Maitse of Argon, who spoke about global macro factors impacting SA fixed income. Phil said, well, he's going to put a challenge out there, and can fixed income produce equity-like returns at lower risk? And he said, yes, it actually can, given his presentation. And then we had Arno saying that fixed income can help grow and protect wealth, right? But what does it all mean, right? So I asked him a few questions, and I said, I'll have my own table and my own graphs, but I'm going to have smiley faces and emojis to express what these guys actually said. So this is a view of the asset class view of the managers on stage, and you can see straight from this point that there's a difference, right? They view the world differently. So we've got SASFund that's negative on our currency, but sitting on the fence for the rest. We've got Aluwani and PMX negative on SA growth. Argon and PMX positive on SA interest rates. Aluwani negative on global inflation, while Argon is more sort of positive. Argon positive on global growth. So that's their view. But how do their portfolios actually look like? And this is what we're going to focus on. So what are their positioning differences, and why does it actually make sense to blend managers, right? Because they actually have different views, and they express that differently in their portfolios. And fixed income isn't always that easy to understand, but if you break it up into its asset classes, you start seeing the differences, and you start understanding the philosophies of these managers coming through, right? So let's start with duration, right? So we see Phil might see taking relatively higher interest rate risk by running longer duration on your multi-asset income fund, but I'm going to focus on you, Conrad. You're taking, your number's very different to the rest. So maybe just positioning that for us for just quickly.
I think, Lee, I think the answer is quite easy. It's a very different fund. So the maximum duration that our Alawani flexible fixed income fund can go up to, the maximum is lower than where these guys are running duration at the moment. So this is very much a cash plus inflation plus fund, but very cognizant of risk. And in fact, it tries not to lose any money on a quarterly basis, and it tries not to underperform money market on an annual basis. So there's a fair degree of risk and preservation in that low duration number, but it also does speak to the view. We've just come out of a year of sub-money market returns from global bonds and domestic bonds, interest rates moving up quite dramatically, and some of the guys have made the point that they're very high, and I'd agree with that. Some of the guys have made the point that they're topping out, and I think the jury's still out on that. I mean, we are in a higher for longer interest rate environment, and until I think we see the whites of the eyes on where interest rates are going to settle, is when we would push the boat out on duration in the portfolio. So we've been very conservatively positioned, but we've then, protected capital in quite a difficult year for fixed income assets.
Fantastic. So look, next we see yields all above 10, so the yields looking great, but Matthew, on your side, cash, there's a 22% holding. Is this more a strategic holding, or are you waiting for opportunities?
Yeah, you could say that. So this fund is limited to about 20% exposure to derivatives. So we like to keep that cash there as an enabler for us to switch exposures fast and efficiently using the futures market. So at this point in time, that 22% is covering about roughly 10% exposure in 214 future. Okay,
great. Arno, your side. I mean, so multi-asset income fund can pull so many levers. So we can see the levers that you're pulling. You're sitting on around 63% in government bonds. Maybe unpack that.
Well, it's just like Conrad said. I mean, the likelihood of them defaulting is pretty low, right? So, no, I think there's two angles here. The one is that at the peak of the cycle, again, I think this point was made about the fact that at the peak of the cycle is when the accidents happen, right? So you actually want to pull back on credit risk at the peak of the cycle. So that's exactly what we do. And the other point is that those government bonds are delivering yields 12, 13%. There's no need for us to go and get an additional 0.5% from some corporate bond. So I think it's really just the bottom line here is that when you're getting as Phil you said CPI plus 7%, how much more do you want? I mean, and I think that's really sort of the positioning that we're taking. It's at this point of the cycle. It's not always going to look like this, but
yeah. Great. Phil, on credit. I mean, you alluded to events recently happening in the credit market. So we once again reminded that these markets aren't risk-free markets, right? Things can happen. Relative to your peers, you overweight. Maybe sort of, or your exposure, the exposure is a bit different. So maybe just unpack that. But more importantly, unpack how do you go about avoiding these types of risks in the credit market?
Yeah, it's a great question. Thank you. Because when you're buying a bond, you're lending your money to someone. Okay, and it's only as good as the entity that you lend it to. So we explicitly, in South Africa, we only have exposure to banks currently on the credit side. So we're looking at too big and too important a fail. We're not lending money to unlisted financiers or normal corporates even, because the probability of them going, if something goes wrong, no one's bailing you out, really. So the banks are quite intertwined with governments, and there's a very low systemic risk of something failing there. So when we've stepped away from government bonds, we've gone essentially into the banks. And as Arno pointed out as well, is you've got the government bonds are the best credit quality, most liquid assets in the country at the moment. They're the only ones that give you fixed rates. I wish I could buy a 20-year Standard Bank fixed rate bond. It doesn't exist. Okay, so you need to look outside of that. So we've increased the duration because we've actually gone less risky from a credit perspective. We were sitting at less than 1 year's duration 2 years ago. And then after, because bond yields were 8, now then they're 12, 13, you go and fix your rates. It's that fixed versus floating rate discussion. We run an income fund that's yielding 10.5 with half year's duration, but that's if you want to be cash. But if you've got a 12-month and longer horizon for investors at the moment, you need to be buying fixed rates.
Okay, cool, thanks. Conrad, so sort of differentiators in your portfolio and relative to the guys on stage as well is your exposure to ILBs and unlisteds around 20% exposure. You know, it really does seem like something different, that you're doing something different in the fund. Maybe unpack that, and what are those opportunities and ideas that you guys are exploring?
So in a fixed income fund, especially where you're largely rand-based, there's very little diversification, right? You're SA Inc. and you're going to go up and down with the vagaries of SA Inc. I heard a great term for that, and it's been in the market for the last couple of years, narrative ping pong. You wake up and as the news changes, you go up and down. So we really try to get our diversification from a broad set of levers. And the two you've mentioned, one is a very focused view on short-term inflation. We did not buy into the inflation declining significantly narrative. We still don't. We think it's going to be higher and stickier than what people expect. Short-dated inflation-linked bonds offer between 4.5% and 5% real yields in South Africa. So 5% real yield plus inflation at 5.5%, you're getting a short-dated government bond with no duration risk that's going to pay you 10.5%, 11 type percent. And if inflation goes even higher, you'll get that benefit. So you can see we've had a little stab at bringing that view into the portfolio, some protection against higher inflation in the short term, which is largely played out or come through. The other one you mentioned is unlisted. So, you know, the guys have spoken a bit about credit. The public listed credit market is a bit of a bun fight at the moment. It's just, you know, it's crowded, it's consensus and spreads are very tight. We have the ability to go into unlisted and private sort of credit markets where we are very selective, very opportunistic, and we are finding very good opportunities in lending money to entities that are a little bit outside the mainstream of this scrum that I refer to, and we've got around about 10% of the portfolio in high-yielding private credit type assets.
Great. Oh no, in the Sasfin fund, I mean, you guys are by far the highest exposed to SOEs, right? So just, you know, just given issues around our SOEs, maybe unpack that position to us.
Yeah, look, I think the point is that there are two sets of, you can call it issues in the SOE market. There's those who are essentially off their own balance sheet, if I use Transnet as an example. And then you have, for example, Eskom and Sanral, who also issue what we call government-guaranteed bonds as well. So basically, it's where your exposure is actually to government. So the predominant component of that 11% is actually in the government-guaranteed component. So ultimately, our credit risk is on a look-through basis to government, and you're still getting that additional spread. So for us, it's almost like a bit of a free lunch in a way, as far as yield is concerned. But it's not the predominant component of our exposures.
Great, mate. See, and so you guys have I'm going to call it like an unconventional bucket here, right? Because I called it other. So almost 20% there. What types of opportunities are there? And, you know, maybe just briefly unpack your capabilities in that space.
Yeah, well, I'm sorry to disappoint you. It's not really unconventional. So that exposure you're looking at there, it's mostly, I mean, we are of the view that we are at around peak of the rate cycles. So we've been looking to fix a lot longer. So a lot of that is coupon CDs going out to 3 years. So that will be roughly half of that exposure, with the 9% made up with a bond future. So pretty vanilla basic stuff, nothing structuring or sexy like that.
Okay, so not too sexy. Okay, great. Then Phil, just let's touch on offshore. So you guys are invested offshore, but you sort of completely hedged out all currency risk. Maybe explain that for the audience.
Yeah, I showed that earlier on the one slide very quickly, that when you go offshore, you get equity-type volatility on the currency movements, but you're not getting compensated for that. So what we've found over time is you can buy offshore bonds hedged back into rands, and you get a couple of % more than you would in South Africa at certain points in time. So you can buy South African government offshore debt. You can even buy some of the banks, SA banks offshore, and they have to pay up more in pounds, dollars, and euros than they do in rands because we've got this tight credit market. So that's the one opportunity there. We explicitly are avoiding property, equity, and currency movements. We don't want the rand strengthening on us and taking away 10% in an afternoon, because it can do that. So that's all about where's the best yield we can get at any given point in time.
Fantastic, guys, and that's it. We've got 700 people, by the way, listening virtually on Teams. So, to those guys, thank you. To the audience, thank you. We've got a full house here. We've just demonstrated the power of different views of different asset managers and why understanding asset managers is important and why blending managers are important as well. So thank you, and enjoy the rest of the day.
Thank you, Lee, and your panel for making it for an absolutely great session, and definitely that you need different drivers of returns even in the fixed income space. Our next session is on global equity, and I'm going to call our next panel to the front. Our moderator from the session, Roelof Horn from Miton Optimal. Roelof, I'm being blinded. I can see you coming through, right? Jared Khan from Credo, Sean Pesh from Ranmore Fund Management, and Lars Achenbach from Riskura. Jared, you're here. Thank you very much. All the way from London, thank you so much for joining us here. Roelof, thank you for coming through. Are they still marking up? Just want to check. That won't work well. Right. Lars, thank you very much for joining us. Really appreciate it. And Sean, thank you very much. Good. Roelof, I'll hand over to you. Thanks a lot.
Eugene, thank you very much for the opportunity. Also to Robert and Tanya. I'm not sure if they did this on purpose, but the first conflict of interest I have to declare is that Miton Optimal is an investor in all three the gentleman's funds here. Starting on the left there, Lars, represents Riskura. They advises about 185 billion of institutional assets across the globe. They've been doing research in China for more than 10 years, and the funds in China are now 6-7 years old, almost 6 years old. And they launched an EM equity fund in 2022, August 2022. That's the one that we are invested in, also a little bit in China. And I think what makes them different is the fact that they advise on so many assets that they actually can have the ability to select the appropriate EM equity manager in whether it's Latin America, Asia, China, or India. And then moving to Sean with Andrew, ex-Alan Gray, managing the Ranmore suite of funds, well, a global equity fund, the one fund. Don't want anything else but the one fund. He's got a value bias in terms of his approach, valuation-driven, as with Jared and his team. But Sean, fourth out of 1,113 funds over the last 3 years. It's a pity you were first at one stage, but it's tough to stay at the top, but well done. And then Jared, first quartile over 5 years in the Credo Global Equity Fund. We also invested in this fund. And I think what makes Miton Optimal different is that our clients don't all have the same exposure because we do tailored portfolios for larger IFAs. So some of our clients have exposure to 2 of the funds, and some of our clients have exposure to 1 of the funds. But over to you, Jared. Let's start, and you approach the theme of market valuations.
I need a pointer, please.
I don't know where.
Yeah, try that.
See if that works.
Great, thank you very much. I'm actually going to stand over here. So I'm Jared Khan. Thank you everyone for listening today. I run the Credo Global Equity Fund, which is available on the BCI platform. I always like to start with this graphic for a number of reasons. One, it's colorful. I think it grabs a lot of people's attention straight away. But also focuses your mind quite quickly in terms of a few things. Firstly, the size of some of these companies in the US market are so big, and a movement in these stocks over a quarter or over a year can make such a significant difference to returns. And it also focuses your mind in terms of dispersions of returns and what's done well over a period of time and what's done poorly. And if you are bottom feeders or you're looking for opportunities, playing in stocks where you've seen bright green and up 80, 90% over the quarter, over the year, are not really the kind of opportunities that we look for, because you've either missed them or they're too expensive. And you're kind of looking for the red bits, and you're asking yourself, why are these stocks down? Why are these sectors down? Is this the opportunity? So it focuses our attention a little bit more. But effectively, what's worked this year and what hasn't worked. And apologies, this is only until the 16th of April. It's only a quarter. It doesn't really mean much. But sadly, we had to put in our presentations well in advance. You have to get compliance right off, which takes about 2 weeks internally, externally, and it's all a bit of a nightmare. But some of this data is a little bit outdated. But what has worked this year? And I think there are really a couple of themes. One is AI. If you look at the S&P 500 semis, it's NVIDIA, it's Broadcom, it's Micron. If you look at the S&P Media and Entertainment, it's the AI stocks. It's Meta, it's Google, and Disney a little bit. And then you've got a bit of a hodgepodge of other stocks outside of those sectors that have done well. And then you look at what hasn't done well. Interestingly, it's the auto sector, and that's predominantly made up of Tesla, one of the Mag 7. Wow, surprise, surprise. And then you have, again, what I would maybe consider some interest rate sensitive stocks. But we talk about the Mag 7 because they really have, certainly last year, I think, pushed most of the performance of a lot of the fund managers, and they're a big explanation of why people did, generally speaking, most fund managers did quite poorly. And this graphic, again, is quite interesting because if you look at the performance of the Mag 7 over the last 18 months, if you were just invested in those 7 companies, you made about 100% on your money, whereas if you invest in the rest of the S&P, you made about 15 to 16%. But what worries me, and as more of a contrarian and certainly more value-based type of investor, is the valuation of these businesses. Are you comfortable owning these businesses? There's no question that there are superb companies, but do you want to pay those kind of multiples? And my worry is that you look at the beginning of the year, the valuations of these businesses have pushed out quite considerably. Again, splitting them out in terms of how they've each performed over the year. NVIDIA has been a massive performer. It's not quite up 82%, but it's there or thereabouts. Meta, lost 20%. This is another factor. Worrying that these kind of mega cap stocks can move 20% in a given day after results is quite worrying. I don't think you kind of should see that kind of volatility in such large cap leaders. And then some of the underperformers, Apple, well, it's improved a little bit recently, and Tesla's just, it kind of does its own thing. But I've now, heard the reference of the Mag 5 because it doesn't fit the narrative anymore because you've had 2 or 3 of these stocks not performing well. It's Mag 5 plus Eli Lilly, and that's another sector that's done superbly well. It's the weight loss drugs, Lilly in the US and Novo Nordisk in Europe. Fantastic businesses, very expensive, but revolutionary in terms of what's going on. So here's the question, is the pivot trade still on? A lot of investors have forecast or have taken the view that the Fed's going to cut rates, and growth as a strategy has really rallied because growth does well when interest rates come down, and yet we're starting to see the market stall somewhat. And this is quite interesting. If you look at the 10-year, which is the blue line, normally what happens is when the US 10-year goes up, i.e. rates start coming down, the market goes up. But what we've tended to see, particularly since January, is in fact the market, anticipating in November that interest rates are going to start coming down, has actually continued to rally and rally and rally and rally, yet the US 10-year has actually done a bit of a head fake, and it's looking like rates are going to stay lower, or higher, should I say, for longer. And I can't quite explain that. Maybe the market anticipates that the Fed's going to capitulate very quickly, rates are going to decelerate quicker than expected, but it's been quite stubborn. And again, in terms of where you strategically placing yourself for the next 12 to 18 months, I think it's a bit of a tricky situation for growth in particular. And again, I draw my attention to this graph, and you will see it again, particularly from more value-oriented investors. This just shows you the relationship of value versus growth over the last 50 years. And value as a strategy historically worked very well. If you go back to 1975, to just around the tech bust, value outperformed growth. So the blue line when it goes down is when value outperforms, and the blue line when it goes up is when growth outperforms. So we see the tech bubble in 2000, massive capitulation, and then from about 2005 and effectively the last 19 years, growth has massively outperformed value. Tough if you are a pure value investor. During COVID, you see a massive accentuation of this outperformance. Then you see the COVID kind of hangover, interest rates start going up, and value has a great session in 2022. Our fund was performed very well then. And then you've just, again, seen this head fake where growth has gone up predominantly because of AI. And you've got to levels which are quite uncomfortable. So as a asset allocator today, and you're looking at strategies, where you want to put your money? In growth, where it's looking, I think, quite expensive, or in other strategies. And I think, just going back to the trend line, if you look at the black dotted lines, I think even if you believe as a growth investor that, value's dead, I think there's a tendency to believe that at some stage the AI bubble is going to, maybe slowly start bursting, and you'll get some kind of level back to trend, in which case you get a 20 to 30% outperformance of value versus growth. Valuations look expensive. This again tracks for the last 20 years the S&P value index, the normal MSCI index, and then you have the growth index. And all the re-rating has come in the growth stocks. There hasn't actually been much re-rating in value, very little re-rating in the general stocks. And then, we look from a geographic point of view. We are bottom-up stock pickers. We kind of just look where we can see value. And the US market has been the envy of the world. Again, this is just a quarterly kind of report, doesn't show much, but the US outperforms and has tended to outperform most markets for the last quarter, for the last 5 years, and it's really been the only game in town for the last decade. But interestingly, you look at valuation discrepancies, and things are starting to show. Back in 2000, Europe and the US used to trade on a similar multiple, and then the US has just kind of shot the lights out in terms of being the best companies in the world, having the best technology in the world, and valuations in terms of a PE have also shot out. Europe, less so, and the UK, which is in the black, has underperformed. And if you look on an EV to sales ratio, same kind of numbers. And the one that I like quite a lot is price to book. And you look at the black line, and what's interesting is the black line, time after time after time, which is the UK market, starts screening very cheaply. And the UK has its issues, let's not kid. Brexit's been a tricky time for the UK. Politically, it's been difficult. And it's not quite the market that it used to be, particularly if you don't have much IT or technology or growth in your indices. So from our point of view, strategically, as I say, we're not big macro economists. We don't look at things, but where we've tended to be putting a lot of our asset allocation in terms of our stocks is in the UK market. So briefly, if you look at the MSCI world as an index, geographically, the UK only represents about 4% of MSCI. We're at about a 25% allocation, and I'll maybe touch on that in a Q&A a little bit later. Brief snapshot, we have about a 90% active share in our portfolio. So not the typical kind of stocks you will see in a top 10. Looking for the Mag 7 in our top 10. Well, oh, we got Microsoft. That's about it. We do own Meta. We do own Google. They're a little bit lower in that pot, but we tend to own a lot of companies that the rest of the market doesn't own. And I think that's a great differentiator. And in times like 2022, when you're not part of the pack and things don't quite go the way the market's expecting, that's when you have great periods of outperformance. And we think we are at an interesting junction in terms of where things are right now. The US screening very expensively, a lot of people following, the AI trade, very, very, huge amounts of hot money in those sectors. And you want to differentiate yourself because that's the only way you're going to really outperform over the long term. So that's that for now. And I do have 25 seconds left, but I think we've covered most of what I got to say. So thank you for your time.
Thanks, Jared, and good morning, everybody. Thanks first of all, I just want to thank BCI. Since we moved across to the BCI platform, we had 17 million rand. We've currently got 720 million rand. So they've been a phenomenal, and it's just a delight to be here and see you all. So thanks to BCI, and thanks for your support. What I'm going to talk to you today is pendulums and wrecking balls. It's a little bit different to the topic that I proposed, but we'll get into that. So this is a quote from Seth Klarman, and some of you might have heard of him. He is the founder of the Baupost Group. He's a billionaire value investor. He said, the whole reason our capitalist system works the way it does is because there are cycles, and the cycles self-correct. And Jared just showed a chart of Tesla being down 37% this year. And if you think about that, Tesla started making a lot of money in EVs. All the other car companies came to the party, invested, started producing their own EVs. What's happened now? Tesla prices are falling. Okay, so cycles are just a fact. They're just a scientific fact. I mean, a couple of years ago, I was showering in a bucket when I came here. Last year, half the overburg got washed away. So things move in cycles. And we need to recognize that. So let's take a look at some of the financial cycles. This is back in October 2007. You can see at the top there. That is the 5-year historic return of the European market. It was up 160%. North America was up just over 80%. And take my word for it, if you looked at the 1 year, the 3 year, it's the same picture, it just made for a messy slide. If you were sitting down with your clients, how many clients would have wanted to invest in North America versus Europe? We all want to bet on the previous winner. Well, let's roll forward 5 years. And if you'd invested in Europe, you're down over 35%. You had a wrecking ball. Okay, a wrecking ball hit your portfolio, your client's portfolio. If you'd invested in North America, you were down 9%. But more of a pendulum, gentle pendulum swing. Okay, that's in October 2012. Let's give another example. Style. This is 5 years to the 31st of March 2000. Growth had beaten value. Growth was up 160%. Value was still up, nearly 90%. But, you're sitting down with clients. Everybody wants to invest in growth. How many wanted to invest in value? Well, let's roll forward 5 years. And unfortunately, you're down nearly 40% if you'd invested in growth. The wrecking balls hit the portfolio. If you'd invested in value, you were up a little bit. Okay? Another example, size. If you'd, January 2000, large caps, just over 130%, small caps just over 40%. So still positive, but everybody wants to bet on the recent winner. And so what happened if you invested in large caps? Well, you're down nearly 25% 5 years later. If you'd invested in small caps, you're up nearly 50%. Okay? Again, wrecking ball and pendulum. What about developed and emerging? Well, in 2011, 29th of April 2011, emerging markets up nearly 45%. World index, barely up. Okay? You're sitting down with clients. Everybody wants to invest in emerging markets. You're down nearly 30%. World index up 20%. And so this is the point. We have these cycles. Now what I'm going to do here is just put together a combo. All right? So let's have a look. Where are we today? North America has done over 80% of the last 5 years. Europe has done less than 30%. Okay? Growth has done over 90% in the last 5 years. Value has done over 30%, just over 30%. Okay? Large has done 55%, returned 55%. Small has returned 35%. And lastly, oopsie, sorry, go back here. Emerging markets, world index is up over 60%. Emerging markets is negative. Let's do a little combination of those. Okay, what we've got here, North American growth. So I've taken North America and I've taken growth. I worked with what indices I could work with here. You're up over 120% if you invested in North American growth index. If you invested in the all countries world index, that's the ACWI, but the small cap value ex-US, all right, you're up less than 20. There's a 108% difference. How many people want to invest in the small cap value ex-US versus how many people want to invest in North America today? Okay? I mean, so what are you risking for your clients? If you are betting on large cap US growth, you are potentially risking a wrecking ball if that slows down. Think about cycles. Or are you going to bet on pendulum? You know, I came up with this quote here, use a rearview mirror if you want to go backwards. Sometimes these cycles go on for longer than expected, and normally at the very point when you think this is going to happen forever, this is just a dead cert, it's going to continue forever, is the time that it turns around. So, but let's just take a look. That's just history. What about valuations? Well, what I've got here is the enterprise value, and I mentioned this at the conference last year. The benefit of enterprise value, rather than a PE, is it brings into account the balance sheet, and we've had a period of very low interest rates. Lots of American companies have got lots of debt. And so it's important at this point to bring in enterprise value, and it shows up the difference compared to other regions, especially somewhere like Japan, which has got lots of cash. So enterprise value, this is the world index, you know, just over 12 times. And this is the trailing 12 months earnings. All right, where's North America? North America's at 14. You can see that historically down there in 2009, it was lower than the world index. Where's large cap, US large cap growth? It's at 22. And this is the same point that Jared mentioned and some of the earlier speakers. North America is very expensive. You know, a lot of these companies in 2016, Apple had 25% of its market cap in cash. It's basically got very little cash left once they've finished their buyback that they've proposed. And where is the ACWI ex-USA small and mid cap? It's down there at 10. Okay, so that's where the value is. You can see it's almost at the same levels as 2009. That part of the market has been left behind as everybody has rushed to go for the AI. So it should not surprise you, given that we value investors and we look for parts of the market where that are being ignored. That's where we find opportunities. If you want to buy a BMW convertible, don't go and try and buy one on the first sunny Saturday in summer. You're not going to get a good price. You must buy your BMW convertible in the middle of winter when it's raining and nobody wants a BMW convertible. That's when you're going to get a good price. You might not get it at the first dealership you go to. You're going to have to look around, but you're going to get a good deal. So we hunt where people don't want to hunt. We have 81% outside North America, very different to everybody else. You know, most of the world index is sitting in North American equities right now. And if you look at the average market cap, given how skewed these huge companies are, is 90 billion in the world index, the average, okay, very skewed. Ours is 10. Now, it looks tiny. $10 billion is still a significant sized company. Okay, so that's where we are. That's our historic performance, 100 Rand to 995. Peers 618, and the world index 905. And we've done that through a period when value investing hasn't really been in vogue, and we've managed to avoid many of the value traps along the way. So, but importantly, we're very differently positioned to everybody else. We've been doing this for a long time. We have a great team. Many of you know Andrew. He's an absolute superstar. As are all my other members of the team. I couldn't be prouder. And we've done well, and we got a recent award. But as Rudolph said, this is a race without end. So the most important thing, we respect cycles, and we hate wrecking balls.
Thank you, Sean.
Yeah.
Sean, you did that in 7 minutes. That means you can make up the 3 minutes in the Q&A session.
Okay. More disclaimers. Nothing's with me. Well. No? Anyone?
Sorry,
you broke it. Gee. The wrecking ball is already upon us. Am I doing something wrong?
I've got no idea. Maybe it's because the time...
We're off to a great start. I lost my voice on the way here. If anybody finds it, please let me know. Oh, there we go. Whoa, 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 whoa.
There you go.
Easy, easy, Tiger. Okay. Whoa, whoa. I'm spoiling the story here without even having said anything yet.
It's too fast.
Too fast for everybody. Okay. So, what are we going to talk about today? The case for China. So, China was mentioned a couple of times earlier this morning already. It's really important for the South African economy. It's really important for emerging markets. It's really important for the global economy. So, a couple of years ago, if you asked somebody what's the case for investing in China, these are the kind of points they would have made. It's a huge population. They're getting wealthier. Lots of infrastructure being spent, money being spent on infrastructure. Exporting iPhones and other electronics to the developed markets. We then fast forward a couple of years and we say, okay, what's actually happened? Well, obviously, COVID happened in between. The stock market hasn't nearly done as well as it could have done. Although, in fairness, year to date, we finally are back into positive territory. So the month of April was positive. We're back above the waterline. We have had weaker growth post-COVID, but weaker growth by Chinese standards. So the Q1 GDP growth for China was still plus 5.3%. It's all relative, right? There's a lot of countries out there that would be very jealous of a 5.3% growth rate. So just bear that in mind. And we've gained a couple of things. The green economy has been a big positive for China. Electric vehicles, solar panels, anything to do with renewable energy. Geopolitical tensions, I've colored that sort of both orange and blue because, yes, there's been issues with the US particularly around technology exports and sanctions and the like. But at the same time, it's also meant that inward industrial production has benefited. The authorities have channeled resources and money into replacing that capability with internal capability. So that's been quite positive for domestic companies. Deflation, somebody mentioned earlier already, it's kind of a little bit unsure. There has been an aggressive policy attack on certain sectors, after-school education, monopolistic e-commerce players, a couple of very high-profile individuals like Jack Ma, looks like he's been in he's the guy at Alibaba. He's been in the crosshairs of the government. So there's been some of that. And the property sector, which also a few people have mentioned today already. The property sector is a bit of a tricky one. It does make up about 25% of the Chinese economy. And yes, it has had some issues. But I've also heard commentators say that the Chinese approach and the response to the property sector crisis possibly has actually averted a bigger problem. So they've intervened. It was a self-made correction by introducing greater restrictions on what people can borrow, on reducing the leverage, trying to reduce the leverage in property development companies. Some of those have indeed gone bust, but it could have been worse. So quite possibly, with hindsight, we might think that they managed it. It was an okay response, even if it wasn't fantastic. As a result of these negative things that have happened, we find the Chinese market is just incredibly cheap. Right? This is on a forward-looking PE basis. We're looking at a forward PE of about 10. We haven't had numbers like that since, well, almost 10 years ago. Just a couple of stats for those who are perhaps less familiar with the Chinese market, what's happened to it over the last 20 years. Now remember, it only really started opening up to foreign investment in the early 2000s, really. It was initially quite difficult to get exposure. You had to get quotas. They found different mechanisms for making that exposure much easier to obtain. And lots of companies have listed. So we have more than 6,000 stocks listed on the Chinese market now. That's combining the Hong Kong market as well as the mainland market. It's the world's second biggest market after the US, and also is extremely liquid. Now, a lot of that liquidity, turns out, comes from retail investors. And we know that retail investors, on average, are prone to being quite sentiment-driven. So that does make for more volatile market performance. But also, over the long term, they're not especially clever. They listen to their dentists, they listen to their buddies on the equivalent of Twitter's Weibo platforms. So they don't necessarily make great informed decisions. So it's a very ripe market for professional investors to generate excess returns. And despite all that's happened in the Chinese economy, the growth that it's experienced, it is desperately underrepresented in global portfolios. On the left-hand side here is the GDP proportion of global GDP that is made up by various countries. The Chinese one is at the bottom. It's about 18%, give or take, of global GDP. But in the MSCI All-World Index, it's probably closer to 3%. So it's desperately underrepresented. And in fact, this is in the index. Most investors would actually admit that they have below an underweight to China relative to the index. So it's even less than that. So there's a huge underweighting over there. But what's actually been happening in the meantime is that the Chinese have been quietly getting on with expanding their capabilities and their economy. This is a number of percentages of the world's production that is made in China on a number of physical goods. So it's solar panel production. 20 years ago, they made 11% of the world's solar panels, now almost 90%. Civilian drones, so these are photography drones, video drones, nothing at all 20 years ago. Now 3/4 are coming from China. You can go down the list, right? From virtually nothing to somewhere close to 2/3 of global production. In the virtual world, so the digital world, same sort of thing. Most downloaded apps on the left-hand side. TikTok, it's a Chinese app, the most downloaded app. This is 2022, the data. CapCut. Shopping apps, Chinese apps, the most downloaded ones. How have the Chinese managed to achieve this? Well, one is through education. China produces something like 5 million STEM graduates every year. STEM is science, technology, engineering, mathematics. 5 million every year. That is twice as many as the US, France, Germany, and Japan combined. Right? You've got an extremely educated workforce. Another thing is just attitudes to work. During COVID, a lot of the developed market, and many of us included, were looking for excuses to stay at home. The Chinese engineers were living at the office. They worked, they slept at the office. They weren't allowed to go home. Didn't make for a great lifestyle, but it did mean that in those 2 or 3 years, there was progress. Right? And so now the Chinese electric vehicle companies, for example, they can crank out a new model in 4 years. You want to see a Western automaker, or worse, even a US automaker, crank out a new model in 4 years. It's impossible. Right? So you've caught up, or indeed you've gained an advantage through education and through the attitude to work. And yet, we have the market desperately underpriced. This is the US at the bottom here. It's the implied equity risk premium by looking at the earnings yield less the fixed income yield. In the US, it's climbing like a 0.5%. It's crazy. Your Chinese equity risk premium is more like 6.5%. Now, sure, there are some risks, right? So a little bit of an elevated risk premium is justified. But this gap doesn't make sense. Right? So your question is, well, should you remain invested? Has the fundamental story changed? Is there something that we're completely missing? And so, yes, the sources of growth in China are going to be different, or have started to become different already now compared to what they were a couple of years back. Right? So the infrastructure story was a big one for many years. Well, as someone else has said earlier today, you've kind of built all of the high-speed railway lines. By the way, did you know China has more high-speed railway lines than all of Europe combined? Right? But anyway, so they've built all this stuff. But going forward, the Chinese have come up with this expression for where they're trying to go, which is quality productive forces. It sounds like something Karl Marx would have dreamt up with, but in fact it's completely the opposite. It actually refers to electronics, biotech, artificial intelligence, electric vehicles, space exploration, semiconductors. It's all the kind of stuff that where they are either they have an advantage already because of existing capabilities, or they're concerned that it might be taken away from them through some type of geopolitical problems. So there's money being channeled, energy is being channeled into these sectors. So going forward, replacing supply chains with domestic production, the green economy, strategic sectors, there's where you're going to see your growth coming through. It's not necessarily going to be so much from e-commerce in the future. Also, what we're seeing is the Chinese consumers are increasingly buying domestic. So in the past, well, actually the same is true in most emerging markets, to be honest. If you become wealthy in emerging markets, you want a nice handbag from Louis Vuitton, you want a BMW car, but you aspire to develop market brands. In China, we are seeing the domestic consumer aspiring to premium Chinese brands, premium Chinese electric vehicles, premium Chinese handbags, premium Chinese beer, instead of buying imported products. If you're a South African investor, you might ask yourself, well, we're kind of an emerging market. China's also an emerging market. Am I getting any diversification benefits here? And it turns out that actually, watch the yellow line is one at the bottom, correlation between the Chinese market and the South African market. It's kind of around about 0.2 the last little while here. Over there, it's 0.4. Remember that correlation of 1 is highly correlated, -1 is uncorrelated. Close to 0, it means it's kind of, there's nothing there. It's a great diversifier because the nature and makeup of the Chinese economy is so different to the South African one. So, just to finish off, the markets are desperately oversold and under-owned. And despite the recent headwinds that we've had, and unfortunately the Western press is very good at picking up on the demise of China and all these terrible things that are happening, and they're not looking through to see what is actually going on the ground. Right? A modest allocation is probably appropriate given that there are some risks, but it is just so cheap that it is, there's not a time to sell. People should be holding or buying more. Opportunities like this don't come around every day. I'm going to leave you with that. Thank you.
Thanks, Lars. Lars, I'm not going to leave you. I'm going to start with you in terms of the questions. While it's first on mind, and you've done a great job in demonstrating the fundamental value that the Chinese offer for markets, and also the productivity and the fact that they don't lie in hammocks and print money. They actually are productive and innovative. But from a global perspective, in our team, we've discussed it so many times. We need a catalyst for the global investor. The grand elite. They really own a big part of this market, and the sentiment towards emerging markets, for various reasons, were extremely negative. Whether it's the Ukraine, Russia, now Middle East, and just the U.S.-China trade war. In your view, what would the catalyst be? And I'm going to throw the question to you, Sean and Jared, as well, for non-US equities in EM to get the cash from the grand elite.
Yeah, no, understood. So obviously your very first top of your list is relative valuations, right? Many have spoken to that theme already. The US is extremely expensive on a valuation basis. China and other emerging markets with it are relatively inexpensive. But you're quite right, like where is the catalyst that is going to cause, either the one to fall or the other one to, hopefully it's the opposite, the other one will rise. And for the Chinese market particularly, I'd say there's probably two things that will change people's ideas there. The one is confidence. Confidence of domestic investors, confidence of foreign investors second, domestic investors first. Because once the market starts rising, as in fact it has now, we've had a quarter of
40%
positive, like I said, we're positive for the year again. Inflows of foreign investors, I forget the exact number, but I think it was the last week of April, was the biggest net inflow of money into the mainland Chinese market that we've seen in several months. So there's been a change of attitude that people are looking and saying, okay, there's a bit of FOMO going on. Was that the bottom? Am I about to miss out? And maybe that's correct, right? So then they're starting to invest in that. So that's one thing, is watch for the confidence to improve. There's your turning point. And the other one is decisive policy action by the Chinese authorities. And one thing that was clear in the last quarter is that what they call the national team has been brought in, so that often when the market's in a bit depressed and the authorities eventually realize, look, we've got to prop up the stock market a little bit here, they make some phone calls to captured institutions, so various state investment funds or retirement funds that are state-controlled, and they say, listen, we've got to buy a bit of domestic equities. And then before you know it, the market finds a bottom because this buying power comes through. So there are some levers that they can pull, but to be honest, they haven't been as aggressive in other policy actions as perhaps they could have been, perhaps they should have been. In a Western context, you would have probably seen much more aggressive action by now because people are much more worried about the performance of the stock market. The Chinese are looking for a more gradual, a more sustainable economic growth going forward, rather than just having these You know, to
In
Sean's point,
a way,
cycles of
they
wrecking
fix
balls.
some wrongs with rights instead of fixing wrongs with wrongs.
Yeah, I mean, the property sector sorry, I'm monopolizing the conversation now. Property sector is a bit of an example, right? So let's try and find a way to manage our way out of this as opposed to, you know, a sharp wholesale intervention, which you could get wrong. It could have more downsides, unanticipated consequences than you could have anticipated.
Thanks, Lars. Jared, do you think it needs a catalyst for the non-US equities to outperform? And moving on, your conviction on the UK market. It's been an unloved market from a global perspective for quite some time now. And you have, what, 25% exposure to the UK. But first question, what would the catalyst be? And secondly, just elaborate on why you are excited about the UK market.
Sure. So I'm not a China expert, but my take on China is, you know, China had a competitive advantage over the rest of the world. They had cheap labor, and that cheap labor converted into very cheap product that they could then export. And I think things have changed somewhat. I think that cheap labor, and you may disagree with me, has kind of dissipated to a point where there are other more stable countries where you don't have the political risk, like Vietnam and Bangladesh and others. Even Mexico has become a big point now where other foreign companies are happier to trade with those businesses where the cost of capital is not excessively more expensive than dealing with China directly, and they move away from all the geopolitical risk. And I think that's a big factor. But China's cheap. But unfortunately, I have, like, in my mind, we owned Sberbank, which was ridiculously cheap, Russian bank, 6 times PE, like a 10% dividend yield. Great company, never lost money, made huge money. And it was cheap because Russia was cheap. And everyone goes, buy Russia because it's cheap and nothing's ever going to happen. And the next day they invade Ukraine and the stock gets suspended and you lost your capital. And that is unfortunately the risk you run when you're running in these hot kind of emerging markets. Now, China's been through so much negativity, maybe I think there is a lot of upside, and it doesn't take a lot to change that. But longer term, I think I'd rather just stay with the boring stuff where I can sleep at night and maybe have a 5 or 10% allocation to a little bit more spicy stuff. So going on to the UK, I've got to hold my hand up and say we are not pure UK-centric businesses that we own. You know, these companies are, in the most part, global titans. They're great businesses that have huge geographic exposure. They happen to be domiciled in the UK. But having said that, what we're seeing in the UK and why I think it's such a great, attractive opportunity right now is that you've had this almost wokeness or this ESG kind of compliance that's taken over Europe and the UK, where investors are almost forced not to participate in certain sectors, to the point where, say, the energy sector, you have Shell and BP. Now, BP have been a little bit more woke about the way they do things, but Shell turns around and says, you know what, I'm not investing in green energy anymore because my return on equity is rubbish. You know, I can go and buy old fossil fuel businesses and get a 20-25% ROE instead of investing in new energy and actually having to leverage it up and at best with the government subsidy, blah-de-blah-de-blah, get like 8-9%. And then interest rates go up and then they have to write off billions. So what they say is, well, if I don't get the valuation anymore in the UK like I should do, I'll just move my listing to the US. And you're seeing more and more rhetoric. Even Total, which is like the prince of the French energy sector, has just come out and said, if we don't get a re-rating, we're moving to the US because it's underappreciated in Europe. And you're seeing more and more of that. So you've got businesses like BP, well, not Shell. You've got businesses like Beasley and Hiscox, which are insurance businesses that trade on 6-7 times PE, whereas similar businesses, arguably better businesses in America, are trading on 12-13 times. And they also have the ability to be acquired. So we're happy to keep buying what we think are world-class assets, trading at a discount with the chance that either they get acquired or they relist, or you get a re-rating. And I think it's slowly happening. More and more activities taking place. So they're not pure UK-centric businesses. We have a few. We have Admiral, which is a UK car dealership or car insurance company. We own Progressive, which is our number one holding. It's a US business done very well. Admiral is 2 or 3 years behind in terms of the whole hardening cycle in the car industry, and we think it's cheap. So it's a big holding, and that is quite UK-centric. Outside of that, Diageo, one of the best beverage companies in the world, trading on the lowest multiples traded in about 6, 7, 8 years. Very cheap. We like it. So that's our argument for UK.
Just the catalyst for non-US equities to outperform US equities, are you convinced there need to be a catalyst? Or are you just saying that from an earnings and evaluation perspective, non-US equities can do well? But you've got 60% in the US.
We've still got a healthy 60%. I think it's so difficult. The sector outperformance, particularly technology and growth, as sectors drives a lot of performance. So you don't need to be out of the US. You just need to be in different sectors, and you'll get that performance.
Thanks, Jared. So you can see Sean is sitting on the chair waiting for his 6 minutes that we have left. So first of all, Sean, do you think there should be a catalyst to get non-US equities and emerging markets to outperform? I mean, you've got 35% in emerging markets according to your slide. So that's the first question. And then the second question is AI. Investors have this perception, that technology stocks are expensive. But many companies benefit from AI. Can you elaborate on that too? So first of all, the catalyst, do you think that it needs one for non-US equities? And secondly, how do you and your fund benefit from the AI?
Yeah, thanks, Roelof. I think on the catalyst side, often if you wait for a catalyst, it's like trying to buy a lottery ticket after they've announced the winning numbers. Okay, it's too late. Now, you might have sat around, and there are lots of companies recently in the UK we thought, oh, this looks good, and then the next thing is a takeout bid. Okay, and then it's too late. So one's got to be careful about waiting too much for this catalyst. But it might interest people. I'd love to know how many people know that the UK hit an all-time high last month. Okay, and this is while it's very out of favor. 3.8% of the world index used to be over 10. It's full of banks and miners and insurance companies hit a new all-time high. So, sometimes these catalysts are at play underneath. And that's why I think if there's nobody external who is going to take advantage of the cheap prices, then you've got to have management teams who can do that themselves. And so things like buybacks is often a catalyst. But one of the big things is, I think what a catalyst could be is that most of the world has more than 70% in the US. And it just takes a large family office, sovereign wealth fund, et cetera, to just say, you know what, we've got 72% in the US, why don't we just take a few percent and move it into Europe and move it into Japan? I mean, look at Japan. What was the catalyst there? Warren Buffett all of a sudden announced, that he's got these trading companies and then the CEO. And the problem is when you do that, okay, she say, I'm going to take 7% off the table and move it across. The US is far more liquid. So to give you an example, JP Morgan trades $1.5 billion a day. So if you had if you're a big sovereign wealth fund, you've got $200 million worth of JP Morgan, you want to sell JP Morgan, you could do it before coffee. You try and invest that in Europe, you're going to move the price. Okay? Lloyd's trades 64 million a day. That's the largest UK bank. So you've got to be ahead of the curve. It's that whole ice hockey thing that Wayne Gretzky said. You can't go where the puck is, you've got to go where the puck's going to be. And you look at, if the football fans, Haaland, or what makes him so good? People don't pass the ball to him, they pass it in front of him. That's where he scores. You've got to go where the ball's going to be. And, the ball's been in the US. The ball's going to go outside, I think. So, right, so in terms of AI, I think if you take a step back and you say, well, who built the internet? It was Cisco and Nortel Networks and Broadcom and all the rest. How are those companies doing now? So was it the people who provided the tools to build the internet, or was it the users of those tools, the Amazons and the Microsofts and all the rest? So we'd argue, actually, that the AI beneficiaries are not just the NVIDIAs. And in fact, to Lars's point, while the Chinese, he's talking about the productivity of the Chinese in factories, Huawei announced a new chip and everybody sat up and thought, my goodness, look what these guys have done. They've built it. So does the rest of the world really think that China are not going to come up with a great AI chip when they've been locked out the market? Of course they are. And what's that going to mean to the likes of NVIDIA, et cetera? So on AI, it's the beneficiaries. And if you think of companies like banks, they're benefiting from AI because we don't need to have call centers. We can have chatbots. We can add signatories and open new accounts and all the rest. A company like eBay, which we've got in the portfolio, you can use AI to describe the product you're about to sell on eBay, and it will do so using. If I want to sell sunglasses, okay, it'll go back in time and say, well, the highest price that's been achieved for those sunglasses, describe the sunglasses like this. Do I want to use AI to describe my product? Sure, go for it. Okay, so there are all these clever ways in which food retail, they're using AI to reduce wastage. Wastage is a big component of costs. So if you think about it, you just say, well, what is AI really good at? It's really good at cutting costs. And so what do you want to have? You want to have businesses with huge cost bases. And so we think we're very well exposed to those kinds of things. And
thanks, Sean. Yeah. Any questions from the audience? We have 90 seconds. Any questions? Anybody? Roving mic? No? Okay, Lars, I'm going to use the opportunity to help people understand what you guys do.
Okay.
It's a minute. In your emerging market equity fund, you have a philosophy where you have a core flexible manager presence, so managers that can invest in growth, value, and quality. And then also a forward-looking quality component, a value component, and then using your indexation, your ability to actually do tactical trades with indexation. Within the BCI, so I'm doing BCI, a bit of a commercial here, you have two managers, SANS as well as GQG, that's in your portfolio. Let's talk about GQG. They are overweight India, and in your fund you are underweight India, but GQG is in your fund. Explain how you got to selecting GQG and this anomaly where they actually are quite overweight India and you're underweight.
Well, obviously, so, I mean, what I don't want to do is to sort of speak on behalf of another manager as to why they came up with the views they have. But maybe just to sort of explain a little bit more about how the portfolio construction then actually works. So it's likely that you'll find someone who's very good in perhaps a given geography or a given sector. You'd like to include them in your portfolio, and they might come with almost unintended consequences elsewhere. You say, well, perhaps they're not very good, or they don't have the capability in one market. I'm not saying GQG is this person, but just let's imagine someone says, you know what, I quite like China. I don't want to spend the time researching Chinese stocks, but I can buy Brazilian commodity stocks instead. Because if China does well, the Brazilian commodity stocks will do well, right? So I can play the same theme through two different angles. And as a result, they build up extensive Brazilian capability. They research those stocks well. They're great at picking them. And they end up being underweight the one and overweight the other. Our job then as a constructor is to say, all right, we like these guys. They're going to add value over time. We've got a bit of a shortage here now. How can we fill that? Is there someone else in the portfolio that we can use to fill that gap? If not, perhaps we need to get an ETF or something just to make sure that from a risk management point of view, you're not missing out completely. But that's kind of the magic, I guess, that someone in our role will bring, is to how to blend the managers you have so that ultimately you don't have any obvious gaps. You're not going to be blindsided by any geography or a sector or anything like that. And you're trying to generate your returns from stock selection. That's really what we're up to. We're not, we don't think we're clever enough to time individual countries or individual sectors. The managers must get on with that. If there's a gap, we try and close it. But you can very easily have people in your portfolio who, on looking on an individual basis, that like it doesn't make sense. Why is this person here? But by the time you've added everybody into a portfolio, it's different, right? So GQG, they might be underweight China, but actually our EM fund is slightly overweight China in aggregate. So that's what we care about, is the aggregate position.
Thanks, Lars. That's all we have time for. I'm going to ring the bell. In the next 2 years, non-US equities are going to outperform the US. Check that statement in 2 years' time. Cheers. Thank you, guys.
Roelof, we're going to hold you to that. So in 2 years' time, you might be having to buy everybody lunch, right? Speaking of lunch, our last session before lunch, don't run off. We're going to have, we look at property, local and global property. Our next panel's already here and onto the stage already. Moderator for the session, Nadine, very welcome from Analytics. Thank you so much for coming through today. Nadine, if you can maybe sit here and grab the iPad, the questions are going to come through there. Greg just gave me a list of his whole speech. Must I go on with the speech? Right, not yet. Okay. Greg from Reachway, thank you very much for joining us, and Evan from Sesfikile. Ladies and gents, thank you very much for being here.
Is this on? Yes, sorry. Good afternoon, everybody. Just another 30 minutes, then we can break for lunch. So we're going to talk about listed property. And as we know, listed property has got a very specific set of attributes. Those attributes have been demonstrated over many, many years, both locally and globally. More recently, the sector has had some headwinds. If you just think back COVID, I'm supposed to start this. Sorry, I'm just watching the time and it's not starting. Anyway, going back to COVID, it changed how we worked, where we worked from, where we shopped from, and then after that we saw high interest rates across most countries in the world. More recently, those headwinds had started to ease for the sector. In South Africa specifically last year, we saw listed property being the best performing asset class, but over 5 and 10 years, the worst performing asset class. So with us on the stage today is Evan from Sesfikile Capital and Greg from Readway Global to share their views on listed property with us.
Thank you. Can I have a pointer? Cool. I'm going to stand. This is better that way. Just on the local side, so I'm going to speak about where the grass is greener. And really, I'm not going to give you a definitive answer. I'm going to tell you up front. But what I want to do is give you a rational and objective outcome. Because South African investors, when it comes to investing in South Africa, they're either pessimistic or very pessimistic. So I want to see, maybe I can give you a little bit of encouragement to say why there is value in the sector. Just to show you, this is not a pitch slide at all, just to show you that I am objective here. We do invest in two strategies, so we tend to the grass on both sides of the fence. We do global and local, but obviously I'm going to tilt a little bit towards the local front at the moment. But really what I want to say is that, as a South African investor, we've got to be proud of our industry. We actually have boxed above our weight, and we do and we can stand toe-to-toe with the best of them globally, well, worldwide. So really where I want to start is when I speak about SA property, I want to speak about the ALLP, the All Property Index. So as a starting point, it has evolved. It's become a lot more diverse across sectors and geography. You know, it's just a little bit ironic that the SA property sector is only 40% on a direct see-through exposure into South Africa. We do have other opportunities globally and very good opportunities at that. So if you look at call it the developed market indices, you don't get the same exposure to the likes of CE, which creates just under 30% of our see-through exposure into our property or into our property assets. So there's a lot more than just SA. But yes, I want to focus on SA, and I'll touch on CE as well subsequent to that. But really setting the scene, and this is what was spoken about, I think I think on the bond side when the guys were speaking about it, SA has been out of favor. So since Nenegate, you've seen guys selling down both on equity and bonds, and subsequent to that, with the change in Reg 28, not only have the foreigners been selling, well, now we've seen the locals going from 30% all the way to, call it circa 43% exposure on their pension fund allocations. So really, we've been the whipping boys across the board by our own investors as well as the foreigners, but that's created opportunity. Why is, if you look at this is price to NAV. South Africa now is trading, call it circa 35 to 40% discount to NAV. So that's the listed price to the actual physical see-through exposure. Compared to, if you look at the global index, it's at a 15% discount to NAV. So everyone will say, well, yes, you do need a little bit of a risk premium. But we're double counting because that NAV is already at a higher cap rate or a lower multiple for other words, in another matter of speaking. So we are double counting that discount. Because the market has been global and local selling SA Inc., they've been selling the index, and that has created that value trap. And if we aren't going to see the value, well, then third parties are. And there's a few examples up there. Is Liberty 2 Degrees was taken out at a 25% discount to NAV. It was trading at a 50% discount to NAV. The portion of Waterfall City was taken out at a 15% discount to NAV. It was also trading at a circa 50% discount to NAV, as well as Industrials REIT in the UK and Irongate in Australia, both in South African listings, even though their assets were global, were taking out at huge premiums to where they were trading because money was flowing out of South Africa. It was indiscriminate. So that is where we point to. There is value. But then there's an argument, well, can you really do business? You know, people are so pessimistic. Property, well, the economy's flatlined. So are these assets actually trading well? Are they doing anything? Well, I'm saying yes. So I'm going to show you through the different asset classes. Let's start off with retail. Your vacancies in retail at the moment in SA are circa, this is the listed funds, 3%. That's lower than the US, it's lower than continental Europe, the UK. It is looking very positive. Subsequent to COVID, the retail sector has been exceptionally strong. You've seen expansion of retailers, not as much as we saw when the likes of Cotton On and the Zara expanded, but you've seen the likes of ShopRite expand aggressively. Mr. Price with some of their new brands like a Studio 88. TFG has expanded their brands. And then I'm sure I'm going to get to, a lot of you are thinking of it, what about Pick n Pay? We've all seen Pick n Pay in the crosshairs and the headlines. You know, Pick n Pay is a material trader in our portfolio. It's probably approximately just over 3%, of which half of it is Boxer. Boxer is trading exceptionally well. So we can put that aside. So 1.7%, which if that all went vacant, would still be lower than the likes of the UK and continental Europe. But nonetheless, is that Pick n Pay, it's not an EdCon scenario. They're not filing for business rescue. They are restructuring. They're being rational, and I think they're being very responsible in doing what they're doing. And they're raising capital, shoring up their balance sheets. And when it comes to the interactions with the property companies, they're not cutting all their space. The underperforming assets, or call it stores, they're all downsized. They may vacate some of them, but they're doing the right thing. And as a property owner, you don't want an underperforming retail in your center. So if anything, it's actually a positive. So if you look at retail, you're seeing a nice little steady reversion to the positive territory. Obviously, that's lagged behind the global scenario, which has been very much linked to the high inflation levels, but we are more consistent. So they're seeing that very much the rentals are linked to inflation. So we saw the spike last year, you saw high escalations, and now it's coming to very low single digits. Whereas if you look in South Africa, even though it's only a slight positive, call it reversion upside at the moment, what we call our effort ratio, which is gross rental to sales, is at 6.8%. Levels we last saw in 2013. So there's a lot of room to push rentals. So we are positive on relative to our global peers when it comes to retail. Office, it's been a little bit of a swear word for the last 13 or so years, but I'm actually getting a little bit positive here because we are troughing out. But I don't want to speak about the absolute return. I want to speak relative to our global peers. Our vacancies have started to come off, especially in your prime grade and your A grade assets, which are over 80% of our exposure into office in the local sector. If you look globally, aside from Europe and really call it France and UK, you've actually seen vacancies tend towards to the higher levels. South Africa, it might not be a positive, but we don't have the luxury of working from home because not everyone has access to Wi-Fi and not everyone has access to electricity. Over and above that is that in a strong market, a strong job market like the US, for example, people want to work at home. They have the negotiating ability. As that market softens, you might see that change very, very quickly. So that's why it tends towards South Africa having a much more prevalent work from the office environment. Over and above that is that the BPO market, which is business process outsourcing, has moved subsequent to COVID, strong from, call it Indonesia, India, into South Africa because we have a strong English-speaking, call it workforce, and it's a much cheaper workforce at that. So we actually have seen the likes of Cape Town City Centre, Umhlanga, in certain areas in Joburg, that you can't find place to actually roll them out. It's been a huge, call it response to that ability, that sub-asset set to to take up all those vacancies. And there's been no new supply. 0.7% of actual supply has been built. There is no new office supply in South Africa. So again, we are toe-to-toe with the globals, and I think we're actually doing better. And then lastly, of the major sub-asset classes, I'm speaking about industrial, which has really been the darling of the sector globally. And we've also been privy to that because of, obviously, e-commerce, optimizing supply chains, and lastly, onshoring. It's been really positive for us. That's why you've seen vacancies, call it trending sideways, but around about 2.5%. Very low vacancies. And a similar story we've seen globally. Asia, not so much, but in the US and the UK and Europe, we've seen very compressed vacancy levels. There's been a big difference, though. We haven't seen an uptick in rentals. We still have negative reversions. And there's a very good answer for that. It's because the cost of building in South Africa was so low that the guys were very conscious that if they had to raise rentals, there'd be new supply coming through. But at the moment, as you've seen inflation spike, cost of building, cost of materials, now you've seen the rental levels for prime grade industrial from 65 Rand stayed really just bounced all the way to 85 Rand a square. So we may be trading a little bit, but we are seeing the growth. Really what I want to say on the asset side is we've been doing very, very well in South Africa subsequent to COVID. Balance sheet as well. We know we've done very well. Our loan to values have trended from 44% to 37%. Globally, they're still sticking around about 40%. And the cost of funding. Now, we peaked at, call it the marginal cost at 10.4%. We're sitting around 9.4%. So the cost of refinancing is a little bit higher. But if you had to look in the likes of Europe, where guys were funding at around about 1.5%, now they got to refinance at, call it circa 5%. It's a much bigger hit. So balance sheet, we're actually looking in good position, in a good form as well. And then lastly, I've got to speak really quickly now, I only have 2 minutes, is that CE. You know, that other 30% of our exposure has been really a jewel in the crown for the last, call it 10 years. Still, even though we saw the likes of GDP peak around about 8% pre and post COVID, we're seeing it settle, call it in the low 3%, high 2% across CE that we invested, primarily in Poland and Romania. It is a strong, really, really strong area of the world. Unemployment, low single digits, again, primarily in where we invested, 2.7% in Poland, 5.4% in Romania. What does this spell? A lot of discretionary spend. There hasn't been a lot of the new supply that's come through, but you can see that the retail trade volume growth has been very exceptional, and it's projected to be as good, if not better, going forward. So those darker blue bars is where we invested in CE, and if you look how it outshines the likes of the Eurozone, it really is something that's special. It's really the gift that feels like it keeps on giving. So we're very pro the CE markets, and we have exposures, many exposures, but really primarily through the likes of NEPI and mass real estate. Going on to, so just bouncing around here, the outlook for the sector, well, you can't speak about property without speaking about the cash flow. We still have a positive carry relative to our bond yields. Our bond yields are, I think I forgot to look 5 minutes ago, but I'm assuming about 11.9%. We're offering a free cash flow yield slightly above that. So is the global market. You're also seeing a positive carry, but I heard Phil Bradford, and I really agree with him to the nth degree, is that we expect a much stronger compression in our bond yields. It shouldn't sit at 11.9%, especially where the cash rates are. We expect a much more material compression in the bond yields, and we expect that relative carry in property to remain even, well, to grow even more, which can lead to compression and NAV upside or valuation upside. So we're very positive on that basis. But ultimately, the drivers are somewhat the same, local and abroad. Everyone's waiting for that first rate cut. We're very positive that, you know, we saw it in November, December last year, and the market rated circa 20%. Unfortunately, inflation was a little bit stickier than everyone expected, but we still expect that rates cut to come through and the bounce in property valuations. Geopolitics, the known unknown. Sometimes it's a positive to be in the, call it the tip of Africa, so we're quite positive on that. We maybe stay away from the noise. And then obviously we're coming into elections. We got a few weeks' time. Hopefully it'll be even middle of the road for me as a positive. But don't forget, this is the year that you've seen more elections across the globe than any other year in history. And don't forget about the circus that's going to happen in November, December in the US. So don't just think it's happening on our shores. The world is exposed to this as well. The one big differentiator is GDP. We are coming off a very low base, but do we have that political will to grow off that base? That is the biggest differentiator between ourselves and some of our global peers. But again, every asset has a price. And as I told you, I believe, and many do believe, is that the market has been unduly oversold. So just because it's South Africa, we've had bad years and good years, but it's all dependent on what are you paying for the value that you are buying. And last year, we didn't have the best of years on a relative basis, but the year before, we were top of the piles, and we've been there before, and there's no reason we shouldn't be there again. Going forward, we expect quite comfortable, call it mid-teen performance, total return. The one big caveat there is an exit bond yield of 11.3%. We're going according to consensus of all the major economists that we respect in the country. And with that, if that is the case, growth can get you into a, call it, mid-teen total return performance. However, there is sensitivity to that. Should we get an unfriendly outcome in elections and you see rates spark, it could even be higher than that, but just understand the sensitivity. If it goes to 11.8, your total return is closer to 10%, but if we get a positive outcome, you could be aiming for the low 20s total return. But what I'm trying to say is that don't be so pessimistic just because we're in South Africa. We have a lot of opportunities here, and we think they're priced for disaster, which is not necessarily the case. Thank you very much. Thank you.
What's happening? I'm not connected? Oh, there were. Nadine, I warned you about these Sesfakili guys. They always overrun their time allocation. So let me get going. I need to caution you that this presentation is going to be boring as it comprises of many statements of the obvious, albeit that they may be latent, and repeats of the thesis that we've been putting forward over the last 12 months. The first of which is the market is grappling with pronounced daily reversals, the impact of which reverberates across weekly, monthly, and quarterly trends. The reason for this is that there's now a wealth, if not an overload, of readily available data coming down the wires, which is fostering the result in sharp short to medium term fluctuations, and this trend is set to stay. Navigating this landscape of elevated volatility, inflation, higher rates for longer, and even now together with hints of stagflation is a challenge for us as active managers. So how does the global property asset class fare? Well, the market noise over the last 2 years has been overshadowing the delivery of steady, visible, real earnings growth, for which there's many opportunities within the global property universe. That is, of course, if the underperforming geographies, sectors, and individual REITs are avoided. My ultimate statement of the obvious is that global property is no longer the homogeneous asset class that it once was. Whoops, I went the wrong way. So where's this earnings coming from? I'm using this chart prepared by Green Street Advisors, who have done a 4-year forecast. Yeah, it's quite risky, starting from 24 to 27. And as you can see, starting on the left-hand side, they expect data centers to come in with a credible 5.8% compound growth over that 4-year period. Still going further, even to single-family rentals, a credible 4.3%, which is a real return, assuming, of course, that inflation is going to decline and get down to the more moderate level. But be that as may, even if it doesn't, it's still able to deliver a real return. I want to focus briefly on the industrial sector. As Ev pointed out, it was the darling, had spectacular growth from 2018 to 2023, exceeding 10% compounding, and now it's moderating to a more lower level of 4.2%. But due to the extent of the size of this sector, there's plenty of opportunity still available, which I'll address later. Gosh, I'm pushing the key point. So last year, we actually did some comparisons of the sector dispersion and performance. Now I would like to actually get down to the individual holdings and just give you some examples. Here in this slide, we've listed the actual sector projected growth rate, average growth rate that Green Street has put forward in the first column, and then compared the actual consensus growth rate, rental growth rate for 2024. And as you can see in data centers, Equinix and Digital Realty are the two giants. and there's there's a variance there of 5%, a divergence of 5.8%, and obviously we have got a higher weighting of Equinix than Digital Realty. Our analysis, though, is that we expect that both of them are going to exceed this figure, the consensus figures. The Q1 results have just come out, and unfortunately we had to publish this beforehand, and I'm sure that these figures for the data centers in particular are going to be higher than the 8% and 2% respectively. Similarly, in self-storage, CubeSmart is projected to forecast to come with a credible 10%, almost 10% growth in rental. But have a look at Public Storage, which is the largest self-storage REIT. Our discussions with our analyst partners in the US is that they expect this as an underestimation, and as a result, we have recently taken out a higher weighting of public storage. In turn, in the industrial sector, we don't believe that Prologis, the giant of the sector, let alone the industry, will come in with 11%, so we've reduced our weight, particularly after disappointing Q1 reporting. However, there is still numerous logistics or industrial properties that are available to be developed or needed to be developed. And to this extent, the more mid-cap industrial companies or REITs like Rexford and Torreno have got great prospects, and we believe that our forecast is that they'll exceed that rental growth of 12% and 13% respectively. And in particular, we are overweight Torreno. What's happened? Whoops. So we've been showing this chart for many years, depicting the global property performance over the global equities. Going back to 2000, you can see it started outperforming, and that was brought about by the increasing amount of sectors that are coming into the market, particularly in the US. More specifically, no longer do we actually now pull up a slide reflecting the 28 sectors and subsectors, the recognized one. There's now more and more emerging sectors coming out, and I draw your attention, for instance, to industrial. There is one cold storage REIT with a market cap of sub $10 billion, but it's expected in about 2 months' time, a very large REIT will be listed with a market cap of $48 billion, and it is more than likely to cause the actual sector to become a recognized, fully fledged sector rather than a subsector of the industrial. Going further down, medical office, new sectors that are emerging, ambulatory surgical centers. I have no idea what it is, but it sounds impressive. Micro hospitals, there's one just up the road here, Intercare, and what would happen is that the REIT would own the building and rent it out to the medical operator, in this case Intercare, and believe it or not, even veterinary clinics. Something quite intriguing under self-storage, you have boats and RV storage, and have a look at it. This is what the properties look like. Americans are great about their RVs and caravans as we know them, and have a look at this quite impressive boat storage facility. I would imagine many marriages are saved as the boat and the RV is not parked in the driveway or taking up space in the garage. But this thing is slow. Getting back to this chart, let's have a look at it again, and from the perspective of where the rubber meets the road. As you can see there, we've highlighted that recently, and in particular from 1st of January 21, there's been this long sideways movement. Look at it. Let's look at it in more detail. There it is. Global property has been trading in an extended sideways movement and has made 3 attempts to break through, despite real returns coming through. And what has caused that? What has held it back? It's clearly got to do with what the 10-year yield has been doing. And in this slide, we're showing and comparing the global property index relative to the 10-year. And you can see there's almost a perfect inverted reaction or behavior of the property relative to the 10-year. But is it like that all the time? Going back over a year, we just added an extra year. You can see global property outperformed, or there's little or no correlation between it and the 10-year. Going back in history, going back 20 years, should you want this information, just drop us a line and we'll send it to you. You will see, particularly when there's been significant growth, that the global property plays little heed to what the US 10-year is indicating. So what it's done is created a fantastic entry point that has been around for the last 12 months. And this is the relative valuation relative to the S&P going back to 2005. And it's only a case of when rather than if global property is going to start being recognized. And I want to conclude with 2 quotes. Firstly, from BlackRock, who believe that static allocations and set and forget portfolios are a reasonable starting point, but they don't think they will deliver in the past. And here I'm talking specifically about global property. We need to be more active as things change pretty quickly. Just recently we saw the disappointing results of the largest REIT, Prologis, having a marked effect on the rest of the sector. However, the other smaller REITs are starting to recover from this position. Finally, most active investors fail to realize that they are part of the crowd themselves. They are trying to beat the crowd while being the crowd. And to this effect, to the allocators, I put forward to you, you need to start looking at the benefits of real visible growth that the global property sector delivers. I've got 25 seconds, Ev. Thank you very much.
Thanks, Greg. Thank you. Evan, just a comment from the audience. Ronnie is saying, excellent presentation. I have diversified a certain 8% of investment in the South African property market. I assume that is in your fund. Well, I hope so. First question to you, Evan. You showed the valuations of the property market, the property sector at least, in South Africa, showing prices relative to NAV. Over the last 10, 15 years, the sector has changed a lot in terms of more rand hedges or more offshore companies being listed here, etc. Is it still the best valuation metric to use? And if it's not, or if it is, maybe have you tested other valuation metrics that might have a little bit more predictive power? Or, yeah, give us some insight into your process there.
It's a great question. Our primary valuation metric is free cash flow and the sustainability and the relative to its peers, to itself in history, and also to the long bond. So we actually don't start with the price to NAV, but it's a backup mechanism. But it had become a lot more prominent coming through into the likes of COVID, where you had balance sheet issues. There's no doubt as you potentially rates spike, your LTVs spike as well, as valuations come off, your LTV spike. So we had to look at it as well. But so we use it as a backup valuation mechanism, but it is something that is very prominent, especially where we are in the market today, because it is a key indicator of potential corporate action. And we've seen several examples of that when unlisted players, where they want to grow unlisted portfolios, instead of buying NAV in the market, they can come to the listed sector and buy it at 20, 30% discount to NAV. So it is a lot more prominent in recent times, but it goes with the cycle.
Sure. Okay, thank you. Greg, I've got a question for you. If you look from a South African point of view, I'm playing devil's advocate here. Is there a place for global listed property in my portfolio, or should I just allocate to global equities where global property anyway falls part of? Because there is a higher correlation to equities offshore compared to local.
What has happened is that I mentioned that the global property market has changed, and if I can summarize it, the most significant is that there's more and more equity-like REITs that are coming onto the market. As I showed you, a lot of them are dependent on economic cycles or sectorial cycles. There is still obviously plenty bond-like equities, and they will, bond-like REITs will do very well should interest rates start declining. But to answer your question, there is definitely a correlation between the equity-like REITs and equity markets. And we've just seen this recently when the S&P went up just as little, like last week, it was very visible. The 27 REITs making up the S&P 500 rose up in concert. So to answer your question, the difference is that global property or REITs have got this far more visible earnings rollout relative to Tesla and even Apple at the end of the day. And from an allocation point of view, you should definitely be including an allocation to global property. It's just really the percentage what is the question.
Yeah, no, true. Evan, back to you. Do you see more prospects of diversification in the local property sector? Maybe more storage companies listing, or just to be able to compete with offshore property?
We can compete. That's not my issue. Yeah. But when you're answering the question is if there's new sectors coming through, there's definitely new sectors happening on the grounds. Whether they list is another story. So it comes back to the fact that if you are trading at a 35% discount to NAV, there's no incentive for these things to list, because you're writing off 35% of your value if you come to market for liquidity and for the ability to raise capital, but it's a very, very expensive cost of capital to raise. So, when the investment industry understands the value and prices normalize, then you'll see more listings coming through. But at the moment, unfortunately, there's no incentive for these things to come onto the listed exchanges.
But does that mean structurally listed property is going to change going forward?
These markets work with cycles. We see boom and, I won't say boom and bust, but you see big listings and then you see consolidation. At the moment, we're in a consolidation phase.
Greg, maybe one last question. We've got 1 minute left. I read a report that was released earlier this year in Global Property to say the biggest sub-asset class for the next 12 or 18 months is digital economy. So I know data centers is a big part of that. But is there other themes coming through that will allow you to also make or access the digital economy of the world almost?
Well, during COVID, it spawned the significant growth in the industrial sector. Obviously, data centers, there's just not enough of them. There's a shortage of power. Unfortunately, a lot of them were delisted by private equity because they weren't achieving the values at the end of the day. And then, of course, towers, the stuff has to be transmitted through towers. And then there is another sector, and that is the stuff that is underground. There is REITs with fiber optic cables, and there's another one, a tower with a lot of kilometers of fiber optic cables in the mix as well. So it's quite possible that there is one at the moment. It's quite possible that a whole lot of fiber optic cable that transmits it rather than over the air, but through cables, could be coming to the market and become a recognized subsector, emerge from being a subsector to a fully fledged sector.
Thank you. And with that, I'm specifically looking forward to the bear and the bull case, because both of them had very decent returns for our investors in the local side, even for the next 12 months in South Africa. But with that, thank you very much, and we're going to break for lunch now.
Thank you. Thank you.
Nadine, thank you very much. Evan, Greg, thank you very much for being here today. I really appreciate it. You're listed with demands. I always thought it's demands. Greg, thank you very much for that. Right, we are going to break for lunch until 2. Big breather, right. And then we're going to come back for the hedge fund managers and multi-assets, and then we're almost done. Enjoy lunch in the foyer. I'll see you back in a bit. Right, I think that is fine. And again, thank you so much for all being on time. I hope our online audience are all with us as well. On stage already is Rafik Taylor from Sanlam SMI. I think you're all very familiar with Rafik. And he is joined by Craig French from Vigio Fund Management and Clarissa van der Westhuizen from Fairtree with our next session on hedge funds. Proved to be very interesting. And Rafik, I'm going to hand over to you. Thank you so much.
Thank you very much, Eugene. Good afternoon, everyone. I hope you enjoyed your lunch. Yeah, I mean, hedge funds has been in the retail sort of limelight now for the past 24 to 36 months. And I'm sure all of you are getting more familiar with it and getting to grips with it. Yeah, today we are going to be talking about hedge funds within the context of global allocators and what are global allocators doing and how is that sort of superimposed in the South African landscape, and that's going to be done by Craig, followed by Clarissa, who will talk about long-short equity strategies and how you manage those kinds of portfolios within a volatile market like we've seen over the past 18 to 24 months. So looking forward to the presentations and then a little bit of Q&A. Please utilize the functionality that you have in front of you with respect to questions, and I'll pick it up on my side and we can have a fantastic debate afterwards. Craig, over to you.
Thanks, Rafik. Good afternoon, everyone, and thanks for making it in here after a delicious lunch. I'm going to give you guys just a snapshot for hedge funds from a global perspective. I spent 5 years in hedge funds in London before moving back to South Africa. We effectively worked with European institutions, treasuries, family offices, helping them source hedge fund solutions for their portfolios. But before I kick off, I'd just like, by a way of show of hands, can you please stick your hands up if you have hedge fund allocations for your clients at this point in time? Okay, good. That's probably about 15-odd%. So if we look at hedge funds offshore, the global hedge fund industry at the end of 2023 was $5.1 trillion. If you rewind roughly 10 years back, it was $1.4 trillion. So you've seen over a threefold growth in the global hedge fund industry in almost a decade. So clearly, there are allocators globally that see value in the asset class. You have seen growth locally, but it's still only a fraction of the allocation of what you see offshore. By way of the size of an allocation in the portfolio, if I talk to the likes of a Yale endowment, so the smart money in the US, they have 31% allocation to hedge funds. Stanford has 19%, and Harvard has 16%. So that's to hedge funds. If you add in other alternatives, so private equity and real assets, that goes from 45 to 50-odd%. Okay, I think we are there. The interesting thing in South Africa is we had two great things happen in '95. One was the start of our web-less campaign in winning World Cups, and the other one was the start of the hedge fund industry. It's quite fitting to share the stage with Clarissa today. Andre, who started Fairtree with Kurbis, he is what we would call a Decillion cub. Decillion was one of the first hedge funds in South Africa back in '95. And in the US, when managers break off and go and start on their own, they call them cubs. So we've got a second generation cub on stage with us.
These are just the figures that I've shown you. Again, a pretty big deal in terms of global asset allocation. Maybe to frame that, the global REITs, listed REITs industry is about $2.2 trillion. So it's over double the size of the REITs listed market globally. This shows you just a snapshot from a global perspective. Hedge fund research, it's a Chicago-based outfit. They research hedge funds across these 4 main subgroups. It's a total of 28 subclassifications that are available to clients globally in the hedge fund space. What we've done is we've circled the strategies that you as a South African investor have access to. In the main, it's equity long short, and that's split between directional, longer bias, and market neutral, and then more relative value on the fixed income space. There are private lending funds, there are some commodity hedge funds and some multi-strats, but in the main, you have 3 strategies that you can access via retail funds in this day and age. I was very fortunate while I was in the hedge fund consulting in London. I got to travel to New York, across Europe, Asia, Hong Kong, Tokyo, meeting with hedge fund managers. And there were really 2 reasons why global allocators allocate to hedge funds. The first is the ability to generate an absolute return. So if the market's going sideways, like it currently is in South Africa, or if there's a slow puncture and it's going down, you should be able to generate a positive return. I've taken data here from Vizio's retail hedge fund, which was launched 17 years ago, and I've shown through the average Aussie bull month, we were up 1.9 versus an average 3.7 for the Aussie, but the interesting thing is the downside capture. We're down 20 basis points on average when the Aussie's down on average 3.2% during the bear months. The result of that is enjoying what Albert Einstein called the 8th wonder of the universe, and that's that effect of positive compounding. The next reason global allocators allocate to hedge is they want to harvest a source of return, pay for a source of return that has a low correlation to markets. Again, this is data for our retail hedge fund since November 2006, and we're showing a rolling 12-month correlation to the Aussie, and you can see over that period it averages a correlation of 0.4. So it's a lower source of correlation to equity markets. How do we achieve that? There are a number of tools that you can utilize. What I've done here, the most obvious one is I've shown the red bars are the CapSwix sector allocations. Whoops. There we go. So the red bars are the CapSwix breakdown from a sector perspective, and then the blue bars, that is where I've plotted our retail hedge funds exposure from a sector perspective. So obviously the one to achieve a low correlation is being positioned differently to the index. Pretty obvious. Second is your asset class diversification. So although we run an equity kind of centric hedge fund, we are also allowed to hold a number of other instruments. And in the main, we've got classes like the bonds here. We've held corporate bonds. We run a dollar corporate bond funds. There are certain sectors that you can't access on the JSE, something like right at the bottom there, energy transition. So increasing what you would call your off-benchmark type positions into the portfolio allows you to create that diversification, lowering the correlation. You also have at your disposal the ability to adjust your net exposure, and then also what they refer to in the hedge fund space is your beta adjusted net. So you take your net exposure, you multiply that by the beta of the underlying holdings, and you get a beta adjusted net exposure. You can also work with your gross exposures. You have various hedging tools at your predisposal, derivatives along those lines, and then also the composition, the FX makeup. So we have in our hedge fund, it has 70% equity exposure. 40% of that is offshore. 25% of that is SA Inc., and then the remainder, really 5%, is on the range hedge component. You can also further increase your correlation by looking at what you're doing within a sector. So here's an example of a pair trade. We entered into momentum back in July, August of 2022. And how we did that is we actually sold one of the other insurers. I'm not going to mention the name, but you use the proceeds of stock that you borrow. You basically borrow the stock. You say, I'll pay 75 bips a year to borrow that. You go sell it in the market, you use that cash to buy even more longs of the stock you like. So that's a way you can buy more of what you have high conviction in, at the same time lowering a correlation because you've got an offsetting bet in the same sector. MTN, express yourself. The nice thing about a hedge fund is if a stock looks like a bit of a dog and it's got massive headwinds, well, that's fine. Then you actually decide to go short. So it's not only about the long opportunity. And very often in a hedge fund, when you cover your short, it's often time to rethink and potentially your thesis is not potentially a buy opportunity. So you've got that optionality. Another tool which we use at Visio is we like to get actively involved with boards, what they would call activism. We call it constructive engagement. You send in a letter to the board. You challenge them on issues such as capital allocation. You look at management incentivization. You know, are these guys incentivized? Do they have share options in space to drive value in the specific stock? So here's a number of stocks that we've done this with. Most times we don't go to the press about it. We don't want to antagonize management. We want to work with them. But every now and then, if they're not being forthright in terms of communications, we'll happily speak to the press. Another tool, obviously in the South African context, given your offshore alliance, is you can diversify offshore. I'd say in the main, we've obviously got a fair bit of US exposure. One stock that may look interesting there is NVIDIA. We've got a collar structure on the NVIDIA where we've we've bought puts and we've sold calls, and in that way limiting our downside capture. Yeah, the stock has run hard, but we think the runway is still quite long and there's lots of potential upside in an NVIDIA. You'll see in Europe the likes of Novo Nordisk, which is in the biotech medical space. Again, you have a universe of one in Aspen to invest in locally. We were fortunate to catch Hypnosis. We've got a couple of guys on the team that are musos, drummers, guitarists, and so forth, follow the music industry closely. And again, an off-benchmark bet, which can add nicely to the portfolio. We've got an India position. Team have spent time in India, very excited about the growth opportunities there. At the moment, we're actually playing that through an ETF, so it's a broader exposure, but again, that lowers the volatility of your portfolio. And then there's Tokyo Stock Exchange are putting pressure on companies to try and unlock value. Many of the companies there are trading at book values of less than one. This has been a multi-decade issue, and it's finally being addressed by the exchange. This is my PA portfolio. I've taken the names out, but I hold 3 internal Visio funds and I hold 3 external funds. The green funds are dollar-denominated funds, and all I've done is I've actually converted their returns at spot back into rand. That does elevate the volatility when you do it at spot, but you can see here that you're able to generate a return with a risk-reward ratio of 1 investing in hedge funds, whereas you look at something like the ALSI, it has a sharp ratio of 0.3, ALBI 0.3, and then if you took a classic 60-40 mix, you're getting a 0.4. So you're getting 3 times the return at much lower volatility. This is just a track record of the Visio Retail Hedge Fund. It's a fund that my mother-in-law is invested in. I'm brave enough to put her into this portfolio for a couple of reasons. Again, we talked about absolute returns and limited downside capture earlier. You'll see the lowest 12-month rolling return over 17 years has been 3.3% versus 37% for the ALSI. And again, the deepest drawdown has been 10% in this fund versus 40% for the ALSI. Okay, hedge fund conversation wouldn't be done justice if we didn't get to talk about the fees. I sat down with a BT pension fund trustee in London and he told me hedge funds, HF, stands for high fees. I was like, thank you very much. The reality is, as I've demonstrated earlier, you have the ability to generate far superior risk-adjusted returns, in the order of 3 times, by having a portfolio of hedge funds. Our hedge fund, which was structured back in 2006 was set up with a management fee of 1% and a performance fee of 20%. Research done globally shows that the average equity long-short hedge fund management fee is 1.5%, and the average performance fee is 19%. So, yeah, it really comes down to you can have the classic Swiss Army Victorinox penknife, which gives you a couple of tools, and that could be relevant to your balance type funds. Or you can have what they call the Swiss Pro, which gives you all of these various options in terms of expressing your purest view in the hedge fund space. Can I ask, for those of you who said they didn't hold hedge funds, would you possibly consider hedge funds going forwards? Please put your hands up if you would. Okay, so a few converts. Thank you. My time is up.
Hi, everyone. Good afternoon. I'll just wait for my presentation to come up. But firstly, thanks very much to BCI for the opportunity to present today. There we go. Okay, so I'm going to present a little bit differently from Craig. I'm going to go into a little bit more detail on some of the core issues around hedge funds, or at least a long-short equity fund. And I'm going to talk about how you can benefit from putting a long-short equity fund into portfolios in volatile markets. I just want to comment, apologies for the overly dramatic image there. I asked ChatGPT to come up with something for this presentation, and that's what it came up with. So firstly, I just want to explain short selling. I know Craig referred to it in his presentation, but we buy shares because we think they're going to go up. So short selling is when we borrow a share that we don't actually already own, and then we sell it, hopefully at this wonderful high point here, and then hopefully it collapses in price, and we buy it back over here. We return the stock that we borrowed to the person we borrowed it from, and we pocket the difference. So short selling is a way of making money from shares going down. Now, I know that sounds very mean, but it is actually the way that, as hedge funds that we add another tool to our toolkit to generate returns. And by shorting shares, we also introduce leverage into the portfolio, because we get in funds from this share that we've sold that we didn't own, and those funds we take and we invest in another share that we really, really like, that we think is going to go up. So if I go on to the next slide, you can see over here, if I just compare a long-short equity portfolio, hedge fund, to a normal long-only portfolio. This is our normal long-only portfolio over here. It's got between 0 and 100% equity. That's the total amount of money that we've got to work with. That's our gross, that's our net. We've got to pick shares, and we've got to invest in those shares, and hopefully they will go up and generate good returns for us. Now, I've taken an example here. This is our Assegai fund. It's actually a qualified investor hedge fund, although we do have a newer retail version of this fund, which is slightly different, but it follows similar principles. And the net equity of exposure of this Assegai fund can vary between -20% and 120%. So if we think we do a crash, we can have net short position in equities. We can benefit if the market falls a lot. If we are positive on equities in general and we see lots of opportunities, then we can have more than 100% net exposure to equities. And how does that relate to our gross exposure? Okay, so if we're really positive on equities and we've got the maximum exposure that we can have, which is 120%, how do we go about achieving that? Well, firstly, we sell 90%, we have short positions amounting to 90%. And then we have long positions amounting to 210%. So we have more long positions than a normal fund would have, and we have these short positions. So the short positions are allowing us to fund more long positions. If we're at maximum, we're maximum negative, if I can put it that way, then we'll have 160% short positions and 140% long positions. So that's, in this fund, we have 300% gross exposure maximum, and that's how we can utilize the full toolkit. Now, just let's talk about the different types of shorts. So outright shorts, I think that's pretty easy to understand. That's where we see a business, we think this thing is going to collapse, it's a house of cards, it's a Ponzi scheme. You go max outright short, obviously you risk manage the position. So if it's very small and illiquid, then you don't have a large position in the stock. But that's when you really hope the stock is just going to go down. Now, we might have a short position in a stock that we actually think is a good business, but we think it's fully valued, and it's run really hard, and earnings have done well, and the rating is pretty high. And then we can have a short position in that business, and that allows us to fund a long position in a business that we think is going to do much better. So that's an outright short. Portfolio hedges are where we might buy like a put on the all-share index. If the all-share index falls, we make money. It allows us to protect our position. And then cross-sector pairs, say, for example, we're going into the elections, and we think that the outcome is going to be positive. So we want to have access to stocks that are going to benefit in an environment where people get excited about SA Inc. But we think that actually, this is not our position, I'm just using it as an example. We think that potentially the retail shares are really going to struggle. There's too much competition from Shein and Temu. So we want to be short retailers, but we want to be long banks because we think their earnings will be protected. So both of those positions are exposed to SA Inc., but one sector we think will just benefit far more than the other if our scenario plays out. And then if I talk about intrasector pairs, that might be, in our retail example, we've got one business which is well managed, excellent moat around their business, doing really well, and another business that is poorly managed and struggling. So we'll be long the business we really like and short the business we don't. They're both exposed to the same environment and the same operating environment. Okay, so this is an example. It's an old one, because talking about current shorts can be a little bit controversial. But this is a short that we had for quite some time in the portfolio. It's an investment holding company, Brait. And the gray bars here show our position. This is the share price. So it went from 120 Rand in 2016 to about 2.60 Rand in 2021, where I've cut the graph off. So what happened? Brait went and bought Virgin Active. They bought New Look, which is a high street retailer in the UK. Both of these businesses had been through a number of restructurings and issues. They put a lot of debt into the underlying businesses. They valued them quite highly, and then they also put a lot of debt into the holding company structure. So we looked at this business and we thought, there's not enough cash to fund the level of debt within these businesses and the level of debt at the center. And that's why we were in short this. Subsequently, Brait wrote off New Look in about September 2017. They restructured the business later that year. They recapitalized both New Look and Virgin Active various times. They did a rights issue. So that's why the stock price fell so much. Okay, this is a slightly different example. In the orange here is the price of the platinum group metals in rands. So that's platinum, palladium, rhodium, the basket price of those metals. You can see it's fallen a lot over the last 2 years. And the black line is the Impala share price. So Impala is a miner of these metals. Makes sense that the share price falls along with the metal basket. You can see that there's been times where the share outperformed the metals, and there have been times where the metals outperformed the share. So already you can see potentially there's an opportunity to be long or short the share based on whether it's running ahead or behind its basket. But what I actually wanted to show you was this chart. So these are 4 different miners. I've taken the names out. The black bars are our modeling of the free cash flow generation of these miners at the spot platinum group metals price. So if the metal price doesn't move, one of these miners will lose a lot of money, and some will just make a teeny bit, even less here. If the price falls, those are the orange bars, this one will lose a lot. And then the gray bars show if the price goes up 30%. So even if we don't know exactly what's going to happen to platinum group metals, we can take a position by being short this share, which is really going to struggle in almost any scenario, and long maybe these two over here. Okay, so that's how a long-short equity strategy would work. So has it worked? Over here, I've just taken the last 2 calendar years, which we know, have been very volatile period with various geopolitical issues, Russia invading Ukraine, etc. Lots of macro dynamics around the US and inflation and interest rates. So we can see that the green line over here is the all-share index total return. Over these 2 calendar years, cumulatively, the all-share return 13%. So not great. Over here, this gray line, this is again the Assegai fund, is the return of our short portfolio. Now, it didn't do great. It underperformed the all-share index. It was down about 3% cumulatively over those 2 years. But it allowed us to fund long positions over here that returned 90% over the 2 years. So the return of the Assegai fund over that 2-year period was 44%, so well ahead of the all-share at 13%. So that's a relatively short history. I've done the same thing over a 12-year period. So here's the net return of the Assegai fund, 20% since inception, and the all-share is about 10.5%. So I hope that you have a feeling for some of the tools that are available as a hedge fund. And so these tools allow us to kind of invest in volatile markets and benefit even when markets are going down or trending sideways with volatility. The types of markets that it's not necessarily easy to just put your money in a long-only fund and not worry about it. Thanks.
Thank you both very much for your presentations. Yeah, I mean, I think this is a very interesting space for all of us here. For me personally, being an allocator, and for you, the audience, trying to figure out exactly how to actually utilize this. Is it a massive opportunity, or is it a grave mistake? And I think that's why we're sitting here. So maybe as a starting point, looking at, and Craig, you started your presentation with it, talking about the global context for the use of hedge funds. And there's a survey out called the Global Allocator Survey that speaks to the 151 allocators globally about how they use hedge funds and where they see it going. And they said 51% of them saw it increasing, and 90% of them overwhelmingly said it was either going to be maintained in terms of exposure or AUM. That's very stark to, I guess, what we've been seeing in the South African context, and actually I would say in the early noughties, hedge funds in South Africa got a bit of a bad rep, or should I say rap, and then we've seen a bit of a resurgence in the use of hedge funds, not only in the institutional space, but also in the retail space, maybe over the last 3 to 5 years. Where do you see hedge funds going in South Africa? And is this another sort of a fad, or is this legitimately people understand it, people know it better, allocators know it better? Maybe your view of the bottle.
Yeah, sure. So I think, firstly, as I mentioned, that hedge funds started here in roughly 95. So they call it 29 years old now as an asset class in South Africa. They've been going in the US for 70 years this year. So it's a much older asset class there. There's the whole thing I was saying to Rob Foster earlier, and he mentioned the term education. It is about educating clients. If you just purely look at the data, it speaks for itself that hedge funds can protect capital, and you can get far superior risk-adjusted returns by having an allocation to hedge funds. I think the other stark thing is, for the industry to have grown from 1.4 trillion in 2012 to 5.1 trillion today there's certainly a large allocator group that sees use for it. The other thing is we've only recently introduced retail hedge funds. When they introduced the UCITS hedge funds in Europe, what you saw there was this massive growth, but what it was is institutional investors moving their capital to the more liquid, daily priced, better transparency, more regulated product. So I think it takes time, but I think the numbers speak for themselves in terms of the benefits.
Thanks, Craig. I mean, maybe talking to some of the technical aspects of hedge funds, and maybe on your side, Clarissa, managing a long-short equity hedge fund. There's different ways to skin the cat when it comes to hedge funds, and early on we spoke about, are you using hedge funds for risk mitigation? Are you using hedge funds for low correlation or something else? Maybe talk about how you manage your long-short hedge fund, and I guess within the context of how you think the person buying the fund needs to think about an allocation to your portfolio.
Okay. So, I mean, in hedge funds, there's many different kinds of hedge funds, and often when you hear people talk about hedge funds, they talk mostly about risk mitigation. Our funds that I'm involved in, so the Assegai Fund and Silver Oak Fund, which is the RIF version we have of this fund, they're essentially funds that are looking to achieve returns. So they're not all about risk mitigation. We do tend to have quite high equity allocation. And these funds are aiming to generate additional returns using all the tools that I was talking about during my presentation. At Fairtree, we do have market neutral funds, which is a fund that tries to return basically cash plus an alpha on top of the cash. So in any market conditions, you can generate the alpha and you can generate cash. But those funds, by definition, they're not going to be able to achieve kind of 20% CAGR over the life of the fund. For the Assegai Fund, which is an aggressive long-short portfolio, you do achieve higher returns.
Maybe I can just add to that as well, is in terms of having this complete toolkit, what it does allow is for the manager to express their purest view. And again, so if we don't like the NTM, for example, we can go short that stock, whereas in a traditional long-only fund, well, you just wouldn't hold it. So it allows you to be a little bit more clinical in how you can express your view.
Got you. And maybe circling back to the landscape of hedge funds in the South African context, at Visio, have you seen any opportunities that suddenly have come sort of your way in terms of hedge fund interest from South African investors, both sort of institutional and retail, anywhere from, say, a DFM to a sort of standalone advisor, and maybe some of the challenges also that gets faced when there's this interest, but there might be a stumbling block associated with it, and what does that stumbling block look like for you guys?
Yeah, I think the interest often peaks at times when we enter a period of increased volatility in the markets. When you see a bit of a sell-off, everyone goes clamoring for a market-neutral hedge fund, effectively trying to lower your beta exposure. Yeah, and then I think the hurdle is really trying to get around the fee structure. And it's hard to try and explain it away other than, again, I try and give a global allocator's view that the average fees globally are 1.5 and 20, and there doesn't seem to be pushback on that. They talk about should there be a hurdle in place, and you don't see hurdles in the main amongst the big offshore funds. And again, the uptake of the asset class, I think, clearly speaks for the value add that it has to a portfolio. The reality is, with my portfolio, I sleep well at night. I'm not concerned about if there is a major market correction. Well, I know that I've got protection in place.
Okay. Just to chip in, at Fairtree, we've had QIF funds, which are qualified investor hedge funds, minimum investment of R1 million, and monthly pricing for quite some time. And those funds have great track records, but they're not always the kinds of funds that are accessible to a broad range of investors. And more recently, we've launched RIF versions of our funds, of our Wild Fig Fund, which is a multi-strategy portfolio, and also the Silver Oak RIF, which is a retail version of the Assegai Fund. Those funds are available on platforms, they're priced daily, and they have much lower minimums. So, we are seeing a lot of interest having launched those types of funds, and I think they're much more accessible. So, there's not the stigma that you have to be a very high net worth investor to be involved in hedge funds anymore in the way that there probably was a few years ago.
And I mean, I guess one of the other things to discuss is, somebody coming to you and again a DFM or an advisor saying, well, I'm interested in hedge funds, but I don't know how to necessarily deploy them in a portfolio. Maybe, because we don't have a lot of time, maybe your advice around what to sort of consider when adding hedge funds or even a collection of hedge funds, because I think that's something that is intriguing for me is, as an investor for a collection of individuals, when adding hedge funds to a typical balanced portfolio, should it be, one hedge fund where, you can hang your hat on, or two, or collection thereof? How would you essentially deliver some sort of advice without giving advice? And this is not financial advice, this is really them expressing a view around how people should think about hedge funds in the context of a typical balanced portfolio.
Yeah. Again, I would look offshore. How it developed there is you had fund of hedge funds getting set up. So investors could go into a product without the concentration exposure, spread your risk amongst a couple of funds. The example of my PA portfolio, I showed I had 3 internal Visio funds and 3 external funds, so not putting all your eggs in one basket. And then interestingly, we run an optimizer to look at our balanced fund strategic asset allocation. And on an unconstrained manner, it suggested a 60% allocation to our retail hedge fund if there were no sort of limits that we put on the optimizer. And it suggested 0 to local equity. So it just gives you a sense of what the data stats suggest. And that's because they run with such a low correlation. They increase your performance and they decrease your risk. So yeah, the machine tells you, but spread it.
I think when you overlay fee budgets, I think that's where some of the sort of the canary in the coal mine sits. Yeah, I think that's it from our side. We didn't have much time to get into other stuff, but I want to thank you for your contribution to the hedge fund panel and to the audience. I hope you've learned a little bit about hedge funds and gotten some education. Thank you very much.
Fantastic, Rafik, Craig, and Clarissa. Thank you so much for that. Very insightful indeed. Before you run away, Rafik, I know you guys are actually blending think hedge funds with some of your model portfolios as well. Yeah, and some of the other DFMs are starting to do it as well, but make sure you've got the right license.
Absolutely.
Absolutely. Rafik, thank you so much.
Thank you very much.
Right, our next panel coming to the front, and here to moderate the session is Simon Deploy from Corian. Simon, thank you so much for joining us. And then we've got Nick DeForce from Centaur Asset Management. Yeah, instructions there on the iPad. Paul Bosman from Granite. Paul, thank you so much for coming through. Sapsnaker from Vunani, and Omri Thomas from, well, the agenda says Net Group, but ABAX.
Where, dankie.
Where's Omri?
Ons het nog stay at the back. Do you want one of these?
Baie dankie.
Come here.
There we go. Sneaky there. All right, multi-asset funds. Simon, I'll hand over to you. Thank you so much for being here today. Thanks.
Thank you so much, Eugene. Yeah, I think we can get right started. I think first up is Nick. Well, they've set themselves up in order. So I'll hand over to Nick, then to Paul, then to Safs, and then to Omri, and then we'll get into the Q&A.
Right.
Okay, great. Good afternoon, everyone. Nick DeVos from Central Asset Management. So presentation today is, are we there yet? Which is like quite ironic because I think in our industry there isn't really a destination, it's a bit more about the journey. So I'm going to be talking a bit about our balance fund that we don't really often go through. It's more, the focus often on the flexible fund. And then I'll just be talking about the asset allocation, and then within that, a couple of themes that are going on in the market at the moment. Views on SA equities. I'm sure you've had a lot of views around that today. A little bit about the US and China. So just firstly, the balance fund. So we've got just over a 10-year track record in this fund at the moment. Over the past 10 years, we're quite proud that it's the number 4 fund in the category. This is the A class, so advisors, DFMs, multi-managers would have access to a lower fee class, where you can add about 0.5% per annum on the respective kind of like red bars over there. And then, as I mentioned, in addition to this, we have a flexible fund, and then towards the end of last year, we launched an SA equity fund. So just in terms of kind of asset allocation, this will inform the rest of the presentation. So we're sitting with about 13% odd in cash. So we've got quite a bit of firepower on the fund. SA government bonds, we are slightly overweight. That 26% is versus a 25% benchmark number. We really use it as an asset allocation tool, but I'll touch a bit on that now. Then local equity, so JSE equity, we're sitting at 40%. We are underweight here, but we have become a bit more positive on SA Inc. I think the story SA Inc.'s a little bit delayed, but we are selectively buying there, specifically businesses where we find optionality or where we're being paid to wait. And then in terms of the global side of things, it's really on a stock-by-stock basis. So SA bonds, is it the time to buy them? So firstly, as I mentioned earlier, it's an asset allocation tool. We don't ever take any big bets around bonds, so we'll never go massively over that 25% or under 25% allocation to it. But currently, what this chart's showing here is that the market's implying that over the next 10 years, inflation in South Africa will run quite a bit above 7% per annum, versus historically it's been just over 6%, and the SARB targets a number of 4.5%. So we think that's relatively attractive risk reward. You are also getting very good real yields at the moment of around 6%, especially in the longer dated bonds. And if the SARB's successful in bringing inflation down, then that real yield looks a bit more attractive at around 8%. Part of the reason we aren't really swinging for the fences here, we are concerned about the fiscal position in the country and its trajectory, but the risk reward is quite favorable at the moment, so we are topping up a bit. Then SA equities, really the driver of SA equities we found is the interest rate cycle. So typically in periods we have rates that are being cut, the market gives you about 25% per annum, and in tighter cycles where interest rates in South Africa are rising, the JSE essentially gives you no return. So that picture over there, whenever it's shaded red, that's when the market's implying that interest rates will be lower 12 months' time looking forward. So if you kind of like squint your eyes a bit and look closely at the picture, you'll see that that red has actually been picking up. So the market was expecting rates to be cut by more than what they currently are. And it seems to be that inflation is proving to be a little bit more sticky in South Africa, especially on the food side and overseas, particularly in the US. So we think the rate cutting cycle is potentially a bit delayed. So what we're really looking to do is to find businesses that are paying us to wait and with optionality. So an example of that is PPC. So it's one that we've owned for quite some time, but we do trade it around the various ranges. So what's interesting with this one is that they've appointed a new CEO. Matthias used to be the ex-CEO at NPC, or Natal Portland Cement. So when he left that business, I won't quote the exact number, but the margin that he was running that business at was significantly higher than where PPC's SA Cement business 11% margin is currently running at. So we think there's quite a bit of scope for self-help to drive efficiencies in the business and potentially to take costs out of the business. And what they've also recently done is sold their operation in Rwanda, and we think that they could return around 20% of the market cap to shareholders over the next year to year and a half, either via special dividends or continued buybacks. So that's an underpin for the company, and you're being paid to wait, so that if this interest rate cycle does turn, you're almost going to get like supercharged returns on the up. So I don't expect the share to perform strongly anytime soon until we see the rate cutting cycle. And then we've just put here that potentially you could get 30% returns kind of per annum from that one when the cycle does turn. So US market, what US recession and where the rate cuts. So you might be familiar with this picture here, but it's the US yield curve, and it's been inverted for quite some time now. So for 21 months. So if you look back at history, typically by now you should have seen a US recession already, but the US economy just seems to be continuing to steam ahead. So we look at this, and it does give us a little bit of caution around the US market. Also, inflation seems to be sticking around current levels since July 2023, 3 to 3.5% versus the Fed's target of 2%. And you've had some of the members of the Fed come out and talk about potentially delaying rate cuts or even increasing rates this year. So we think that does warrant some caution and stock picking to really take preference over here. So this is just a tool kind of set I thought I would show you. So this comes out of a book called The Gorilla Game. So it's how we're viewing the current AI theme, which is quite instrumental in driving the markets at the moment. So if you look at that picture on the left-hand side, that's typically the new tech adoption cycle. So I'll give you an example. So if you look at number one there, so that's quite early on, that's tech enthusiasts. That's the guy that runs out and pays 100,000 Rand for a TV, and then 6 months later, the TV's half the price. So those are the people that run out and do the first purchase, and that's typically around 5% of potential sales. So if you look at number two, that's where we think Dell, which was one of the top holdings in the fund at the moment, that's where Dell is. So they've got some exposure to this AI theme, but we don't think it's really being priced. So what we do is we weigh kind of what stage we are in this cycle relative to the valuation. So Dell's being priced for stage 2, but we think it's potentially going to be entering stage 3 versus a NVIDIA in that picture where it's being priced for potentially stage 3, but we think it's somewhere in between the stage 2, stage 3, so the risk reward not that attractive. And I'm not going to go through all of them, but there's just the different cycles, and you can see what kind of like percentage sales typically fall in these things. So this is just a guiding kind of like principle when looking at new technologies. China Tech, I think, is, this, when we created the presentation or handed in was about a month ago, so China hadn't really run yet, but we think China is potentially an opportunity, but tech specifically. So on the left-hand side, you've got the Hang Seng. So you can see that the market peaked at over 30,000 points and essentially halved. And a lot happened around that period, but specifically for tech, you had a big regulatory clampdown. Overnight, the CCP came out and said that the education kind of like tech sector couldn't be run for a profit anymore, and that big spike down, or kind of like capitulation to the 15,000 level that you see there, that's when a member of the CCP was kind of removed from their parliament. So on the right-hand side, what I've done here is just aggregated a few of the large Chinese tech businesses, just to kind of give you almost like an index feel of that sector. And you can see revenue's been growing, and then more recently it's kind of like slowed down. As you see that red line, which is the margin that these businesses operate, has also come off. So that's when the regulation came out, and the tone was common prosperity, and a lot of these businesses started reinvesting, almost trying to not really show much profits. EBITDA also came down in that period, and more recently has started to pick up again, and margins also picked up. So the narrative has changed a bit. It's almost as if the CEOs of companies in China who used to be like full-blown communist are now leaning more towards a capitalist kind of framework where they're returning more capital to shareholders via dividends and buyback, and they're monetizing and cutting costs within their businesses. I think top line's also a little bit more difficult to come by, even though the Chinese economy is growing 4-5% per annum. So I guess the point of all of this is, for a very long time, Centaur hasn't owned any Naspers or Prosus, but over the past few months, we have built a stake in that to gain direct exposure to Tencent. And then just finally, here's just the long-term track record of the business. So the early couple of years, that's when we had stock portfolios, but from about 2004 onwards is the flexible fund, and that's 18 or just over 18% per annum over about a 24-year period. That's net of fees as well. And that's my story. Thank you.
Thanks, Nick. So the topic we submitted is grown as a bunch of tools. And when I started preparing a deck, I think it was sort of 2 weeks ago, I realized that we might be a bunch of tools, but we certainly also are a bunch of fools. This is the share price of NVIDIA since we launched our funds in February of 2020. We looked at the stock, we debated it, and we decided not to buy it. You didn't even need a pro pocket knife for this one. You could just push the button, and we didn't push the button. This is Hermes, a very high-end luxury goods company. We had a long look at it, long debate, many weeks, and decided it's too rich for us. Meta, the owner of Facebook, offered a great buying opportunity. We thought about it quite a lot and decided it's a good idea not to buy it. And then you go to university, and they teach you lots of complicated formulas, how to look after clients' money. They could rather just tell you never sell Microsoft or MasterCard. You'd get a far better return on your investment. And they didn't tell me that, so we sold MasterCard. But it's not really fun to be a fool. It actually causes physical pain. So how do we try not to be fools? Well, I could wear a wig and a bow tie and go to Cavendish Square. I wouldn't really enjoy that. It's the kind of thing we try and avoid. So how do we avoid it? We first look at the quality of what we're buying, and then we look at the price of what we're buying. Why do we do that? The first reason being, if you look at a company, it's a great company, and you look at the PE ratio, or maybe the low dividend yield, or the high price-to-book ratio, you would quite possibly not buy it because it's expensive, but it's a great company, like MasterCard. Or you would not want to look in the areas where there's only bad news, because you would be too scared. So how do we ensure that we don't make these mistakes? Firstly, thoroughness. So stories are convincing, whether it's the sell-side analysts telling you that a stock is cheap, or the media telling you that a specific sector is uninvestable. That's a strong story. You need to do your work thoroughly to defeat that. Secondly, emotional resilience. This is very hard for an individual. We believe you get it from a team. So we've got a very tightly knit team, and we have rigorous debates, but always mutual respect. And this resilience, this emotional resilience, is needed to execute on your thorough research, even when it's incredibly uncomfortable. Even when you're buying in areas where others are not buying, and there's very, very little good news. So we believe this thoroughness and emotional resilience are two very important forces in our process. So let's look at some of these stocks that we are buying that are expensive. So TSMC was mentioned at one of the earlier presentations today. They're a semiconductor manufacturing company. So they have got a monopoly on the very leading edge of the semiconductor industry. And if you look on this chart, the share price is in red. Our allocation in our balanced fund is in gray. You can see it's 6% of our fund at the moment. If you were running a value screen, you would certainly not be buying this stock. The PE ratio is north of 20, but we believe it's got a strong competitive advantage on a strong growth vector. When you get that combination, a competitive advantage on a strong growth vector, a PE ratio is a very expensive mistake. So we look at the company from a free cash flow point of view, and we build conviction on the competitive advantage and on the growth vector. And another example of a company like this, which is optically expensive, is Capitec, which you all know. If over time you ran value screens and you bought the other banks rather than Capitec, because Capitec's PE ratio is high, every time that was an expensive mistake. It's currently 6% of our portfolios. So let's look at examples of companies we bought where when we bought it, there wasn't a lot of good news around. We needed that emotional resilience. So Lam Research works in they make the equipment that makes the semiconductors. If you again look here, the red line is the share price. But during 2022, that share price halved. It was on the back of basically two drivers. Firstly, after COVID, there was a very strong slump in the demand for consumer electronics, and also the US banned the export of some of the equipment to China. This caused a very sharp pull down, and as you can see there, we used that opportunity to increase our shareholding. It was uncomfortable at the time, very uncomfortable. Applied Materials, similar industry, also makes the machines that make semiconductors. As you can see, the share price also halved during 2022 for the very same reasons, and we increased the position in our portfolios, and also that was not easy. So let's look at examples of companies where there's currently still no good news around. A property company. So property globally, in many cases, is still the share prices are not reflecting a lot of positive news. In fact, it's still reflecting pessimism. But we're not willy-nilly buying property. We are specifically looking for companies with good assets and balance sheets that are structured in such a way that even if interest rates remain high for a long period of time, the balance sheet will remain strong enough to survive the higher interest charge. This is not the case for all property companies at all. Unibel Rodamco, Westfield, owns very good assets in Europe, the UK, the US. The balance sheet is very well structured. It's currently trading at about 40% discount to its book value. How will you make money from this? Well, that share price could claw back towards book value. Book value could be written up. They'll pay you a dividend, which they're doing already, a very attractive dividend. And then it could even trade at a premium to its book value. If you look at the height of the cycle there, this price-to-book ratio indicates that in February 2015, it was trading at an 80% premium to a book value. At the moment, it's a 40% discount. If we run a normal cycle and property moves back into being very popular, you could make a lot of money. We've already doubled our money in this stock, but we think there's a lot more to come. Another property company which we all know, Growthpoint, very well-structured balance sheet, very good assets in many different countries of the world, and also trading at half of book at the moment. It's on the JSE, probably one of the standout opportunities for us. Finally, Derwent, it's a UK property group. They own a very good portfolio of assets in the West End. It's trading at about 65% of book value, which is £30 at the moment. That book value has already been written down from £40 to £30. So we could move towards book value of £30, and then that £30 could move towards £40, and then we could move to a premium above £40. And it's currently at £20. So a lot of money could be made in property, and while you wait, they're paying you a dividend. So these are areas which currently requires some emotional resilience to buy, maybe less so than a year ago. Property is becoming slightly more popular now, but there's still plenty of opportunities. So will we be fools again? Sadly, yes. But our aim is to be good fools by looking at our mistakes, stare them in the eye, analyze them, and hopefully become more tools and less fools. Thank you.
Afternoon, everyone. It's a tough act to follow, so I'll try my best. Just waiting for the slides to come up. Okay, so we've been asked to talk about asset allocation, and the topic I've chosen is kind of balancing risk and returns. I think if you look at sort of long-term returns, and these are long-term returns dating back the last 29 years, and these are real returns. So the numbers at the top, there's lots of numbers, but real returns over various periods of time. I think what you can see is if you look at the far right, the last decade or so, the place to have been was offshore. Foreign gave you good real returns and domestic fixed income. That has given you the best returns, but that's not always been the case. If you go back the last 10 years before that, you've actually had phenomenal returns out of SA equities and lesser out of foreign. So you've got to ask yourself, sitting at this point with the opportunity set that you've got in front of you, of asset classes that you can choose from, Where does your returns go to from here? Ultimately, what we're trying to do for our clients is balance risk and return, give them the best risk-adjusted return and real returns. So if you put all the asset classes into some sort of optimizer to find the most optimal mix of assets to give you the best risk-adjusted returns and also inflation-beating returns, what you find is that over time, probably your sweet spot for risk-adjusted returns or real returns is probably between 5 and 6%. If you can invest in a mix of assets over time that gives you roughly 5 to 6% real returns, that's probably the most optimum balanced portfolio you can get. Beyond that, adding more risk to your portfolio by going out on the risk spectrum with more equities, you add more risk, but not necessarily more returns. So finding that mix of assets, you're typically looking at a portfolio of between 55 to 65% equities and the balance in fixed income. So now that we know what assets we're looking for to generate real returns, we've got to ask ourselves, so standing here today, we know that global markets have done very well. But with the opportunity set in front of us today, what do we invest in to generate returns for the next 12, 24, 36 months? And where does that opportunity set sit? So these two charts are cyclically adjusted PE charts. On the left, S&P, on the right, SA equities. I think you're probably going to hear this a lot or have heard this a lot today. The S&P is looking relatively expensive. And if you look at what's happened to US markets over the last while, the breadth of the market has narrowed. You know, there's a very strong tech bias towards driving the market, but there's also a deep bench in that market that actually is trading quite cheaply. So at the index level, it looks quite expensive, but within that market, there's opportunities. The flip side of that is when you look at SA equities look quite cheap. But what does that mean? Is that for that cheapness to be evolved over time, you do need earnings to come through. You do need business to survive. But if that's your choice, on a relative basis, where does your return come from? Where's your balance of probability of future returns? It has to be biased towards domestic equities. The emergence of that return over the next 12 to 24 months, I guess that's what everyone's trying to time. No one denies that there's value there, but when does it emerge and how does it emerge? So these are charts as well. If you look historically, so this is S&P, now the historic PE, not cyclically adjusted PE, bumping close up to 21 times. If you start at a multiple that's that high, the top bar is subsequent returns when you're investing in a market with fairly high multiples, and the subsequent returns you earn. The further you go out this way, the lower your probable returns in future periods, because your PE multiple actually prices in a lot of future expectations. So what you've seen in recent earning results, you've seen companies report solid numbers, but where outlooks have come in a bit less than expectations, they've derated quite significantly. That is not a positive sign. That is a market pricing in a lot of good news, and any fluctuation in expectation is going to have quite a big drawdown. And a lot of that is based on the fact that you're starting at quite a high multiple. So as you look at your client's portfolio, you obviously want to multiply and compound the returns over time. In which portfolios and which asset classes do you invest? You should have some foreign exposure in your portfolios. I mean, it's a diversifier, but you should be careful where you divest because you are in an emerging market. So you want to have DM exposure in your foreign exposures. If you look at the domestic market, clearly we're trading quite low, probably about 9 times on the historic multiples. Again, if you look at the far right, you're probably, if history were to repeat itself exactly, you're probably looking at the next couple of years, high teen multiple returns. That's because you're starting at quite a low multiple. You don't need a lot to go right to generate those returns. You can generate quite a lot of returns by the market re-rating. Now, we all know there's lots of political risks and all the election risks, but if we can look through those periods, starting at this point, to compound from these levels at high teen rates is not impossible. It's not what most people are expecting. Yes, there's going to be a bumpy period ahead, but these multiples do offer quite a rich opportunity going forward. So this is quite a busy chart. I'll kind of explain it. On the left vertical axis, the SA 10-year on the horizontal axis, the US 10-year. So interestingly enough, we always think of our markets as, being quite risky. But if you look at over the last couple of years, during lockdown, our 10-year bond yields went above 12%. But over the same period, the US 10-year went from sub 1% to above 4.5%. So the yields have expanded, higher yields, lower returns. But SA has actually stayed between 12 and 11, which actually means that the SA bond market has actually outperformed the US market. Now, standing at 11%, if we're at the cusp of a rate cutting cycle, these returns in government bond yields, forget adding credit to that, is quite attractive. Again, cast your mind back to the first chart. If inflation is running at 6%, buying government bonds at 12% is a 6% real yield. That is attractive if you think your upper bound of real returns is 5 to 6%. But the SA market and debt markets are not without risk. I think when you are taking on credit risk, you've got to understand that there are default events. We've had recent default events. And these events do require you to be aware of the risk in the underlying operations. These underlying business operations are taking stress. You can see that in the SA economy, you can see that in businesses. To perfect security in some of these underlying instruments does take time, and there is a legal process. But these things happen over time. And the other thing I think people need to be aware of, investors need to be aware of, is when you think of fixed income, everyone thinks of fixed income as a very liquid market. In reality, when you look at the domestic fixed income market, we've got the 11 trillion rand market, but it's very concentrated in 11 bonds that actually trade 90% of the market. So we've got 2,400 bonds, but many of them don't trade. So liquidity is there, but it has to be orderly. And I think over time, that's what you're going to have to consider when you're putting up your portfolios. How do you mix these assets together to create the best optimal portfolio? The opportunity set is clearly sort of linked or tilted towards domestic valuations, but you've got to have a portion of your exposure in global markets and in the US, because that market does drive a lot of what happens in global markets. So I think the period ahead, when you think about balancing your portfolio, is really about compounding your returns over time and buying assets now that over the next 12 to 24 months could generate outsized returns. Thanks.
Thanks very much. Thank you and good afternoon. We've all heard South Africa is very much out of favor. But I recently attended the OMD conference, and sometimes things do come back into favor. So even my kids enjoyed the conference after the concert. So today, I'm going to chat about opportunities for certainty. I think we're in a very interesting environment. If we go back 1-2 years ago, there were very few asset classes that one could actually invest in. Some of them were uninvestable. And we've seen a complete change in the asset classes and asset class pricing levels into an environment where we've actually got a lot of choice now. So if you look at what's happened, you've had US interest rates rising very sharply to high levels, and at the same time, you've got record debt levels at the moment. The US national debt sitting at $35 trillion at the moment with these high rates. So if you just knew those two facts and you ask where is the market trading, no one would guess that it's at a new all-time high. So markets continue to challenge the fundamentals. I mean, if you take it back a year ago, people were talking it's going to be a US hard landing, soft landing, a recession. They've managed to guide a very uncertain plane, and so far it's been no landing, despite a very tight labor market. Inflation looks like they've got it sort of under control, and the economy continues to boom. In South Africa, we've got elections coming up. The outcome will impact the markets. Very interesting period with the MK party appearing, ANC support dropping, and one will see the sort of alliances that come out after this election. So the outcome will impact markets. But a lot of those risks are now being discounted in the market. If you look at the risk premium associated to our market, to our bonds, at quite extreme levels. So if we just looking at that, our SA risk premium, you're currently getting a very healthy premium for exposing yourself to SA risk. It's been higher at times with Nenegate during COVID. So, but what's in the price? So determine the current risk premium, try and look at future risks, determine the price of the asset, and then invest when the risk reward is favorable. So if you just look at some of the opportunities at the moment, a lot of speakers have referred to the cheapness of our local shares, how attractive our bonds are. And if you look at specific examples, one share that was mentioned was ABSA. Now, there's been about 40 cases in history where the PE of ABSA was below its dividend yield. And historically, just knowing that factor, if you invested in ABSA, your subsequent 12-month return was over 30%. Now, if you break it down, you say ABSA currently trading at a 5.5 PE. In the past, it's traded up to 10 times, or its average has been close to 10. It's got over 10% dividend yield. We're forecasting earnings to grow by 10% over the next 3 years on average. So 10% dividend yield as your starting point. You're going to get 10% per annum earnings growth. So that gives you, that takes your 10 to about 20, and then you haven't had a re-rating. So if it re-rates from 5.5 to call it 7, so it's only 1.5 PE re-rating, that's 30% capital appreciation. So if you also spread that over the 3 years, that's another 10%. That takes you to 30% per annum, and ABSA is then trading at a 7 PE. If you look at our bond yields, you can buy the R2044 bond, which is now a 20-year bond. So our 10-year bond trading at just about 12%. But if you look at what the R2044 implies from 2035 or 2034 to 2044, you're getting 17% per annum for those 10 years. So in the South African market and managing a balanced portfolio, you can at the moment construct a very attractive real return offering portfolio from the asset classes available to you. So you try and apply a wide tool set, and that's the benefit of running a balanced fund. We've heard local equity stocks are attractive. We've heard bonds are attractive. You've got these global stock picking opportunities, and the benefit of running a balanced fund, if you can rotate between these different asset classes when value appears in the different asset classes. So at the moment, almost all South African assets look attractive to us. Bonds, SA linkers, equities, cash, you're getting a very good cash return. Emerging market equities also looking attractive, especially China. And then protection levels, your VIX is at reasonably low levels, so you can also buy reasonably cheap protection on your global portfolio. US bonds has become investable again. They were totally uninvestable when yields were at the low levels. At the current yield levels of close to 5%, as the global risk-free asset, we think it is a very attractive asset class to include in your portfolio again. We think US equities and development market bonds still look expensive. So you can build a nice diversified portfolio with attractive underlying yield. The portfolio yield of the opportunity fund, as an example, is currently at 8.3%. So it's a very nice floor to your return, and hopefully through your exposure to some growth assets, you can further enhance on that return. So this is just to show that over time, the switch in allocation to the different asset classes, and that's the benefit of running a balanced fund. You can rotate between the different asset classes. So we've got two objectives with the opportunity fund that we manage on behalf of Net Group. The one is to protect capital over a rolling 2-year basis, and the other one is to try and achieve inflation +5. It's quite a busy slide, but we highlight here the all share, and you can see the massive drawdown that we've seen, especially with COVID, and in green opportunity fund. So over the, I think, 142-year rolling data points, in only 2 of those instances, we haven't been able to protect capital over 2 years, and that includes the sort of COVID sell down, it includes the Nenegate, Steinhoff, which you guys know that we had some exposure to. So we're quite proud of that achievement in the past. So at the moment, what are the opportunities? We think inflation has started to roll over. It looks like core inflation, especially in the US, is still sticky. We think global rate cuts are currently being priced in, and it is probably going to come through. Tight US labor market still keeping pressure on inflation. We worried about the US valuations at quite high levels. We see attractive valuations in China. High cash rates, both locally and globally, offer you opportunity to not to have to take on too much risk to still get a decent yield. Locally, we do expect some rate cuts to come through. And then in SA, we're actually finding quite a bit of value on the equity side and on the bond side. So over time, the red line is inflation +5, and the yellow, white, brown, and pinkish line are the different asset classes that one can use in the balance fund. So again, the green line is the opportunity fund. So over time, by being able to switch between the different asset classes, we can see we've been able to get close to that inflation +5 target, which has been quite a tough target over the last decade in South Africa. Our assets have been under pressure, but I think structuring a portfolio now for the next decade is a very good opportunity for one's clients. Thanks very much.
So I want to start at benchmarking, because we had a single asset class presentations this morning, and that's a narrow opportunity set, but a very clear benchmark, either the equity benchmark or the bond benchmark. Multi-asset funds has got a much wider tool set, but benchmarking becomes quite a problem. Paul, I'm going to start with you. If I understand correctly, your fund does not use a strategic asset allocation as part of its processes. If I more or less got it correct. Is there any reason why, and sort of what is your view on benchmarking in a balanced fund?
Yeah, I mean, we like working backwards. So if someone's 70 and they need to go to the grocery store, maybe they need a new car, maybe they want to go overseas, we want to make sure they've got as much money as possible if they've trusted us with their pension money. That you get from high real returns. So we're going to target high real returns and nothing else.
So does that mean you just view all asset classes in the same way? You don't bucket them into different...
Yeah, no, we're going to, where the opportunities are the most compelling, that's where we're going to invest. And that will ultimately inform the asset allocation.
Safs, I almost get the impression you guys are on the other end of that. As soon as somebody goes and throws some math into, some Greek letters into the optimization, it's quite technical. How does Vunani approach strategic asset allocation?
Yeah, so we typically think of asset allocation as generating real returns over time. And when we look at the opportunity set and real returns over time, we think, reaching above 5 to 6%, that's a challenging target to begin with. And mixing assets, if you're just going to go for the highest possible return, you actually end up with almost an equity-centric fund, because that's probably your best growth opportunity. So the way we kind of look at balanced funds is trying to balance the risk and return, and to reach for the highest real return that's possible with the opportunity set ahead of us.
All right. Nick, your guys' fund, I noticed, was very concise in terms of its benchmark, like 1 or 2 asset classes, a bit of bonds and that. Do you find that gives you more freedom, or is it, is there any specific reason you went very narrow on your asset, on your benchmark?
Let me explain how we constructed it. So The benchmark is the strategic asset allocation, and when we created it, essentially we built an efficient frontier, and we backtested and made sure that our benchmark that we're creating is able to deliver top quartile performance and to meet the criteria of CPI plus 4%, kind of like under various scenarios. So that kind of like grounds the asset allocation decision. It actually makes it, I find, maybe a bit easier because once you've set up that asset allocation, you don't have to worry too much about it. I mean, we do tactical, around that, but that kind of like grounds it, and I guess is a kind of like a starting point for trying to outperform. But really, it simplifies things.
Makes it quite concise. And then finally, Omri, in terms of, sorry, what wasn't clear from the slides is, does the fund have a strategic asset allocation? And then how do you try and, if it does, how do you sort of determine your target of not delivering a negative return over 2 years?
Yeah, so for us, it's a constant shift in focus between capital protection and sort of asset appreciation. We haven't got a strategic asset allocation framework, so within the mandate limits of the minimum, maximum weight to the different asset classes, and actually only the equity limit, we do adjust our weighting, but it is dependent on the opportunity set available or that the market provides you at that point in time. So if an asset is very expensive, we will go to zero in it, even though it could be high in the benchmark. An example would be bonds. When bond yields were at 8-9%, we had zero government bonds within the portfolio. At the moment, it's one of the highest weightings we've had in it. So it depends on the opportunity set at the time.
I want to move to SA Inc. next, but I want to try and set it in the context of multi-asset. So I think many people agree that, if we've heard a lot of presentations, that SA Inc. is considered cheap. Many fund managers are overweight. My question would be, in a multi-asset portfolio, you've got the ability to bring in more asset classes. And Saf, if I can start with you, what is the counterbalance to SA Inc. if the view is wrong? If we've got another year of disappointing returns, we were sat here 12 months ago, and there was quite a positive outlook, and we actually had quite returns were relatively flat. So what's the counterbalance to SA Inc. in a multi-asset portfolio?
Yeah, so when we think SA Inc., we think both equities, bonds, and cash, right? So, I mean, if you look at cash at the moment, you can probably get NCDs between 9 and 10%. I mean, that's quite an attractive, almost risk-free asset to have in your portfolio, right? So we build it up kind of bottom up. Where do we want our SA Inc. exposure to be? Fixed income is very attractive. It's pricing in persistent inflation at about 7 to 8%. We think that's unlikely over a 10-year period. So there's opportunities there as well. So the equity component, while we're kind of moving into the equity component, we're not, boots and all into it. We kind of think of the growthier assets as SA equity relative to global equity, and that opportunity set. Yes, you're right. You could be sitting here 12 months from now, and we have been sitting here for a while saying SA Inc. is cheap. It hasn't emerged. But at some point, you don't need the earnings to emerge for SA Inc. to re-rate. You need the expectations to change. You need the sentiment to change. And I mean, you've got a couple of catalysts probably on the horizon. I mean, everybody knows the elections is happening. If that turns out less bad than people expect, that could be a massive catalyst. And also the first sign of a rate cut in domestic markets could also be quite a strong sort of tailwind for SA equities.
So, yeah, let me turn to Paul next. As I want to ask you the same question, because you're very broad in terms of your asset allocation. For as a counterbalance to SA equity, what do you think can do well if SA Inc. doesn't do well?
Yeah, I mean, I think that's a good question. If you look over long periods of time, South Africa, our history has been rough and hard. And where we are now is probably some of the easiest sort of patches in the history of South Africa. And the big money was made buying companies that can grow faster than the cost of capital. The cost of capital in South Africa has generally been high. And whether you're looking at the Santums or the Capitec's of the world, companies that could grow, Shoprite, that's where you made your big money, by buying them and keeping them, and they could grow faster than the cost of capital. So that's still our approach, is our biggest positions are companies that are growing, and we think they'll grow even, if the economy doesn't grow very quickly.
So, sorry, I just need to clarify that. So does it mean you don't actively try and find a counterbalance to that in your portfolio? Are you really confident in your stock selection? Is that what you're saying? Am I getting it right?
So you mean in terms of asset allocation, whether we also have a conservative asset allocation, setting that off? Yeah, I mean, so government bonds at the moment for us is fantastic because it provides you liquidity at a very high yield. You've got some duration risk, but if you're managing a balanced fund, I think you can take that risk. When bonds are not attractively priced, it's harder. Then you've got to sit in cash, and you've got the cash drag. We would more use cash and bonds for liquidity than for timing markets. Timing markets is very hard, but we've got a lot of respect for the benefit of being able to move in tough times. So at the moment we've got some cash, but predominantly our liquidity lies in government bonds.
Omri, do you want to add to that? Or well, essentially the same question.
Yeah, I think you, even if it doesn't happen, I mean, you're getting paid to wait, Simon. It's our yields, our real yields are very attractive. So unless you've got a significant, massive risk event and an inflation blowout, it's very difficult to get the catalyst right over time. But if you know what the valuation is, your starting valuation that you invest in, I think that protects you. And at the moment, and in our market, realistically, I mean, we know that the SA portion of it is actually only 40-45%. So you do get a lot of global diversification, even in some of our South African shares as well. So it's difficult to get that catalyst right, but I think you're getting paid to wait.
Nick, I also want to ask you the same question because I'm quite curious if there's something, because let me maybe try and set it up more. We get a lot of this from South African investors, especially institutional side, and maybe that's where I'm coming from. Is like, what if this keeps going wrong? So, what's and I think in a multi-asset, you've got the ability to put something into your portfolio that helps in the tough times.
Yeah. So I mean, look, I think it's all like based or boils down to risk reward. Like I mentioned in the presentation earlier, we do think the rate cycle is a little bit delayed, so we're not going all out buying SA equity now, but we are buying. But it's very company specific. It's where you're being paid to wait, and where you've got optionality. So we're looking for businesses that have quite a bit of like self-help, busy going on within them, and then they're returning capital to you. Then, and there's like a few scenarios where you can get an easily 15% return per annum for, doing that. And then you don't need to have like all these positive catalysts. And, we might be in the same situation in 12 months' time, but you're getting a 10, 15% kind of like return, even if the economy is not really growing. So,
Nick, you guys also had quite constructive on China. Yeah. Is South Africa highly correlated to China in terms of its prospective return? Isn't that just doubling up on the same view within a multi-asset portfolio?
Yeah, so quite specifically China tech that we're positive on, and it's really it's Tencent that we quite like. But as a broader theme, China tech looks quite interesting. And yeah, it's very dependent. I mean, it boils down to the commodities that we export there, and that kind of like really drives growth in South Africa to an extent. But this is kind of like tech, more kind of like consumer focus that we're more interested in at the moment. But yeah, like predicting, commodity prices, that's also like a very difficult thing to do. Does like India become the next China, or does China start doing stimulus and recover? So it's, if you ask anyone, no one actually knows the answer, but it's kind of like playing that risk reward.
Paul, I'm still struggling a bit with your fund. What's your view on local versus global equities at the moment? Like sort of what's your allocation between the two?
Yeah, I mean, we've got globally about 40%, which is all in equities, well, property and equities. And we've got about 15% in bonds and 5% in cash, and the remainder is local equities. Yeah, I think where local equities, we probably aren't finding many opportunities, but the opportunities we're finding are good opportunities. So we're utilizing those. We're trying to buy the best companies, because in South Africa at the moment, I don't think any companies are expensive. And if you buy the best companies that can grow despite the challenges, you're probably going to be okay. Whereas if you're buying companies just because they're cheap, the value might not be unlocked, if South Africa doesn't get better. So we're more focusing on the companies that are growing their profits.
Gotcha. Safs, are you guys also have a high allocation to offshore?
Yeah, so we've got slightly less. So we've been reducing our exposure to offshore. So for the first time in a long time, offshore fixed income is actually looking interesting. So we've been switching equities into US Treasuries at 4.5% on the 10-year. It's actually giving you a real return after many decades of no return. So that's kind of a nice, maybe to your question of counterbalance, a nice different way to think about a counterbalance to your domestic exposure. But we're probably running our global exposure at about 25 to 30%, 25 to 30% in fixed income, local fixed income, and then cash at about 5%, the balance in equities, domestic.
Perfect. We are at time. Yeah, so thank you very much. And thank you for the fund managers for your time and your presentation. Over to you, Eugene.
Right, if you can remain seated very, very quickly, I'm going to be a minute and a half, so Paul, that light's still going to be in your eyes for another minute. I'm so sorry about that. Just to all our presenters here today and our moderators, thank you so much for being here.